Hello, I'm Stephen Hode, technical analyst, trader and founder at the Stock Hunter. If you're new to the channel, then a big welcome to you, and if you are a regular, welcome back and thank you for your support. Would you like to learn technical analysis and be able to apply it successfully to your trading and investing? Would you like to learn ways of using it over multiple timeframes or not even timeframes at all? Would you like to know how to apply it to any type of market, whether that be cryptocurrencies, commodities, stocks, forex, whatever? It works on them all. And would you like to learn from someone who has been doing this for 25 years, teaches the professionals how to do it and uses it very successfully in his own trading? And better still, would you like to learn technical analysis totally free? Well, if you do, then you are in the right place, and I'm hoping that I can help you on your journey to understanding technical analysis through this video and this course. Now, the course is pitched at beginners, but it's suitable for all levels, and you may learn stuff that you've never used or thought about before in the world of technical analysis and trading. And the course is made up of 7 hours of content broken into small handy sized modules so you can learn at your own pace. There's 45 lectures, and inside that I'm hoping to give you a full roadmap of where to go in technical analysis and how to take it further. And there's even some psychological profiling tests and a trading plan for you to take away. Now, did I remember to say that it was free? I think I did, but all I want from you from this course is to tell your friends that you liked it, give it the thumbs up, and don't forget to subscribe and hit that bell button to receive future notification of future content that I'm going to produce just like this. So with all that out of the way, let's crack on with the course. So as I just mentioned, the course is made up of 8 sections and 45 lectures. Section 1 is an introduction to the course, just to give you a bit more in-depth feel to what to expect and what you'll need to do, and learning outcomes as well. And also a very important section on the housekeeping, so you can understand how to use the course. We then go on to section 2, which is all about the essentials of technical analysis, things like charting packages, the intro to technical analysis, 20 rules you need to know, big questions, and essential chart knowledge, sort of the basics just to get you going and up and running. In those basics we cover line charts, bar charts, candlestick charts, market breadth, and some other common forms of charts. Then we move on to section 3, which is all about direct price analysis, and we look at trends, support and resistance, patterns and price, moving averages, bands, Fibonacci, pivot points, Ichimoku. It's all in there. And then in section 4, price confirmation tools, things like trend and momentum, volume, volatility, sentiment, and how you put the tools and indicators together in technical analysis. Section 5 covers alternative concepts, and I'm going to dive a bit into those, not too much detail, but they're for you to take away and digest. And then my favourite section, the Japanese charts, the introduction to, where we cover off Heikin-Ashi, Renko, Kagi, line break, and give you some ideas where you can take that next. Section 7 is about putting it all together, strategy design and implementation around technical analysis, risk and trade management, rules and ways of using technical analysis to improve your trading from sort of the more safety side of things, and how you can improve your results. And then section 8 rounds it all up, and in that section there's a couple of psychological profile tests that you can do, and you can also take away the trading plan and build that into your newfound knowledge on technical analysis, trading and investing. More than ever, technical analysis has become easier to use, more affordable, more accessible and is now at a state where it's levelling the playing field between the professional and retail trading arenas. It's in a boom cycle. Everyone's using technical analysis. It's all part of the wider technological revolution, and it's great for you and me as traders. So why should you use technical analysis in your trading and investing? It's quite simple, really. It's about getting an edge. And what is an edge? Well, that's a mathematical advantage you have over a game played over time, and in this instance it's trading. And if you don't have that edge, then you don't trade. It's as simple as that. And finding an edge in today's trading could come from programming skills like Python or C++. It could come from some specialist knowledge or an industry that you work in, or you could use technical analysis. Technical analysis is just so easy, quick, simple to learn, and it allows you to analyse and trade just like the pros. So let's take a quick look at an example. I'm going to look at something called lean hog futures. Now I'm using the lean hogs example to really illustrate a point around technical analysis. And lean hogs is simply pigs, and in America they're a very popular futures market, but they do illustrate the purpose of using technical analysis. Now here we have a simple candlestick chart. Now each one of the candlesticks or the bars are red or green, and that signifies, or one of those bars signifies, a week's worth of price data and action. Greens are up, reds are down, and as we can see from the chart here, this spans over 11 years of history, and I've drawn on some blue arrows there to show you where the market suddenly drops off, and it's always around July time. And why is that? Well, the answer's in the red box below, and it's really simply because it's barbecue season, and there's been 10 winners in the last 10 years. And why does it sell off in July? It's basically the end of that period. The buying stopped, supply and demand is resetting itself, and the market sells off. Now if I was a hog farmer, I'd have the inside knowledge of that market activity. As an outsider, very difficult to find that information, but if you pull that up on a technical analysis chart, you can see it and have the same type of knowledge and inside information that the hog farmer has. So a brilliant example, an illustration of why using technical analysis can give you an edge. So I'm going to give you 5 good reasons why you should use technical analysis. Well, the first one is going to make and save you money. It's going to save you a lot of time. It's going to help you deal with the psychological aspects of trading. It helps create discipline. And finally, the 5th one, it is so simple and easy to understand. And if that wasn't enough, also on top of that, it aids your trading and investing further by creating fixed targets and objectives, timing, entry and exit of trades, sizing and risk reward methodologies, and ideally strategy design and enhancement. Overall, like I said, it gives you that edge that you're looking for. Now for the beginner, technical analysis may seem to be a vast, massive, confusing subject, and you're not really sure where to go or how to use it. It's made of lines, squiggles, noise charts. What do you do? Well, let me assure you firstly that it is really simple and easy to learn. It just requires you to bring some dedication, application and an open mind. And really, technical analysis is a tool that anybody can use. Unfortunately, I'm here to help you in that journey. And I'm thinking that I've got down in this course all that you need to know to successfully use technical analysis and apply it to your trading. And it also allows you to develop and expand further as a technical analysis expert and use that to develop new strategies, ideas, trading techniques, and hopefully more financial reward. Now the course is taught by me, Stephen Hode, and I'm one of the UK's leading technical analysts, and I've been using technical analysis for over 25 years, Professionally in investment banks, hedge funds, trading houses, I hold the MSTA qualification from the Society of Technical Analysts in the UK with distinction, and I'm also on their panel of elite trainers, so I teach the diploma course to the professionals over here in the UK, and also teach on postgraduate programs at various universities throughout the UK. I design and build my own technical analysis systems and strategies heavily into algorithmic and systematic trading. I use it very successfully in my own trading, and there's probably not a lot I don't know about technical analysis in trading, so you should be in good hands on this course. So what will I teach you on the course? Well, firstly, the course is suitable for all levels, but it's aimed at the beginner and new user of technical analysis, and the aim of the course is to give you a complete and thorough foundation overview of technical analysis. It was going to answer those questions you've always wanted to ask about the subject. You're going to understand what charting tools and resources you'll need to master the subject. It's going to allow you to decide the route you want to take for your trading. That's very important. You don't want to be forced into a route in technical analysis. You want to make it your own, because there is so many avenues you can go in. I'm going to teach you how to practically apply technical analysis to your trading and investing. You're going to learn not just how to use technical analysis for getting into trades, but how you can use it for risk and trade management, and how it can improve your trading results, discipline and psychology, and how you can all build this into one hopefully successful trading plan. As well as that, you're going to get valuable insights and experience and tips from myself, and I'm going to give you the next steps, resources and information on whatever tangent you take in technical analysis, so that you can really master the subject. Now, the course is broken down into easily understandable and digestible modules, and each module, where appropriate, is broken down into 3 stages: a lecture, examples, and then practical exercises for you to follow. I hope that's given you a great insight and answered some of your questions around my course on technical analysis, and I hope to see you very shortly within the course. So to get the maximum from the course, I'd like to go through a bit of housekeeping first, and the first thing you'll see is a whole bunch of symbols. Please do pay attention to these, because they are there for a reason. Now, the first one is a warning symbol, and that's there as sort of a highlighter that something's worth paying attention to. Then there's the magnifying glass. It's a concept check, and the megaphone, something important to take note of. You see the exercise book, obviously an exercise for you to do, and the light bulb is a tip from my vast database of experience in the subject. It's also important to understand how the course is structured, and I've given it more of a university type of feel, where I'm going to first of all give a classroom style lecture. That will be followed up with further examples to prove out cases of point within the lecture, and then finally, where appropriate, I'll give you some practical exercises for you to get stuck into, just to cement the learning from the lecture. And that's pretty much how I want to structure the course. Like I say, that structure will remain in place where appropriate. Now, this part is important. It's all about the course resources, what you need to have to do the course. And at a minimum, if you really want to get the best out of the course, you're going to have a technical analysis charting package. Now, I'm using something called TradingView for the purposes of this course, and if you want to copy exactly what I'm doing, go to my website and go to our charts page under the trading resources section, and you can set up just like me. But as this is an introductory course to technical analysis, most other packages will probably do you just got to check whether they do the more interesting chart types, the Renko, Kagi, line break, point and figure, that type of thing, so we can all be on the same hymn sheet. And I do discuss charting packages and options from the most expensive to the free ones, the ones I think you can use within section 2 of the course. Now, if you do need a broker to start your trading journey, you're new to trading, then again on my website, thestophunter.co.uk, under the Trading Resources tab, our brokers, I list some of my recommended brokers that I use, and they cover all countries around the world: CFD, spread betting, stocks, options, spot FX, the lot. So have a look there. Not necessary for the course, but if you want to start trading, put that technical analysis into a live or a demo environment to test your skills, then hopefully that bit of resource can help you. And finally, the actual course support. If you've got any further questions, queries, need any help around any of the content, then get in touch with me directly through the course or by email at info@thestophunter.co.uk. So that's it for the housekeeping section. I look forward to seeing you in the course. We're off to an action-packed start in section 2, and there's a lot to learn. We're going to have a bit of a look into the background, the history of technical analysis, give you a bit of foundation about the subject. Then we're going to discuss charting packages and tools, the practicalities of using technical analysis in the real world. What should you use? What shouldn't you use? What's good? What's bad? Then this isn't a definitive list by any means, but I'm just going to give you, to start with, to get you thinking, 20 rules that you need to know in technical analysis, and you'll pick those up as you get more and more experienced. Then the big technical analysis questions, the ones I always get asked, and you've probably asked, does it work, that sort of thing, answered there. And then we build into the practical side of the course, the essential charting knowledge, and first of all we look at creating charts, the foundations of technical analysis, and the basic chart types. And I call them basic because they're the ones most used and widely available. That's the line, bar and candlestick charts. And we have a quick look at some other types of chart. Then we finish off the section with something called market breadth, which if you're into trading stocks can be very useful. Before we can go any further, we've got to talk about charting software. Now this is going to be the main area where you do all your technical analysis, so we've got to get it right from the start. And as it says, it's essential. It's an essential tool that you're going to be living with, especially if you're a more technical based trader. You simply can't trade without the charts. Also, if you're a fundamental type trader, they're guys that look for value in stocks or currencies, commodities. They don't often look at technical analysis, but even they do take a sneaky look just to confirm whether they're on the right tracks or not. They might use it for risk management purposes. So you're asking, well, what should I use? How much is it going to cost me? Well, the cost, it really depends on how deep your pockets are. There's Rolls Royce of technical analysis all the way down to free charting packages. You'll notice that most brokers give them for free. They give better versions away the more number of trades you place, but mostly they are limited in their application. Now there are free websites out there that could be useful, to get you started, but mostly they're free for a reason. Now I've used many charting packages over my time, and what I found is that you've got to find a provider that is easy for you and that you feel comfortable with using. You're going to use it so much and you want it to achieve certain things. It's got to be right for you. Like I just said, you pay for the charts for a reason. So if it's free, it's going to have limitations. It's not going to be as flexible as you want. It's not going to do the things that you want. Also, the free version often requires more time and work as well, and I think you're going to find it frustrating. So it is worth investing in a decent charting package, especially if you're going to do like intraday fast-paced trading in, say, the FX world. You're going to need a reliable charting package that gives you a decent data feed. It's accurate. If you're not getting those sort of things, then you're going to end up losing money. So some considerations for you when sort of setting yourself up on your charting package. Well, the most important thing is that you can set it up for your trading world, your strategies. I like to find a package that can allow me to create systematic rules and processes, which again saves you a lot of time. And well, especially if you want to trade multiple markets and different time frames, it's essential that you get the package that is set up for that process. Can you clearly see your buy and sell signals? Does it give you alerts? Can you see how to plot your risk management, your stops and your profit taking? Can you develop your own strategies in there? Does it have the functionality for back testing, downloading the data? Can you analyze your performance, trading performance off the back of it? Also, using the functionality of it. Is it just PC based? Can you use it on a tablet or a phone? I don't recommend using technical analysis on a phone, but the technology these days is getting better and better. So, can you use it there? On top of that, is it like a fixed product with a fixed tool set? I like to look for a package that gives you the flexibility to enhance the indicators provided. Can you create your own indicators and technical analysis tools within their platform? And can it cover the different chart types and indicators and tools that you want? And especially important, especially in terms of cost, live data. Does it come with the live data, or do you have to pay for it? If you want to trade commodities, for example, you might have to sign up for extra subscriptions to the ICE or CME exchange, which can easily build up costs. Generally same cross markets, but a lot of the platforms do offer some sort of free data, mainly FX. So another consideration for you there. So I've put together this table of useful charting, technical analysis sites, packages that is. It's not an exhaustive list, it's just some that I've come across and have used in the past, and they cover all options. You have free charting packages like Big Charts, which is inside the Market Watch website platform. Freestockcharts.com. Another really good one for starters is stockcharts.com. A lot of their stuff is free, but there is a subscription service if you want to take it further. There are other types of ones like barcharts.com, which is more for US stocks, and if you want to go to the, call it the Rolls-Royce end of technical analysis, then you're looking at packages like Bloomberg and CQG, and they are very expensive and used by the professional traders. They do probably tick all the boxes, but you will be spending a lot of money on them. Now, I personally used TradingView, and we'll discuss why I do that in a minute. But there, there's lots out there. Test them, play with them. For this course, you can use pretty much any package you like, but if you want to specialize in certain areas, then that's why you've got to check that your technical analysis package does do the business. So it's pretty obvious really, the more you pay, the more you're going to get, and those platforms like TradingView, CQG, Bloomberg, eSignal, ShareScope, stock charts allow you to store pages, strategies, create filters, signals, offer a lot more functionality than those free sites. And as you get more experience, you'll see that this saves you a lot of time, especially if you've got a other job or got other hobbies, interests. You don't want to be spending hours and hours inside the charts. You want a nice, simple, systematic type process set up. And tip there, if you want to play golf, don't you go and buy the equipment. It's a necessity. It's the same in trading and technical analysis. Think of it like a business cost, and if you're, especially if you're serious about your trading and technical analysis, then get the best charting package you can afford. But it comes with a caveat, be realistic. Don't spend thousands, say, on a Bloomberg terminal if you've got a trading account of $500. That doesn't make sense at all. So be realistic with your aspiration, what you want to achieve, and your financial standing at the time of going to trading. So what package am I using for this course? I'm using something called TradingView. And why am I using that? Well, I personally use it for my own trading, and it supplements my own in-house built systems around technical analysis and the trading software that I've personally built out. I use it in all my teachings and courses, and I actually found TradingView by accident. When I did my courses, I didn't recommend anyone in the past. I let you find them, but I went away and researched, and actually I thought TradingView, for the cost and what it gives you, tools, charts, alerts, strategies, flexibility. It can be used on all platforms, tablets, PCs. It is just simply a very good all-rounder for the monthly cost. And there's different versions. There's a free one that's out there that will get you started. That doesn't let you do the Japanese charts that we'll look at later, and at a minimum you probably need the Pro Plus version to do all the stuff that I do. I've got the premium one, but there's not much difference between the two. The Pro Plus would do very well for you. If you want to find out more about the different options there, if you want to use TradingView, then go to my website in the stockpunter.co.uk and the Trading Resources tab and find the Hour Charts section. But please do note that you can use any charting package that you like. You might already have one. It's just a recommendation for this course and what I will be using most of. I have used all these platforms for CQG, Bloomberg, eSignal. The stock charts are all very good. I prefer the TradingView, and like I said earlier in the section, that it comes down to personal preference and use. But before we do move on into the theory around technical analysis, I'm going to, in the next section, just give a brief overview of TradingView, some of the functionality, tools, workarounds that you can use, just to give you an idea, and for those that are wanting to use TradingView, just a bit more an insight. But if you've got another package and you don't want to go the TradingView route, you can skip that section and move on to the next part. Now in this lecture we're going to have a look at TradingView, and it's for those that are interested in using TradingView or just interested in finding out a bit more about them. If you're not going to use TradingView, you can skip this section lecture and go on to the next one. Now if you follow my link from my website in the charting section about TradingView, or you may just stumble across this yourself if you go into TradingView, you're going to come across a page that lets you know the different types of plans available and the cost, and you can do that monthly, annually. It's not what we're going into here, but once you sign up, you then get to create your own profile. Now here's my profile, and what this does, it allows you to join in the community within TradingView. So as you can see, there's a community button where you can follow people, get ideas from people. Really is a good function. You can chat to them as well. There's a chat room as well, and there's different screeners, the markets available, brokers that you can link into, and the charts. And as you can see, you can post your own ideas. in here. You can follow me here if you want to, and like I say, it allows you to communicate with fellow technical analysts, and under here you can store your ideas, scripts, followers, people following you, and settings. So the purpose of this lecture is to give you a brief walk around the platform, just to get you started really. So the first thing you're going to do is create a chart. So we can go up to our button up here and we can create a new chart, or if we've stored any we can go to load chart layout. So all we have to do is click the new chart layout, and all we can see there is it comes up with a basic candlestick chart. Up the top here we've got the ticker, the symbol that you're looking at, the time frame that we're looking at, the type of chart. You can add indicators here, financial information, and create templates there. Down the left hand side we have drawing tools which you can put on top of the charts, and down the right hand side we've got some very useful tools that we'll look at in a moment. But say for example I want to look at Amazon stock in the daily time frame. I click up in that left hand box, I type in the search box Amazon, and it will drop down all the instruments that have that in its name. You can also refine it further by different sectors, but we want the stock. It's on the Nasdaq stock exchange. We click on there and now we have Amazon stock. It's in the 1 hour time frame. We didn't want that, we wanted a daily time frame. So again we click on there, we scroll down within the box, we click on the day button, and there we now have, you know, a year's worth of data for Amazon. If you want to see back further we can use the scrolling functions to move the page around. We could even go back further, we could look at monthly data. You could see almost the lifetime of Amazon and how it's progressed, and how it's progressed very nicely. Sort of stalling at the moment, maybe going to break out upwards, but we're going to look at ways of analysing that sort of data in this course. So I might want to add indicators on top of this in the tools, and we're going to cover these off in the course. Now we click on the indicators button and you can save your favourites, or say for example you might have heard of the MACD. If you type that in, it comes in there, you click on that and it adds to the bottom. So if I want to change the settings of that, I would click on the instrument, right click, settings, and then I can change the variables as well. Now if I want to draw on the chart, I use these tools down the left hand side. If I click on that one, it brings up things like trend line, so we could draw a trend line under the chart like that. We can use Fibonacci, which again we'll look at within this course, to give us levels. And it is, once you've played around with it, it is very self-explanatory, and you'll pick up, you know, how to use it as you go on. But all down here we've got so many tools to use. You can even set risk management positions. You want to go long here, you can set your risk and reward and create a target. Say you might want to get out at that Fibonacci line there. You can see the risk reward is 1.26 to 1 if you wanted your stop down there. So there's lots to use there. But what if you wanted to create a list of stocks to look at and you didn't want to keep searching for them over and over again? We can create our own watch lists. So up on the right hand side we've got this section here called Watchlist Details. We click on that, you can see one I've already created, but if you want to do a new one, you just click on the down button, create a new list, call it maybe stocks, you save, and then if we want to add our Amazon stock in there, we click on the plus button, we hit Amazon, and notice how it goes into the bar over here. We now want to add, I don't know, Apple. We look at Apple, we found Apple, we add it, there it goes. Now if I click on there now, that changes everything to Apple in the same time frames and settings we had for Amazon. Now if we want to save this page, we've worked hard on creating indicators and tools. See where it says at the top here unnamed? We can do here, we can save, we can rename, we can make a copy so we're not so we can duplicate ourselves and make maybe small tweaks on further types. You can create a new chart as we've already seen, and you can load existing ones. Now if I hit there, you can actually see I've got an awful lot I've created over many years of using TradingView. Another great functionality of TradingView is it allows you to set alerts. So using our MACD example here, what if we wanted the TradingView system to tell us when the blue line crossed the orange line? Well, it can do that. We click on there, we right click and we hit add alert, and you can say when the MACD line crosses MACD signal line, let me know every time it happens. And then if we hit create, that creates us an alert, and every time that occurrence happens it will either email us, pop up on the screen, make a loud noise. You can change the settings as you want. It's got other variables that you can tweak for the rules there. So you can actually, depending on what package you have, if you have the top package you can have up to 400 alerts, and it's quite a useful tool to have. And the alerts, you can see the alerts you created up there on the right under the watch list button. Click there, these are some that I've created in the past, and like I said, a very useful tool to have. Now I just want to cover off data, and one of the plus points of TradingView is there is a lot of free live good quality data coming into the system, so you're not having to pay as much as say you would if you were using CQG or eSignal or Bloomberg, because what happens here is a lot of the brokers feed their prices into the platform, which gives all those markets prices for free. But there's also a lot of exchanges that put their prices in here as well. Some can be delayed for 5, 10, 15 minutes, some you have to pay for. So again, if we look to find something, we click up there in the left hand top, we can see the drop down here. You can see Apple, for example. You can see the different sources of where it came from, or different exchanges that it's on. And so you want to go to cryptos, and then we type Bitcoin, and then give us all these options under cryptos. And again, you can refine it further by indexes, CFDs, forex, futures, stocks, or just as I do to start with, leave it on the all setting to refine in further. Now when you get these symbols into your platform, I'll bring up a watch list that I've created in the past. It's a commodities one. Now if there are a delay, you're going to see a little D in top, and if you hover over it, it'll tell you how long it's delayed for. So that top one there is crude oil, and it's delayed by 10 minutes, but that's still pretty good to say if you're in a longer term trading strategy and that 10-minute delay doesn't really matter to you too much. Where there's not a delay, you won't see any little symbol. So covering off some of the functionality down the right, you've got news feeds coming in for whatever you're looking at, data from the information there and the actual hard numbers. We've got different exchange information. We've got calculated the economic calendar, events coming up. We've got ideas you can post in there. Then we've got public chats, private chats, ideas stream, notifications you get in. There is a lot here, and you can actually link into brokers as well if your broker uses the TradingView platform. So pretty much for starters, I hope you can see that it is a pretty handy technical analysis platform to use, and that will get you warmed up on TradingView. and I suggest that you dig in, you play around for a few hours, mess about, create strategies, use tools, create new views, and just get familiar with the tool, especially before you go live trading. It's always good to get some hands-on practical experience here, but for what you pay per month and what it offers you, it really is a great tool. In this lecture, we're going to have a look into the background of technical analysis, get a bit of history, get a feeling for what it's all about, and some basic stuff that you need to know. Generally though, over the last decade, there's been a big increase in interest in technical analysis, and that's because it can be systematized by programmers and the hedge funds of this world. It's become more available due to technological advances, which means for you and I and the retail trading world, we can now get our hands on technology that we would never have been able to just over a decade ago. And also it's very much in the social media these days, and it's a key tool for giving you some sort of control around your trading and investing. So what we do know is then that there's a big peak in interest in technical analysis for many reasons. But what I do know from my own experience, that's 25 years or so, is that it is actually a vast subject. It looks very easy on an Instagram post or a Twitter tweet, but actually there's a lot more to it, and you need to know the background, the detail, before you can master and move on within this vast subject to areas that you can take advantage of. There are so many tools and indicators, charts, theories, ideas out there. It's very easy to get lost in this subject, and the point of this course really is to give you that guidance, the steering, the background that you're going to need to succeed in the area of technical analysis and this type of trading. Like with anything, technical analysis has its skeptics. Some say it doesn't work, it's just great for hindsight trading, looking back at charts, it's easy to predict, it's the work of some dark magic, and they're all justifiable criticisms in some sort of way, and they're ones that I have to fend off daily. Now everyone's allowed their own opinion, and like I've said before, with my experience, I've worked across all sorts of markets, banks, hedge funds, trading floors, and there's been great fundamental traders, quant traders, and technical traders. There is no one right type of trader, and it's often down to horses for courses, and they've been very successful in their own right. Some are even a blend, but it's each to their own, and I've seen it work. And if you want technical analysis to work for you, you've got to develop your own trading persona, your own interests within technical analysis, become an expert in those, find out what works for you. But it's very naive and ignorant to dismiss technical analysis without first exploring it. That's probably why you're here. But like I said, it works for me. It works for others in different ways, and this is what we're here to learn. So why bother with technical analysis at all? Now, you've already seen these 5 points in section 1, but I'm going to keep banging on about them throughout the course because it's very important to cement these 5 key takeaways. And the first one is it's going to make and save you money. It's going to improve your psychology in trading and investing, which I can tell you is one of the hardest things to master. Whether you're an automated algorithmic trader all the way through to a very discretionary trader. Very hard, and technical analysis can give you that edge there. And in turn it creates discipline around your trading. Technical analysis compared to, say, a fundamental trader who has to go and analyze company reports, do a lot of digging. Technical analysis cuts out all that, so it saves you a lot of time. And finally, the fifth point there, it does give you an edge in your trading and investing if used correctly. So 5 good reasons why you should use technical analysis, and remember them, and build that into your trading and your trading plan. So then let's get into some theory. So firstly, what is technical analysis? It's a very easy, straightforward concept, but its definition is it's the analysis of market activity, whether that's price, volume, open interest, predominantly through the use of charts, with the goal of forecasting future price trends. And you'll see many of the tools used in technical analysis can also be found in other areas, such as behavioral science or quantitative analysis. Technical analysis is very flexible, adaptable, multi-time frame dimensional, and also non-time frame dimensional, as we'll find out. Approach to your trading and investing. Now this is massive. This is probably the most important slide in any technical analysis presentation. It's what the subject is built on. It's built on 3 pillars, and you've got to understand these, and if you can embrace them, then you're going a long way to understanding technical analysis. The first is market action discounts everything. What does that mean? Well, the price is a price for whatever reason it is there. Prices move in trends, and history does repeat itself. They're the 3 pillars you must understand and believe in, and again, I can tell you those 3 pillars of technical analysis do work. We did briefly touch on this already, that technical analysis is very different to fundamental analysis. That's one of the other key styles of trading. And fundamental analysis, FA there, is all about value. Is something fair, under or over value, and those trading decisions are based around that analysis, and that analysis is very time consuming. It could be around earnings if you're trading stocks, interest rates if you're trading forex, or if you're trading copper, how much copper is stored in a warehouse somewhere or coming out of a mine. And like I said, the downside to fundamental analysis is that it takes a lot of time to put together, and it's also very hard to do risk and trade management around the trades you have, because you're sort of going blind into trading there. It's just a number, and that's where technical analysis can come in and help, and it can also aid if you are a fundamental trader, that as well. If you're a pure mathematician, you probably don't like technical analysis very much, and my background actually is very quantitative, and I'm convinced that technical analysis works. The problem is the mathematician believes in the efficient market hypothesis and random walk theory, which basically says those pillars that we looked at shouldn't really work. But the mathematical approach does work in trading. So does the technical analyst one. So does the fundamental, for that matter. The end game, what we're looking for is that you want to make money, profits, return. So it doesn't matter how you get there, as long as your methodology works. And here we're exploring technical analysis, and a lot of the success just comes down to your personal psychological makeup, and also to what approach you adopt. Some people are suited to fundamental trading, some like the technical analysis. Technical analysis is my world, and that's what suits me, along with quantitative and sort of maybe more systematic algorithmic approach as well. It's up to you. You'll gain this through experience and trying all these different types of approach. So let's look into the origins of technical analysis, and really it's an art that's been going, or science going back thousands of years. But if you wanted to pin it to 2 places, I'd say you've got over in the Far East Japan, and you've also got the West, and I'd include maybe that sort of Europe and North America. So really those two areas independently develop their own methodologies to the subject. Now, the Japanese approach looks in a lot of places very different to the Western approach, and it's one that I use quite successfully in my trading. I love all this Japanese style of technical analysis, and it goes back hundreds and hundreds of years. And a guy called Homer Munehisa, he is sort of well known for the concept of candlestick charting, which really is just storytelling process to give the people around him, or the users of this approach, an idea of what was going on in any particular market. And in those days it was trading rice as a commodity, so the candlesticks told the buyers and sellers, what was happening with the price. And apart from the candlesticks, there's a lot of other concepts like Renko, Kagi, Ichimoku, which is more recent. And if you look at them on a chart, they do look a bit alien, but if you understand them, they can be highly effective in your trading. Really, it's only the last 20-25 years that over in the West we've been able to access this type of charting in a lot more detail, and that's again because of the technological revolution, the software that you can now get your hands on that allow you to do this stuff. And when I first started, you had to draw these sort of things by hand, and that sort of killed off a lot of the ideas and made it very difficult to perform technical analysis. And if we were to sum up what the main differences were to the Western approach, well, the Japanese charts are much more pictorial in my opinion, and they deal with time in a very different manner. In some instances they don't deal with time at all, they just deal with price movement, and that's not what we're used to in the West. There is similarities in that approach with something called point and figure charts, but normally we deal with time and price on the same chart. And like I said, maybe Japanese charts are a bit more colourful, and we're going to look at that towards the Japanese style more towards the end of this course. And just to give you a flavour of what to expect, this is a Renko chart, and it's basically made up of blocks, and it's very different to what you see or maybe have seen in the past. But for me, that quite clearly disseminates what's going up, what's going down in terms of the price. So like I said, we're going to look into that sort of chart type in more detail later on. So flipping over to the West now. The West was developing its own style of charts in parallel and over similar time frames as what was happening over in Japan. So in Netherlands, Joseph de la Vega was writing about technical analysis and markets, and most marketplaces in Europe, as their economies were developing, were tracking prices in certain styles of charting. And you have to then go over to the US, where really it sort of got established as their markets, especially around commodities, places like Chicago and New York. The exchanges there created such chart types as point and figure in the late 19th and 20th centuries, and that's really where the technical analysis that we're more familiar with really took off. Now, the godfather of the Western approach to technical analysis is said to be Charles Dow, and you might have recognised that surname Dow because he's the guy that set up the Dow Jones Industrial Average Index stock market in the US. It was his analysis of stocks that led to the creation of that, and through his methods of measuring the strength of the US economy and indexing, he inspired a generation of very famous technical analysts, from Elliott to Gann to Wyckoff, who all developed technical analysis theory in the early part of the 20th century. And Dow introduced many theories through his works. Trends moving in different phases, volume, confirmation, reversal, signals, and much more besides. So to end this section, a little quiz for you, and you can go through these questions and then go back through the video to find the answers. It's all a bit like a revision process, to cement that knowledge there before we move on to the next section. So I'll briefly go through the questions. What are the 3 pillars of technical analysis built on? Question 1. Question 2, give 3 of the 5 reasons why you should use technical analysis. Question 3, who is recognized as the founder of Japanese technical analysis and what chart type is he famous for? Number 4, what are the main differences to the Japanese to the Western approach of technical analysis? Question 5, who is the godfather of Western technical analysis? Question 6, name 3 analysts he inspired. Finally, number 7, what theories did the godfather of Western technical analysis introduce? So go through the questions, pause the video during this section so you can give them a go, and then go back, like I say, through the video to find the answers. Before we really get into the meat of things around technical analysis, I wanted to present to you 20 rules that I think you need to know and are very useful to understand right at the beginning of the course. You're going to probably wonder why you're learning them now, but as you go through the course they sort of drop into place. So it's giving you a good starting point and giving you some sort of flavour to the sort of things that go on within technical analysis. This is by no means an exhaustive list. There's plenty more rules where they came from, and you're going to find that out, and you're going to need to learn those as well. But it's a good foundation to build on, and like I say, don't worry if you don't understand them now. You will do by the end of the course. Stick with it and you'll see why I'm putting them here now. So moving on to the first set of rules, remember what I said about the 3 pillars of technical analysis? Well, these are going to be built into your first 3 generic rules. Remember 1, the price is the price. Market forces, supply and demand, have got it to this point, and it's built in real time, and that's what makes technical analysis really good. It's always adjusting for those variables. So as 100% pure technical analysis, if that's the route you are going to take, then you have to embrace that theory. Rule number 2 off the back of 1 is that history to a certain extent does repeat itself, and I can tell you from my experience it certainly does, and technical analysis highlights these patterns over and over again, and it shows you patterns that continue or reverse, trends that happen time and time again, and in some markets it's more obvious than others, and technical analysis gives you those tools to help measure and forecast this activity. So a quick example thrown into mix there. This is a chart of US gasoline. It's a weekly chart, so each bar is a week's worth of data, and it's in a form called Heikin-Ashi, which smooths out the trends to make them look more visible, and the red lines are points in the year that you can see where the price takes off. It's the beginning of the year, and that pattern repeats itself over and over again. Now this is a fundamental reason for that, and that's the driving season and the purchase of gasoline as supplies and stocks, and we can see that playing out much more easily using technical analysis. And our third generic rule is to determine the trend and trade with it. Now there's something in Spain called the Pamplona bull run. It's where they open these gates and everyone runs away from the bulls unless you're really stupid, because if you don't, you're going to get run over by a herd and it's really going to hurt. And it's sort of like that with trading. You've got to go with the flow, go where the money's pushing you, and you've got to have your strategy around that. And this is what technical analysis is very good at, spotting the trend and how to trade it. Another example, using the S&P 500, a US stock market's daily chart, and just look how we can easily define the trend. Again, going back to that Pamplona bull run theory, why would you want to go short or sell against that market? You'd only want to be buying it, that trend looking very strong. So that's like our macro rules covered. So let's dig in and look at the micro, the more specific rules, and see what they have for us. Rule number 4, setting up your charts. Time is normally represented on the x-axis and price on the y-axis. Now, I mentioned it before that some Japanese charts like Kagi, Renko, or even point and figure over here in the West don't have time. They disregard it and only have price movement. And we'll look how that works on the charts later. And price on the standard XY chart can be presented either linearly, which is probably the most popular approach, or logarithmically, which is good for longer term, let's call it investing. And rule number 5, use chart types that suit you. There's so many different types: line, point and figure, candlestick, market profile, Kagi, the list goes on. Explore them, discover them, find out which works best for you, because you'll find that it makes your trading a lot easier. The example there I use is myself. I like using the Japanese style charts like Renko, Kagi, Heikin Ashi, because to me it simplifies things and makes my decision making and discipline in trading a lot more easy to produce. Rule number 6, price, I believe, should not be used as a standalone measure. Use other independent confirmation tools to make your initial assumption around what the price is going to do more absolute. So for example, use volume, open interest, sentiment tools, and this is also backed up by Dow theory, who supported that idea. Rule number 7, from my experience, the more liquid the asset you're trading, the better technical analysis works. So that means those assets, markets that are traded with high volume, like FTSE 100, the S&P 500, big stocks like Amazon or Apple, or foreign exchange currency markets, they're going to work much better than, say, a small stock on an unknown exchange that can be manipulated a lot more by directors or other outside effects, or if you're comparing commodities, WTI crude oil, probably the most popular, highly traded commodity there is. Put that against lean hogs, and which is a fraction of the size of the market. Trading that purely technically can be very dangerous. So that's where rule 6 also comes back into play. Use other supporting measures to back up your technical analysis. Rule number 8, trend line measurement and drawing, and we're going to look into trend lines in a lot more detail later, but for now all you need to know is that the trend is the general direction of a market or the price of an asset, and there are trends within trends, and these are classified as short, medium, longer term. They have more technical names again, which we'll look at in the near future. And the rule on the measurement of trends is if the price touches the trend line twice, then this is a tentative trend. 3 times, it's a signal of a much stronger, more confirmed trend. The ultimate trend line is obviously 45 degrees, and trend lines should be drawn under the price action for an uptrend and above the price action for a downtrend. Here's a quick example using Amazon, the US stock. Notice the uptrend line below the price, and those shorter downtrend lines going against the longer term trend drawn above the price. So that's key when you're doing your drawing on your charts. Remember that the uptrend below, the downtrend above. Rule 9, trend target measurement, is a loose rule in my opinion that you could apply. It's known as the measured rule, and basically it's the length of the previous trend used as a guide to where it could go to when placed, on top of the correction price. And rule number 10, the higher time frame chart carries more weight to your decision making. Always start your analysis from the higher time frame and hone in to the time frame which you trade. And as a guide, take the next two higher time frames. For example, if you're trading the 15-minute charts, maybe use the 60-minute and the 240-minute. And once you've done that analysis, stick to the 15-minute chart window in which to trade in. Don't start playing around in the 60 or 240-minute. And to help you out with that concept, I've put together this table for you. Now the blue box is the time frame that you might want to trade in. So if we go down from there, we've got the 5-minute trading window. So then your charts, you select 5 minutes, that's where your strategy plays out in terms of entry, exit, the trade management. But to draw conclusions of where the trend is moving from, we look at the next two higher time frames, in this instance the 30 and the 240-minute, and that's what you do to give you the confirmation that your 5-minute windows, the right place to be trading either long or short the market. So if we go further down, let's take another example, weekly. You might, if you're trading a weekly chart, then you might want to look at monthly and yearly as your sort of confirmatory windows of where the trend's going. And once we get into that space, I'd say that's more investing rather than trading. But that table you can use as a guide. So if you go to even the shorter time frame, you might go down to 1 minute right there at the top. Then you could use the 5-minute and 30-minute as your trend confirmatory analysis. Rule number 11, improve candlestick or bar chart analysis by teaming up with oscillators or indicators. Now these indicators can be applied on top of that price action or below it. We're going to look at that in a lot more detail, but what these do is create a fabulous confirmatory tool to your raw price analysis. And I always trade with additional indicators and tools on top of that action. Number 12, rule 12, always determine where support and resistance levels are. You can use things like Fibonacci, Ichimoku, pivots, moving averages, trend lines. These levels are crucial for understanding the price behavior of the asset you're trading, and also very crucial when you come to set your stops or want to take profits in your trade. Struggling with the timing of getting into the trade, when's the best time to get into a trade so you're not wasting a lot of time and money? Then rule number 13, use indicators for timing. Are you getting in too late, too early? Then indicators such as MACD, stochastics, RSI can help improve your trading and give you that edge. And rule number 14, beware the round number. It's psychological. Market behavior is very predictable at times, and people trade around round numbers. They're lazy, and that creates people like stop hunters, smart money, smart traders who will pick you off. So be wary of trading round numbers, and your charts again will show you these quite clearly. Rule 15, now this is one of the most important rules in technical analysis, especially when you're putting together indicators. And basically what it's meaning is don't put together indicators all based off the same input. For example, the MACD and the RSI are both based on the closing price. So the signals they're going to give you are essentially based off the same information and are essentially the same. So you're wasting your time. So you want to put something there that's based off something different. So for example, stochastics and RSI is a better combination because this stochastics is more a volatility based indicator, or you might want to add volume in or some other independent variable to confirm. But really it's a cardinal sin to put indicators together that are based off the same info. Rule 16, divergence is a great application for spotting markets when they go out of sync. What do I mean by this? Well, it's probably easier if I showed you an example. So on the left we've got a bullish divergence, and as we can see, the top line there, the arrow is coming down, that's the price, and our indicator sitting below the price is moving upwards. Now when they converge to that point, it's more likely that the price is going to go upwards, and vice versa. As the price moves up and the indicator goes down there on the right hand side, that is a bearish divergence, and we would expect the price to go down. Now doing this in practice is quite tricky. We will look at some examples in real sort of charts, but you need to know the idea behind divergence. Rule 17, measure volatility through the average true range, the ATR. Now this is especially important for risk management and setting stops. You can use the ATR to find you the stop area, the area where you get out your trade, using the charts, using the ATR indicator. So we're factoring in volatility to the calculation, so it's then made more relevant to the instrument that you're trading. Rule 18, use technical analysis for money and risk management. It's often overlooked, this whole idea, but it's very useful for setting stop levels, target setting, entry, exit, risk return numbers, all that are going to aid your trading and investing. You can use those numbers for performance analysis, and it also adds in a lot more discipline and takes out a huge chunk of the psychological game that can damage your trading. Rule 19, measure behavioral analysis using technical analysis. Now behavioral analysis can create many strategies for us, and it's often hard to put a number around behavior, but technical analysis can give us an illustration of what is going on, and if we can then measure it through technical analysis, then we can gain an edge. Finally, rule 20, are you too jumpy getting in and out of trades? Then use a chart type like Heiken Ashi. It takes away some of the psychology again, which can lead you into danger. Like I already said, this section was all about giving you an idea of what goes on in the world of technical analysis, and actually learning these rules and the other rules that you'll come across will make you far more effective as an analyst, and allow you to create your own strategies and give you that edge. Like I said, this was an exhaustive list. There's countless other rules, both hard and soft, and I suppose the big takeaway here is that technical analysis is objective and subjective at the same time, which makes it maybe one of the reasons why people criticize it so much. You give a rule, but actually then there's a subjective interpretation to it. So bear this in mind with all rules in technical analysis. It is a science and an art as well. We've now had a look at some of the rules of technical analysis. Now let's have a look at the big questions that are often doing the rounds, and probably that you've asked and many other people have asked, and hopefully in this section we can get to some answers. Now I've been doing this for a very long time, and over that time I sort of got quizzed on around technical analysis along the same sort of lines, whether that's psychology, winning, losing, strategy, trade, risk management, and the more fundamentals of technical analysis. But there has been a thread through it, and I do get asked very specific questions, and that's what this section is about. There's a bit of an overlap to the 20 rules, and you'll see how they can interact. And as we know, technical analysis has its critics, so I'm constantly answering these sort of questions. And again, like the previous section on the rules, don't worry if you don't understand this now. As you go through the course, it'll all start to make sense. I found that the questions that I get fall into two different pockets. One's theoretical and the other is practical, and again this isn't an exhaustive list, and there's probably other questions that you might have thought of and wanted to ask, but hopefully I've got a good selection here for you to get your teeth into. So the theoretical questions is really where the controversy happens, and one of the most common questions that I get is the first one here: does technical analysis really work? And the answer quite simply is yes, it does. If it didn't, then professional traders and investors and analysts wouldn't use it, so it obviously has some value, and I can say from my own experience and the returns I've made, it certainly does. Is technical analysis just a hindsight I told you so tool? Now I get this question and I can see why it's asked, because it's very easy to look back, in hindsight and say whether it's the right time to buy or sell. The truth of the matter comes in when you actually try and trade it and actually use it in the real world. Then you're down to results and making money, and that's how you get measured by. So yes, it could be classed as a hindsight tool, but it is also a very good forecasting tool. Next question: can I make money using technical analysis? Because whatever I try fails. Yes, you can. I've made a living from it, so have many others, but it is a skill, an art, a craft which you have to learn like anything else. If you want to be very good at golf, you spend the time learning. If you want to be a surgeon, you learn how to do that. It's the same with technical analysis and trading. You've got to give it the time. There is no golden ticket. It's about putting in the effort and energy there to get the reward. Technical analysis is such a vast subject. What areas should I specialise in to get the best results? Well, there is unfortunately no right answer to this question. It depends on who you are, your trading style, objectives, but as you are now doing, you're putting yourself in the right place by learning the fundamentals, and then you explore and branch out from there. I had to do that. I learned all aspects of technical analysis, and then I realised that Japanese charting was for me, and it took me many years to get there. Like I say, there's no right answer. It's about experience and exploration. What works best? Fundamental technical analysis. There's no right answer to that either. I've worked with millionaire, billionaire fundamental traders as well as technical traders, blends. There is experts in both camps. A blend can occur as well, and really it just comes down to results, and either camp can be as successful. Does technical analysis just have to be based on price? No, it can be applied to almost anything that you can create a time series of data from. It could be volume, volatility, sentiment, and behavior, pretty much anything, and you can apply the same indicators and rules to those data sets. And that is on can I automate technical analysis? Yes, it is very easy and lends itself very nicely to automation, and this is where the algorithmic traders, systematic traders come in. It's one of the biggest growth areas in algorithmic trading, and with enhanced technologies and programming, data mining capabilities, it's an invaluable tool for the 21st century trader. So now on to the practical questions. So these are the day-to-day questions that I would be asked, or you might come across or want to ask, and they're affecting often the bottom line of your trading. They're adding frustration, or they're a sticking point to applying and using technical analysis. So our first question is: I use indicators like stochastics to trade and measure whether a market is overbought or oversold. If I follow the rules, I always end up losing. The market never reverses at these points like the rules suggest, and the trend simply continues. Am I doing something wrong? No, you're not at all doing anything wrong. Remember, I said that technical analysis can be subjective as well as objective at the same time, and it's the same here. And I found that some of these rules aren't as effective as others, or need experience and foresight to be able to use them, and the stochastics one is a good example. When it does become overbought, oversold, sometimes it stays there for much longer than the tool would suggest. So always bear that in mind. There is subjectivity to these rule sets as well. And here's a brief example just showing the stochastic indicator below the price, and this one's Diageo plc, a UK company, and there's turning points at the top and the bottom with around the yellow bubbles there, which are normally the rules. When it falls back through or up, you either buy or sell, but sometimes they can stay longer or shorter below those periods of overbought and oversoldness. Now this is another question I get asked a lot. How does Fibonacci work? This concept sounds more science fiction than fact. Well, it does work, and it's used professionally. It sort of became a self-fulfilling trading tool, because the more popular it got, the more people used the rule set below. And it is a really easy rule set, and all you need to do is find discretionary highs and lows, but obviously they can be sometimes very obvious, and picking them is the skill. But if everyone's doing it, then these numbers, like I say, become self-fulfilling and very usable in creating stop loss strategies, targets, risk management, and psychological levels where the market is playing at. So it is a very useful tool. So let's have a quick look at an example. Now this is a chart again of the S&P 500 overlaid with Fibonacci, and the lines are really only percentages between a high and a low, and there's some significant ones that you need to know about, and we're going to review and go over Fibonacci later in the course. But you can see that they create these levels where you can use as objectives, either for risk management purposes, to get out the trade, set stops, or to set targets and see really the psychological levels of where the price is. And often these Fibonacci lines highlight these perfectly, where you can see on their key support and resistance lines. I didn't draw those lines on to match the price chart there. That's what happens, and Fibonacci is a very useful tool. What time frame should I use to analyze and trade in? Well, we looked at that in the rules. Setting your trading time frame window and then 2 higher trend windows. But it really depends, is the answer, on your own trading objectives, how often you want to trade, the markets you're trading. If you want to trade intraday FX at fast pace, you're really narrowing it down into seconds and minutes rather than hours and days. So it really depends on your strategy and what you're trying to achieve. Do patterns really work, or are they just made up to make charts look interesting? Well, you can answer this one by taking a step back and trying to translate what's actually going on in the chart. It's all down to psychology of the price action, and if you actually do this analysis, you can very quickly see that these patterns are psychological formations of the price, and the use of these patterns, whether they be triangles, flags, pennants, just make it a lot clearer to the user. So they might have funny names, but actually they do serve a very good purpose. And here's an example using WTI crude oil. This must be noted as a subjective process rather than objective, because it's in the eye of the user of the chart. But I've just drawn on my lines, and if you put 100 analysts into a room, they'd all probably come up with different trends and patterns within the same chart. So it's very subjective, and it's not a science, the drawing of the patterns, but they're very useful when you complement them with other indicators and tools within technical analysis. What are the most common type of indicators used? From my experience, it's things like pivots, RSI, Fibonacci, stochastics, moving averages, and MACD. The suite of indicators and tools available is massive, but they are some of the most popular at the moment. And leading on to the next question, the most powerful candlestick patterns? It's not a very straightforward answer, as there are many patterns that have individual merits. I use only a small portion of the candlestick patterns out there. I particularly like dojis and evening and morning stars. Again, have strange names, but they are there and do tell a story and are there for a reason. Let's have a quick look at my favourites. Again, the main purpose of the candlestick patterns is to tell a picture, a psychological behavioural picture to the user of what is going on. Now, I like the dojis because they're there to highlight indecision points in the market, often turning points. They're the ones in the top left, and there's 4 various types there. And then the evening and morning star patterns on the right are great for reversal points, and again, they don't have to play out exactly like I've drawn them there. Again, it's a subjective process, but they will look pretty much like that when you get to see them on the charts. How do I know if a trend is reversing? When's a trend not a trend? Well, there are some official technical analysis rules here, and we've already mentioned them in the previous section on the 20 rules to know. 2 touches means it's a weak trend. 3 touches mean it's a much more confirmed definitive trend, and 3 or more, it makes it even stronger. And we also saw how we could apply the trend lines, but you can also use other tools like moving averages and indicators to answer that question. What types of chart work best? There is no answer to that one either. All have their own advantages and disadvantages, and you've got to find them out for yourself through trial and error and experience. I heard that technical analysis can be used for trade and risk management and help me stay in the game, and the answer is very simple. Yes, it can. It's often overlooked part of technical analysis, the use of it for trade and risk management purposes, but by putting together tools and indicators, you can create stop loss points, trailing stop strategies, risk reward levels, aid your entry, exit, and improve your timing, and all of this will keep the shirt on your back and the money in your pocket. So normally technical analysis is just often seen as an entry tool, but it is far more than that. So there you have it. They're just a few of the questions that I often encounter. Keep asking those questions because it's going to help you grow and advance and find out the solutions to new strategies and ideas. There isn't a holy grail of trading, and technical analysis isn't that, but if you learn it well and you dig in, then it's going to make you a much better trader and put the odds more on your side for success. So I hope that brief introduction to the background to technical analysis, some rules and the questions that I often get asked has whetted your appetite to dig further into the world of technical analysis. And now, with all that sort of theory and idea out the way, then we're now going to start digging into how to use and build the charts for trading. And we need to start with charting essentials, and in that we are going to cover stuff like line charts, bar charts, candlestick charts, some other common forms of chart types, and if you're a stock trader, you might want to learn about market breadth. The old saying goes, you can't run before you walk, and this is exactly the same with technical analysis. You're going to need to get a thorough understanding of the basics of technical analysis before you can branch out and develop into the areas that you want to. You just will miss so much stuff if you don't understand the basics, and by learning these, it's going to give you that edge when you come to develop, and specialize in other areas of technical analysis. So like I say, essential for you to understand the basics. Over the next 5 sections, we are going to cover line charts, bar charts, candlestick charts, and some other types of chart, and that is point and figure and equivolume. And we finish off for all you stock traders and investors out there with something called market breadth. So let's waste no more time and get stuck into looking at line charts. If you can visualize your chart like a map that you're using to navigate around, that is how I like to picture technical analysis. It's showing you a way, a direction in which to follow in whatever asset you're looking at, and the analyst has to pilot their way through this data, translate the story in their opinion, and come up with a forecast, a future route for where they think that price, whatever they're looking at, is going to take. And a chart can give you so much information, and there's more exotic sounding ones like Heikin-Ashi and Renko, 3-line Kagi, and we're going to look at those later, but first we're going to focus in on the line chart. But before we can even get into the line chart, we need to know the basic setup of the chart, and it's the same for line and bar charts and candlestick charts. It's split into the X and Y axes. X axis normally represents the time, that's the one running along the bottom, and the Y axis the price running up the side. And in regards to time, it can go down to as little as seconds, minutes if you want for price action, all the way up to monthly, yearly, depending on your trading style. And I like to call short term anything less than a day, which I call intraday, and anything longer, which is non-intraday, for example daily, weekly and monthly. Now the line chart, well, I would say it's what it says up the top of the slide there, great for newspapers and TV, but not much else. I'm being a bit harsh there. You can actually use it as a useful tool, but really it is very limited. That's the point I'm trying to get across here. It is the simplest and easiest to use. It's probably the least effective. And why? Because it doesn't really tell you anything too much other than the direction it's going in. And as technical analysts, we need to know much more. So it's a great tool to present to management or just get an overview of what's going on. And if you see and watch the news on the telly or read newspapers, it's the chart you're most likely to find presented there. And its simplicity is its downfall, because it takes away a lot of the additional stuff and work and tools that we can use in technical analysis to give us that extra insight into what is going on with the asset we are looking at. So here's a very simple example of a line chart. It's Vodafone PLC, a large UK company. There's a couple of years of data there, and that's based off the daily closing price. Now the price that uses is default closing price, but you can tweak it to move to highs, lows, depending on the charting package you're using, but the general default is the closing price of whatever time period you're looking. So if it's the daily chart you're looking at, it will pick up the last closing price and make that the data point for the line chart. So that's pretty much it for line charts. There's not much to it, and we could summarize the pros and cons. The pros, it's simple and easy to use. It does give a good impression of what's going on, and it takes out a lot of the noise. The cons, it loses a lot of detail, and the data lacks comprehensiveness that we need as technical analysts to build in indicators and tools to give us a better picture of what is going on. So let's take a look now within the charts how we'd set up a line chart, and let's have also a look at some different examples in different time frames and across different markets. The line chart really is straightforward, so we're going to look at how we can set it up in our charts, and this again is TradingView. Now I've created a new chart layout, and it's defaulted to Renko charts, which we'll look at later. We can change it to our line chart by going to the top left, hitting the different types of chart type, and you can see what they offer there, and we find line, we click on it, and it converts it to a line. Now this is set at the moment to the US dollar Japanese yen, and it's at a 15-minute chart window. So if we want to firstly format the line to make it a bit more visible, we can right click on it and bring up the settings, and we could make it thicker, we can change the color, and in here we can do what we like to the line chart. So now we've got our line chart, we can see the price data, and in the 15-minute window it only covers, you know, a couple of days, but we can change the time period. Say we want to look at it daily, how the yen has performed against the dollar over, you know, the last year. And we can see it's come down, and then it's been the US dollar very strong against the yen. And again, we can go further back if we just drag around, or we could change to a different time period. There we go, back monthly, so we've got back to 2007 data there, and we can see how the price has evolved. Now we want to look at other indicators. Once we've set it up there, let's for example find another currency, the pound against the dollar. We type in the top left and we get the symbol search box, we pick one, and we can then again see monthly. Let's make it really fast, 30 seconds. So really we're just talking, you know, an hour or so of data. You can see what's happened over the last in terms of line chart. And we want to look at, I don't know, a stock, US stock, Amazon. Again, same process. Type it in. We don't really want 30 seconds of that. So say we wanted to look at that in 2-hour window. So going back a couple of months, you can see how it's evolved. Now remember, the big takeaway here is it doesn't really help us much in our technical analysis. It's just based on the closing price here, and really we can't do much as technical analysts to this information. What do I mean by that? Adding on extra indicators and tools to give us further insight into what is happening with the price. So it's very restrictive, but it is very useful to presenting in management reports to your boss, or just getting a overall flavour of what's going on. And this is the sort of chart you're likely to see, you know, on the news or the TV or in basic reports, because like I say, it is quite transparent and it gives you a clear picture. So to round off this section on line charts, a bit of work for you to do. Go to your chart package, whatever one you are using, find various markets, for example the pound, oil, the S&P 500, Amazon, like we saw an example, and set those line charts up and see how you could possibly use them. But the big takeaway here is for you to think about the weaknesses that we discussed in this section of line charts and why these charts may limit your trading and analysis. So now we've covered off line charts, let's move on to bar charts. Bar charts take our analysis to the next level, and until more recent technological advances and the introduction of different chart types and charting approaches, I suppose bar charts were the bread and butter of Western technical analysis, and they were probably arguably the most widely used. And what is a bar chart? Well, it's just a snapshot of price and time for a given asset, but unlike the line chart, it adds a lot more detail. Now one bar represents one period of time, and that could be 1 minute, it could be 1 hour, it could be 1 day, it could be 1 month. And as you'll see, that bar adds on far more data than the line chart, which is focused on just one point, which ordinarily is the closing price. But here the bar chart encapsulates a lot more data. So here we can see our standard bar chart. It's constructed using 4 parts: the opening price, the high price, the low price, and the closing price. So like we say, unlike the line chart, we're building up a bigger picture of what's going on. What was happening in the trading day if you're looking at a daily bar, or what was happening in the hour if you're looking at a hourly bar. We can see what's been happening. Has it been volatile? Has it been flat? Is the price moving around? And then once we start to piece together a selection of bars, then we start to put together a story of what's happening with the price, and then we're able to create some sort of forecast. Now, there are some rules to the bar chart. We've got 4 here, and I've visualized them to the table on the right, and really it is more common sense. So don't worry about the I suppose layout of the rules there. But if it's an up day, basically high of a recent bar is greater than high of a previous bar, and B, low of the recent bar is greater than low of the previous bar, and we can see that there in the up day chart. It's vice versa for the down day, and an inside day is an interesting combination of 2 bars. It's the high of a recent bar less than the high of a previous bar, and the low of a recent bar greater than the low of the previous bar, and that can often signify a pause in market action, and there's no dominant force in the market, so the price could go either way. And then we've got an outside day, which is a high of a recent bar less than the high of a previous bar, and B, low of the recent bar greater than low of a previous bar, and this can often indicate a reversal in the change of price. You can see there on the right hand side the trend arrow coming up into those 2 bars and then reversing back down afterwards, so one to look out for. And 2 more rules here, and they're sort of like a type of outside day and are quite significant. We've got our upside key reversal day and our downside key reversal day, and the upside one is the day 2 bar closes greater than the day 1 high, and the downside reversal day is the day 2 closes less than the day 1 low, and they are important reversal points at often the end of a trend. But hopefully from just those rules, when comparing back to the line chart, we can now see that the bar chart gives a much clearer perspective on price activity. So one of the things you might have heard with bar charts, and it's actually the same in candlestick charts, is that you might hear an analyst or trader, or you see it on the television, that they say that the market has gapped. So what is a gap exactly? Well, it's a shock to the market. It could be by pre-market orders, a political event, a weather event, something like that, that impacts heavily the price. And these gaps are very easy to spot on the charts. There's normally 2 bars on a chart that will overlap, and if they don't, there's a gap in between them, then that is considered a gap. So it's an area where there's been no trading activity, and in an uptrend the open bar 2 is higher than bar 1, and vice versa. In a downtrend the high bar 2 is lower, less than low bar 1. Now there are 3 types of gaps you need to know about. There's the breakaway, and this is found at the completion of a price pattern and heavy volume and create support areas. Then we next have our runaway or measuring gap, and it happens often halfway in a trend, and you can use the first part from between the breakaway and the runaway to estimate the trend length from this. And then we have our exhaustion, and this happens near the end of the market move, and it's often the 3rd gap in a chain and can help identify top. So what does that actually look like? I've drawn out this crude example using the bar chart idea of gaps, and on the bottom left we can see the price has sort of consolidated, and there's a double bottom pattern there. We'll learn about the patterns soon. And then you'll notice that there's a gap between that and the at the end of that and the next bar. That's the breakaway gap. And then we have a run up in the trend, and then there's another gap called the runaway measuring gap. And then we've got a few more bars, and then we hit the exhaustion gap, and then often we see a stabilization, a consolidation in the price around the top, and then it falls back down, and then that reverse 3 gap process happens again. We have the breakaway gap, and then down goes the trend once more. But that top, that after that exhaustion gap, is often known as an island reversal pattern. And why? Because it stands out on its own like an island. So that's all you need to know about gaps, and I'm just going to show you a quick example of what it looks like in the real world. So here's our example. You might have heard of the company. It's Under Armour, the sports manufacturer brand, and it's a very good example of the breakaway, runaway gaps at work. And remember what I said earlier, that sometimes technical analysis becomes more of an art, less than a science. We've given you the rule set, and the breakaway, the gaps here, they aren't 100% as described in the textbook, so you have to use some of that subjectivity around it. But this is a good typical example, and as we can see, the price comes down, we have a breakaway gap, then we have a period of another trend measure into the measuring gap, and then consolidating at the bottom to maybe create that island pattern. So as analysts, maybe we're expecting a reversal in price. Under Armour's hit the bottom and is going to move back upwards. So another way of using the analysis to create a forecast. So bar chart pros and cons. The pros are that it contains a lot more data, and it's easier to pick out important extremes and events, and it's easier for traders to build in filters, and generally just gives you a lot more information. The downside is, this is why you're here, you've got to have some experience and knowledge how it works to get the best from it. Let's now look at setting up your bar chart in the charts and some examples. So here we have our previous example from the line chart of Amazon on the 2-hour setting, and it's the same process. We go up to our different chart types, we click on bar, and notice how that then converts it to a bar chart. So we want to change the setting just so we can make it a bit more clearer. Let's say, well, we got an up color, by the way, normally illustrates as green for up and red down. You can see them as just black and you interpret them that way, but technology these days, you can actually set them pretty much how you like. So we're going to take off thin bars, and let's make that a daily chart so we can see a bit more longer term price action. Let's zoom in a little bit so we can see the last few months of Amazon on a daily chart. Just see how we've got the open on the left, the close on the right, and the colors for the direction. And remember those rules that we saw, they're all interacting here to create a story. We've got volume on the bottom here, and often movement in price corresponds to increases in volatility, so as a volume. So that's a good one to watch in correlation with the price action on the bar chart. So again, we want to find a different instrument to trade. Let's look at the Australian dollar against the US dollar. Again, we search for it, we click it in, and there it is on the daily. And if you want to speed up your trading, we go down to the faster minutes. We've got a 15-minute chart, so we're seeing what's actions happened really in the last 24 hours on the Australian dollar, and it's looking like bullish but recently selling off. And again, it's experience getting used to the bar charts, the bars, what they're telling you, and they can be strengthened seriously when we add the indicators and tools on top of the price action. So some work for you to do now around the bar charts. Go to your charting package and just again play around with different markets. Maybe add the pound, the Australian dollar like we saw, oil, commodity, S&P 500 to help improve your searching if you're using TradingView as well. Find some stocks and just have a look at how the bar charts could be used. And also look at them in different time frames. If you want to be an intraday fast-paced trader, you're going to need to go down to the 5, 10, 15 minute charts, maybe even lower than that. See what that difference makes to the bar chart price action, and look specifically for some of those bar chart patterns that we've discussed, the outside days, gaps, and you're going to probably more likely see gaps in equities, stock markets. You're rarely going to see it in Forex because it's a 24-hour market and it doesn't gap as much, but if you do see a gap, it can be quite significant. Commodities as well, but look in stocks for gaps. And the takeaway is, like in the line charts, think about the weaknesses we discussed in this section on bar charts and why they might limit your trading. So we've done with bar charts for the moment, so let's now move on to candlestick charts. Now we're going up another notch again, and we're now looking at candlestick charts. And I mentioned right in the beginning of section 1 that the candlestick chart is accredited to Homer, but some will argue that, and actually they point you to the Meiji period in Japan in the late 1800s, where it is more probable that these candlestick charts arose. And during this period, these traders discovered there was a relationship between price and emotions, and that of supply and demand. And in particular, they were looking at rice, which was a major commodity in those days, and adding in the emotions to the equation added a whole new dimension to the analysis of the rice market. So raw supply and demand factors weren't the only driving forces behind the price, which is what they drew the conclusions around, and that human interaction also had a big influence on how the rice market and the price of the rice market behaved. And candlestick charting methods were very distant until, I would say, the late 20th century, when technology and globalization occurred and allowed the ordinary guy to access this sort of chart style. But it is now globally popular. It's one of my favorites, and we're going to look into it a lot more now. So what is a candlestick chart? Well, in my opinion, it's just a better looking bar chart. It still involves the same 4 inputs, and it still looks over the same time periods, whether that be 1 minute, 1 hour, 1 day, or 1 week. So instead of calling them bars like we did in the bar chart, we call them candlesticks. And like I said, they still give us that same open, close, high, low information, but in my opinion they are much more colourful and easier to understand and interpret what is going on. So the goals of the candlestick chart are really twofold. They're to display the price data in a more visual format, a more, so I suppose, storytelling format, and by putting combinations of candlesticks together you can confirm price trends and determine continuations or reversals in the price. So let's, before we move on, compare the bar chart to the candlestick chart, those individual components, to see what the main differences are and the terminologies between the two. So at the top of the slide we see the bar chart versus the candlestick chart, and we can see on the left the bar chart, the open, high, low, close data, and on the right the candlestick chart. The bit in the middle is known as the real body, and that really joins up the open and close prices. So it creates, like I said, a body, and then the 2 points, to one at the top, one at the bottom, which then join into the high and the low, are known as the upper shadow and the lower shadow, or wicks. So that's really the only difference. And in terms of colouring, it normally defaults as white and black on the charts, but I use green and red similar to the bar chart look, but you can create any other colour combination that you so desire. But a bullish day, the close is higher than the open, and a down day is the close is lower than the open, and that's it. And as I hope you can start to see, a much more visual way of looking at the price analysis on the charts than the bar chart. So here's just a typical example using the FTSE 100 of the candlestick chart on daily prices. Here blacks are down and whites are up, and it paints a different picture. It's easier to see trends and changes in those trends, I think, a lot more with the candlestick chart. So how do we interpret the candlestick? Well, the different body shadow combinations can have many different meanings, and they are very good for recognizing, like we said, either continuation points or reversal points. And hopefully you can now start to see that that these candles are giving off a psychological profile of what's occurring in the market. So there's 5 main features determine the character of any particular day: the colour of the body, if it was red or green; the range of the day, the high or low; the range of that body, that bit in the middle, the open and close; the range of the upper shadow; and the range of the lower shadow, those wicks. So let's take a look at some examples. Just a note on the patterns before looking at some individual ones. There are, I don't know how many in combination, but the rule is that you would go up to a maximum of 7 candles to tell that story, normally 5, but you can start from as little as 1, and they've got some great names like Hanging Man, the Hammer, or Abandoned Baby. The more candles in the pattern, the more likely the price confirmation. Like I say there, I look at maybe 2 to 5 for the best patterns, and you don't need to know them all. It's up to you if this is an area you want to specialize in. People just use candlestick charts on their own to trade, and they build their whole career around all these different patterns. I like to use them in combination with other things, but again, I'm presenting this here for you so you get a starter and you can decide where you want to take it. So let's have a look at some patterns. In my trading, I don't really use that many candlestick chart patterns, maybe no more than a dozen, but I've put in these 2 grey boxes below my favourite patterns. On the left you see something called dojis, and they are very good for spotting indecision in the marketplace, and often when you see these, the price can reverse and turn on themselves. And there's 4 different doji patterns there, and you can see the higher the body is in the chart, the candlestick, the more bullish it is, and vice versa when they turn red and the body's at the bottom. And in the middle it really is an indecisive market. Now on the right we have something called the evening and morning star patterns, and these again are great for reversal points. If you can see the arrows, say on the left one, the evening star, the trend has come up, the black arrow, then we have this play out of 3 candlesticks in that formation. We had a little gap in there as well, so it almost looks like an island reversal from our earlier knowledge on gaps, and then the price comes back down. And again it's vice versa for the morning star, which is more of a bullish reversal after the price trend has been coming down. So they're just some of my favourite candlestick chart patterns, but there are countless combinations, and if you want to get into candlestick charting, please do. It's very good, it's very effective, and it's great for interpreting what is going on in the chart. So some tips for you on candlesticks. The reliability improves with candlesticks if you team them up with other forms of technical analysis such as the oscillators like stochastics, RSI. We're going to look at those later. And in the example here you can see Fitbit, now part of Amazon, their share price, and in form of candlestick with the RSI and volume and a moving average on the price to start to help us make a more informed decision. So the stages to follow when making a candlestick assessment: firstly, you've got to identify the trend. You can use pre-signal oscillators to give a trend signal, for example using a moving average to filter out, and we confirm with a candlestick pattern, and further confirmation can be done through, say, looking at volume. And as I mentioned just previously, oscillators are good for aligning with the candlestick for reversal patterns. So the pros and cons of candlesticks: it's all about visualization really. It gives a much more transparent picture of what's going on and gives you a unique insight. It uses all that information like the bar chart does, the open, high, low, close. It works very well with other forms of filters and oscillators. You can get to see reversals in the price a lot more. It can be used in all markets, and it works very well for traders and investors in all time frames. That means down to the really fast stuff to like the slow weekly, monthly looks. The downside: you need all that data to make it work. You probably need a bit of experience to translate, and not all data vendors will give open prices, but more and more now everyone's coming to a line, so it's probably not so much of a con these days. They're all pretty much doing the same thing, so more pros than cons, and candlestick charts are really useful. So let's look now at setting up our charts and a few examples around the candlestick chart. So this is where we left our chart example last for the bar charts. It was the Australian dollar against the US dollar at 15 minutes, and it's exactly the same process. So we go up to the indicator, so the chart type, we find candles, and here we've got two different types. We've got hollow ones which look like that, so they're basically a transparent sort of background, and we've got our standard candles which are more solid. Now I use the standard ones there, and again it's the same thing, change through the time periods. Let's look at a week for the Australian dollar. Look at the way we can start to see trends very easily. Let's find something else. Let's look at I don't know, gold for example, see what's been happening in that market. Commodity, there's our drop list. We've got various different options. Let's look at this one, and it's just going to update. There we go, that's what's happened in the weekly price of gold. We have a down run, bullish, and has been in the last few weeks selling off and around the 1800 level. But look for the patterns. There's our dojis there and there. These are different patterns as well that you can learn all about. So start looking at these candlestick charts and translating what is going on in the price action. So to round up the candlestick section, an exercise for you. It's along the same format as the other exercises so far. Go to your chart package, add the various markets that you want to look at, or those in the example there, pound, oil, S&P, Amazon, Apple, etc., and use those candlestick charts to see, you know, how you can use them and how they could be interpreted. And why not flick between the bar chart and the candlestick chart to see what difference they make to each other, and look at the candlestick charts in different time frames. Go down to the faster ones, the 5 minutes, and then, you know, move yourself back up through the time frames to the slower ones, and also look for some of those specific candlestick chart patterns that we have talked about and see what happens to the price action after they play out. So now we've looked at candlestick charts, we're just going to look at two further chart types, and that's point and figure and equivolume, before we then get on to market breadth, and we've then covered the basics of charting. Now there are many types of charts and derivatives of those chart types. We're going to have a look at two in this section, not as popular as the others, and they are called point and figure and equivolume, and we're going to keep the Japanese chart types separate for later in the course, but it's good to give you a broad spectrum of what's on offer, because like I said, it's horses for courses, so these styles of charts might suit you more than the others. Now I'm not going to spend too much time on point and figure charts, simply because in my opinion it is harder to apply than some of the other chart types, especially if you look at the Japanese ones later. You'll think how much easier they are to use, but they are very similar in many ways. But I think point and figure charts are very good for the longer term investor, and it looks like a glorified game of noughts and crosses, and they are some of the oldest chart types in the West, and they started as a tick system on trading floors and developed from there, and predates even our bar chart friend we saw earlier. And traders have developed now over time an effective way to record prices, and it was plotted with this cross and zero, noughts and crosses approach, and it helped them speed up their analysis when they were on the trading pit floor. Now, like some of its Japanese cousins like Kagi and Renko, point and figure is the study purely of price movement. It doesn't take into consideration time, which is slightly confusing to most, but when you see it, it does make. Now, how you set up the price movement sensitivity is very important, because it can provide you with a short, medium and long-term view. And another good plus point of the point figure chart is they're very good for finding support and resistance levels. And as you can ascertain already, that the movement of this price are used in columns instead of the bar charts or candlestick charts that we've seen before, and uses columns of X's and O's. So here is what the point and figure chart looks like. X is for up moves, rising prices, O's for down moves, falling prices, and these X and O's sit within a box, and you set and specify the size of that box according to maybe your strategy or how you think the asset moves. And the y-axis is populated by the price, and the x-axis, which normally has time, really doesn't involve the time, but modern charting packages include it, but you'll see that the dates jump to encapsulate that whole period of columns of O's or X's. So that's what it basically looks like as a chart type. Now, I briefly mentioned one of the two basic parameters of the point and figure chart, which is the box value. We also have the second one, which is the reversal criteria. So you would change these to increase or decrease the sensitivity of what you want to see inside your point and figure chart. So if you increase the box size, it becomes less sensitive to movement, probably better for longer term investors and traders, and decreasing it makes it more sensitive, so better for short term traders. And the more boxes for a reversal, the less sensitive the chart becomes, and vice versa. So what is the point and figure chart trying to show you? Well, it's really the interaction between supply and demand. So we've got two examples down here showing that when demand is greater than supply, it's a buy, and when demand is less than supply, it's a sell. And that's interpreted through the X's and O's, and you can see on the left there the sell as it breaks down through that sort of support level, and vice versa for the buy side as the X's cross up and break into a new level. Now, you could spend your whole life in point and figure charts if you really wanted to, and there are a lot of rules. I've put some down here for the charts. If you want to get into point and figure charts, I suggest you go back and look at them and dive into the subject further, but I'll go through them briefly now. The stronger the support and resistance, the stronger the signal will be when broken. We sort of saw that from that supply and demand pictorial example. More support and then it breaks, the stronger the chance of it continuing. The patterns aren't an exact science, and for patterns the wider the better, and it uses similar patterns to bar charts and candle charts, like triangles, so you can draw on top of the point and figure chart. Congestion analysis can help the prediction of the breakout. The fulcrum dish is the most important congestion pattern, a bit like a W on a bar chart, which is double bottom. And on the right side of the fulcrum, you look for the catapult, which we're going to see in a minute. And that fulcrum can have different shapes, for example a V or a flat bottom, and the reverse is true for bearish trades. And a breakout and pullback is one of the strongest signals, and that is known as the catapult trade. So if you want to visualize how you could trade using point and figure charts, I've got an example for you here on crude oil, and you can see various patterns playing out within inside the point and figure setup here. We've got quadruple bottom breakdowns, we've got descending wedges, double bottom breakdowns, ascending wedges, long-term top and breakouts. And these are just a few of the patterns that play out inside the point and figure world. As technical analysis software has developed over time, it's allowed you to do a lot more to the point and figure chart than you could do previously. It's the same with Kagi and Renko charts. You can create quite easily your own very unique specific strategies. I've got an example of how you can enhance the point and figure chart. You can do this in TradingView, and you can do this within most technical analysis packages now. Now this is a point and figure chart of Barclays Bank PLC, large UK bank, and all I've done to the chart is I've added on an indicator, Japanese one called Ichimoku, which has its own set of rules. I've got no idea whether this works. I'm just illustrating the point that you can add now indicators and tools on top of the point and figure chart to strengthen the decision making or make it easier, an even better charting tool to use. So you can have your own sort of in-house point and figure strategy all by itself, where you can use it for trade management and complementing the other methods, for example placing your stops. We now move on to our second chart type that we're going to look at, and that's called equivolume. This is quite a strange one, and it's a combination of a couple of ideas. It hasn't really caught on, and you can only find it in specific charting packages. I know it's on Bloomberg and stock charts. Don't believe it's on TradingView. And the advancement in the software has allowed these new chart types to come up, and one of these is equivolume. If you're taking the technical analysis exams, then equivolume is part of the MSTA syllabus, so it is very important as a chart type, but outside of the professional world not many people have heard of it, and it's quite simple and logic in its application, and it combines price and volume together into one bar, and these bars are known as boxes. And it was developed by a guy called Richard Arms, who's very famous for other technical indicators like the ARMS index and other technical analysis solutions. And notice on the generated example below that there are no candle wicks, so don't get these charts confused with candlestick charts. They're nothing to do with each other, and the width of each bar varies according to the change in volume, and that's the uniqueness of the equivolume chart. So a bit more on the background of the equivolume. Now the box, the width of the box, and I just mentioned, represents the volume traded on that particular period, and you can, like any other chart, set it to 1 minute, 1 hour, 1 day, whatever you want to use. And the wider the box means there's been more volume in that period that you set. So by default, when the close is above the previous close, the box closes black, and by default when the close is below the prior close, then the box closes red. So it's sort of an amalgam between a candlestick bar chart with volume added into it. Now to me this chart makes a lot of sense, but you'll find when you come to use it practically it's very difficult to use. But visually as a tool it's very handy, and we can see in our example below, looking at the US stock Nvidia. On the top we have our equivolume chart, and below a candlestick chart, and they both cover exactly the same period. Now the candlestick chart below has, even below that, the volume, the individual volume, broken out into two separate parts, whereas the top chart, the equivolume chart, has combined the two. So you can see how it adds in the increase or decrease in volume to within the individual bar or candlestick, as we know now, the box. So equivolume, useful, hard to apply in practice and hard to find in a charting package, but maybe worth a look into. So before we finish this section, a exercise for you on point and figure and equivolume. So the point and figure, as you sort of gather, I'm not a great fan of, because I know that I can use it better at using Renko and Kagi charts, which we'll look at later. But horses for courses, they do have a lot of benefits to them, point and figure charts, and I wouldn't discourage you from looking into them. So if you want to investigate further, do so. It's useful to have an understanding of them, and you can gain more knowledge by knowing what they do. So play around with them, find different markets, and see what you think. If point and figures for you, have a go. Then on equivolume, it's the same sort of thing. You might not find it on your chart packages. It is free on stockcharts.com, so you can load up that and have a play if you want to see how equivolume works. If you're lucky enough to have a Bloomberg terminal, I know it sits on there. If it's something you want to get into, have a play around, see how you can use it. And I suppose the takeaway from this section is that with all chart types, have a think on their strengths and weaknesses and how you can use and do a SWOT analysis on them, how you can use them or combine them with other charts to make your trading better, or how they could actually impact negatively your trading. So never rule out any of these chart types, because they're all very useful, but you must gain experience in them to be able to rule them out or in. Market breadth is all about measuring the sentiment of any given stock market. And that's where it gets its name, market breadth. What is the breadth of the market? And it's all about upward, downward and sideways movement and range, and it's principally applied to stocks and their stock markets. It doesn't matter what stock market it is. It could be US, European, global, anyone. The same principles apply, and it's to use to gain an understanding of whether the overall sentiment of the market is bullish, bearish or flat. So some people see it as like a health check of any given stock market. So at any point in time, how healthy or not it is. And many who analyse the health of the stock market often use certain indices to form a subjective opinion. For example, in the UK, you might use the FTSE 100. In the US, the Dow Jones Index. And you also need to then know what its components that make up those indexes are. Are they heavily industry weighted, tech weighted, like maybe the Nasdaq 100? And is its calculation weighted, or how has it makeup changed over the years? So here's some stock market indices to give you an idea of the approximate weighting shares of the various indices are to its total market value. So for example, FTSE 100 equates to 81% of the total share market in the UK. So if you're getting an opinion from an indices, then you probably want it to have quite a high percentage. So you can see there the S&P is between 70 and 75%, the Russell 3000 98%, Bovespa in Brazil down to 70%. So always bear that in mind when you're comparing an indices in the form of market breadth. Over time, the comparison of the stock index to, say, group stocks wasn't as useful as first envisaged. So technical analysts and users of the stock market over time have come up with different indicators to give them differing opinions on what's going on. So for example, new highs and new lows of stocks within the index, 52-week highs and lows, stocks greater than any given moving average, advances and decliners, and tools such as McClellan oscillator, and some included volume as well, like the up and down volume and the arms index. Other market breadth methods could include comparing indices from the same market and looking how they diverge. For example, the S&P 500 versus the tech-heavy Nasdaq 100, or by comparing their relative strength to one another, or for that matter taking a global view and adding in key markets to gauge global economic equity strength. There's more and more these days, everything seems to be correlated together. And on your daily trading journey, you might quite often come across these sorts of indicators, and normally they are presented in a daily view such as this. On the left we have data from somewhere called marketwatch.com, and you can see that middle column there shows the advances and decliners, at any given time, the 52-week highs or lows, those stocks that are advancing and declining. And again, from another place called barchart.com, it's giving you a snapshot of advances, decliners, and new highs and lows. It's all very nice, but as analysts we want to see what the trends are, the patterns are forming within those indicators, and we can do that in the charts rather than just having these one-off daily snapshots. So like I just mentioned, we can take those snapshots and put them into graphical form, and that's one of the beauties of technical analysis. And we can see from this screenshot from stockcharts.com highs and lows, and very obvious what the 52 and week high low means and how many stocks are achieving this. And obviously the more stocks at high, then the more bullish the market is. Now you can see on the top there the highs and lows, and just below that is the price of the stock market that it's tracking. And what we're looking for here is a relationship between the two. Are the two in tandem with each other, signifying either further bullishness or bearishness, or are they diverging from each other, suggesting maybe a change in the price action? Now, a very common process is to use moving averages. The most common, especially in stocks, are 50, 100, 150 and 200 on the daily setup, and basically they're looking to see, analysts, whether stock numbers are greater than or less than to indicate whether a bullish or bearish situation is playing out in the market. So if you have more stocks greater than, say, the 50 moving average, then the more bullish their feel might be. And here in the example we have on the top that moving average, it's the 200 moving average. See how that picks up in comparison to the underneath chart, which is the S&P 500, the actual stock index. As those stock numbers rise that are greater than the 200 moving average, the price of the stock index has also gone up. So there is a good correlation there between the two. Now, another simple concept is the advanced decline line. That's simply just the difference between the advances and decliners, maybe based off the end of day close of the market, and then again plotted onto a chart. And what we're looking for, again, correlation between the underlying market and the AD advanced decline line, or maybe a divergence signifying a change in direction. And here's an example of the AD line there with the S&P 500. You can see quite clearly over that 5-year period the correlation between the two. As the AD line has progressed upwards, so has the price of the S&P 500 index. So there are more complex tools that have been devised to measure the AD line, and one of these is the McClellan oscillator, and it just turns the AD line into the concept of being overbought and oversold within the oscillator, so users of the data can get a more meaningful interpretation of what the AD line actually he's doing. So it's a bounded study between plus 100 and minus 100, and it's a very similar concept to the MACD indicator. For those of you who want to give it a try, and you will find it on most charting packages, the default inputs for the oscillator are 19 days and 39-day exponential moving average of the net advanced decline figures. And to interpret it, anything greater than 100 is thought to be overbought and less than 100 oversold. So once we go into those boundaries, expect a change in the price action. And continue to build from the example from the tradingview.com charts of the S&P 500 with the AD line. We have now removed the AD line and included the McClellan oscillator, and that looks so. So here is the McClellan oscillator on the S&P 500, and you would be using the green and red points to look for movement above and below 100 and minus 100 to anticipate the price of the S&P 500 there on the top moving in the opposite direction. So as for example that the market got overbought, you would expect a sell-off correction in place. So as the McClellan oscillator moved back into maybe less than 100 zone and vice versa. So then, to enhance market breadth further, other analysts introduced the concept of volume, and there's up and down volume that you can turn into advancing and declining around the stocks. There's many indicators that have been created, but some of the more popular ones are by a guy called Richard Arms, who combined the AD concept with advancing and declining volume and called it the Arms Index. And for those interested in giving it a go, how does it work? Well, as the number of advancing shares increases on low volume, the arms ratio will increase, and this means that the rise in the advancing shares is weak and unlikely to be supported due to low volume, and vice versa. So when looking at a trend indicator on a chart, you'll have to look for the inverse. A high trend normally peaks at a bottom and a low trend at a top. Greater one normally bearish and a low number bullish. And to aid analysis further, often a moving average is applied over the trend to smooth out that data, so you can create strategies around it. And what does that look like? Well, we've got it on the S&P 500 again. Arms index is below the S&P 500 there. Again, it's got boundaries in place, and you can use overbought and oversold approach, but remember that encapsulates volume. And when I mentioned trend, that's the other name that other people call the arms index, so don't get confused there. So just another way of interpreting what goes on with market breadth to give us a health check on the state of the stock markets. So a market breadth exercise to finish off this section. Go away and find some stocks that interest you. It could be US stocks, UK stocks, German stocks, whatever. Could be Apple, Tesla, Microsoft. Then see if you can find some of the indicators mentioned in this section and apply them to your charts. And the second part of this should be to see if you can translate that information, what you're seeing on the charts, and how you can make decisions in your trading around it. Try and tell it like a story, and you can then start to create trading strategies. And the takeaway here is to appreciate that market breadth, the concept of, is more applicable to stocks and equities. So we've come to the end of section 2, so let's briefly go over what we've learned so far. So you've now covered off the raw basics of charting. You've got a brief insight into the history and background of technical analysis. We've looked into charting packages, how to use them, how to find them, examples of resources, and that they are an essential part of your trading. And we've also introduced you to 20 key technical analysis rules to get you started and thinking and see how they interact as you go on through the course. And we've also covered off some of the big questions that get asked in this topic that also, now that you understand those, will help make your learning a lot more easy as the course progresses. So line and bar charts, what did we learn? Well, we learned that they are effective price analysis tool if used in their correct environment, and they can paint a more exacting picture of what is going on the asset you are looking at. And in the world of technical analysis and trading, the bar chart, because of it being made up of 4 parts, the open, high, low and close, offers more possibilities for effective analysis over the line chart. We found out that line charts are quite limited in their application, but very good as a presentation tool. And we touched on the basic capabilities of the bar chart, and there is much more to what this type of charting can do for you. And bar charts take charting up a notch and give a much more transparent point of view of what's going on. And even this style of charting, I think, isn't transparent enough. Methods like candlestick charts, which we looked at, are becoming more preferred because they paint a much more colourful picture and more easy to translate than something like the bar or the line chart. Candlestick charts, I hope now that you can see how candlestick charts add a lot more colour to your trading and investing and make that analysis hopefully a bit more easy. And they can be used as a standalone system if you learn all those combination of candles, and they can be enhanced much further with oscillators and other technical analysis tools, and they make very powerful instruments in your analysis and take you to that next level. And in a later part of the course, we will look at a derivative of the candlestick chart known as the Heikin-Ashi chart, which, if you've got twitchy buying selling fingers, which I mentioned in the rules right back in section 1, then you might want to consider the Heikin-Ashi chart, as it does help out with trading psychology. Point and figure charts, one of the older pioneers of Western technical analysis, losing its popularity, I think, and becoming more of a niche tool, maybe due to its usability and the competition of other charts, which we will see shortly, like Renko, Kagi, the Japanese stuff, and how the software's changed and made those other chart types more available and easier to use and develop. And in the world of technical analysis, point and figure charts are a bit like Marmite, and you'll understand that if you're from the UK. You either love it or you hate it, so I'm not excluding it. Give it a try, see what you think, and if you don't try, then you don't know. So that is point and figure charts. Equity volume really is a strange one, but I've included it in here to give you an idea of other stuff that goes on, and it's even more of a niche sector than, say, even the point and figure charts. It does make sense and has some great applications, but is very difficult to use and find on your charting packages. So if you can explore it, give it a go. If not, I wouldn't hold it against you. And market breadth, the market breadth tools that we looked at, simple in their construction and have served the stock markets well over the years. A very useful addition, a set of tools for the stock indices trader to consider. So that's section 2 wrapped up, and in section 3 we'll look at how to interpret the data in the charts through something I call direct price analysis, and we'll be looking at a multitude of topics from trend, support and resistance, patterns on price, moving averages, bands, are markets trending or ranging, how do we decide, Fibonacci, pivot points, Ichimoku, and understanding these principles, which are all necessary to give you the building blocks to understand the price action analysis and evolve and take that technical analysis learning that one stage further. Section 3 is all about building our knowledge up further, and it's a section which I call direct price analysis. That's not an official term within the technical analysis world, one that I use to describe tools, indicators, analysis done directly on top of the price. It's not about putting indicators below that price chart. It's about stuff that goes on right in the price action itself, and we're going to be looking at 8 mini topics in this section. We will start with trend, support and resistance, then patterns on price, moving averages, bands, then we're going to ask the question, how do we know whether markets are trending or ranging? We're going to look at Fibonacci, pivot points, and then Ichimoku, a Japanese all one-stop shop trading system. So we need to understand these principles first, because it's going to give you those necessary building blocks to understand price action more thoroughly and be able to help you analyze what's going on the charts, and then again allow you to take your technical analysis that step further, and you can now start to deviate into other areas or focus on particular things you find interesting, because again all of these 8 mini topics can be lifelong studies, strategies by themselves, and you can focus on them and make a trading career just out of them. So let's get started into section 3 with trends, support and resistance. We need to know what our charts are telling us, and we need to know what a trend is, and its definition is the general direction of a market or of the price of the asset that you are looking at. So how do we measure that? Well, it's going to go up, down and sideways being trendless, and it's going to have 3 major time classifications: 6 months to 1 year, 3 weeks to 6 months, and less than 3 weeks, maybe better for timing purposes. So here's our chart that shows us through the 3 different periods in action. We got a longer term blue line, the longer term trend, we got green lines showing a medium term trend, and then under that we've got our red short term trend. So you can trade all those at the same time. You might just want to trade the short term one. So by determining the direction of the trend, you're going to come up with 3 trading decisions: either to go long, go short, or do absolutely nothing and stay on the sidelines. And remember, importantly, that the market trends roughly only a third of the time, so you need to know when it is happening. That's very important for what tools you're going to use. So here's a quick example on the S&P 500 on a Heikin-Ashi chart, daily chart. Green arrows, short-term trends, red medium, black dotted line there, the longer term trend. It's just showing you how it works on a typical market. And really the rules of trend drawing are important to know. If you have 2 touches on a trend line, that's only a tentative trend. You need 3 or more for confirmation of that trend, and that's very important to know and to apply. And it can be drawn on any charts, even the Japanese Renko charts that we saw earlier. And you've got to draw the trend lines through the lows in an uptrend and through the highs in a downtrend. And it's a very discretionary, a subjective trading drawing process. So here's a gold chart that I actually used in Bloomberg terminal while I was trading away, just giving you a simple example of a trend line that's touched multiple times, by 5 or 6 before it breaks. So the more touches, the stronger the likelihood of that move outwards and away, and as it did in that instance, it went flying high upwards. Here's another one, Diageo PLC, UK company, and again this is subjective. You might see trend lines in there that I don't, and that's what makes it more subjective, less objective approach, but also very useful to your trading to understand. So what applications can we use the trend line for? Well, we can use it for price objectives, when the trend is changing, the strength of the trend. 45 degrees is a very important number. That's the optimal trend line. We can use channels to bounce prices between, and we can also do it for entering long short positions and profit loss taking. And we can see here on the Hang Seng a typical channel example of the trend, how the price has moved up and down in a range, popped out briefly and then went back into that range. So it's a very useful tool, trend lines. So here's an exercise for you. This is a typical blank chart. Find one for yourself and then just practice to your heart's content, drawing as many trend lines as you can to work short, medium, long term. Let's see how we draw those lines on our chart. We're in Trading View. I've got crude oil, WTI crude oil on a daily chart up for analysis. I want to draw some trend lines on there. So on the left hand side we have all the different drawing tools that we can apply onto the chart. We want the top one there, and we've got, as you can see, all sorts of things going on here. For a standard trend line, we just click on there. We're going to look, because obviously in an uptrend we're going to draw our uptrend line. Just click where you want to, we join it to there, and if we remember our rules, we've only got 2 touches there, so that is it's not a full uptrend yet. We need another touch, another pullback, and then it's a confirmation that the trend is in place. So if you know that sort of knowledge, we could expect a pullback. So there's a short trade there, followed by a long possible bounce. And again, if we want the tools to use, we can draw our channels, and we saw that on the Hang Seng example. We've got a parallel channel there, and it's the same process. We could just overlay that and then draw it that way. And there's not really a channel in place in that longer term because we haven't got any other touches. We just got the 1 touch there. So explore the tools in the Trading View chart, and then play around with a few different charts, time frames, markets. And like I said, and the big takeaway here is it is very subjective. You put 100 analysts in the room, and I can guarantee you every one of them will come up with different trend lines and observations. Now, support and resistance is a very important topic as well. It's similar to the trend line, but with support and resistance, we're going to try and dig into the psychology of the price action. We're trying to find out, why trends stop, why they hit a brick wall, why they go up and down, and why do they stop at these points. Now, they can repeatedly hit this wall until something else happens, and price either gives way and it continues, or it reverses. And this is the concept of support and resistance. So firstly, support. What is support? It's the level of the price at which buyers are expected to enter the market in large enough numbers to take control from the sellers. So it's a bit like supply and demand. It's where the buyers really overtake and overrun those sellers, and the market has a great memory and it remembers these support levels and numbers. And when the price falls to a new low and then rallies, buyers who missed out on that first decline will be more inclined to buy if the price returns to that level, because it's FOMO, fear of missing out, for a second time, and they may enter the market again in large enough numbers to take control back from the sellers. And that, in trading terms, is called a rally. And this just reinforces the perception that price is unlikely to fall further, and creates what we're looking at now, which is the support level. So here's an illustration of support that I've drawn out. Notice the price on the left hand side, that's the black line. As it comes down, it stops and reverses back. It goes back up, a mini rally, and then it falls back down, but it falls back down to the same sort of area, and that is the support zone. And if it doesn't break that support zone, then it's more likely that the price is going to reverse and go back upwards. The market doesn't want it to go down anymore. That's hit its bottom there, and it will reverse. We know that now as support. Now, resistance is sort of the opposite to our support idea, and the resistance level is the price level at which sellers are expected to enter the market in sufficient number to take control from the buyers. So when the price makes a new high and then retreats, sellers who missed out the first time will be inclined more to sell again. It's that fear of missing out, the FOMO, and afraid of missing out for a second time, they may just come back into the market, overwhelm the buyers, and the price goes down. The resulting correction will reinforce market perceptions that price is unlikely to move higher and establish what we call the resistance level. So from the support and resistance so far, you can see it is quite a psychological game that's being played out, and we can measure those support and resistance levels and the psychology of the market very nicely using our technical analysis. So here's a concept of resistance playing out. From the left, the price comes up, hits a point, retraces, tries to go back up again, hits the same point again, retraces, and then tries to go back up one more time, and then falls back down. So again, the market's saying it doesn't want to go up above that level. That's its top, and it's time to sell. So what happens when we see the support and resistance levels penetrated? Well, what often happens is they create a role reversal. Support becomes resistance and resistance becomes support, and it's probably easier to see that in another diagram that I've drawn. So here we see from the left the price has come down, it's hit the support line twice, we're thinking it's going back up, but it fails to go back up, and then the price plummets down, breaks through that previous support level, but then recounters by going back up, but doesn't break the previous support level, and it tries to do it another time. So we now have a change from the support and resistance. The roles have reversed, whereas we did have support at that level, we now have resistance at that level. That's a key flag for you to look at, because if you see that, then you know that the market doesn't really want to go back above that price, and it's more than likely to continue downwards. Some rules of support and resistance. Some support and resistance levels are more important than the others. The significance of the support level is identifiable by, a bit like our trend lines, the number of times that level has been respected, i.e. touched. The more times the better, to signify the strength of that move, and the amount of volume that has been traded near that level as well is an important add-on that you can put in conjunction with the lines that you're drawing to see whether it's significant or not, and whether the level is a new high or new low. And more extreme levels have a greater impact. And always look out for psychological round numbers. Is the price forming at say $20 or $100, because that leaves a lasting psychological memorable imprint in the trader's mind. So here's just an example on the FTSE 100 of some subjective support and resistance lines I've drawn on. And if you look over to the right hand side where there's the price axes, notice that they are quite at significant levels. The top one there at 7,000, you got one at 7,300, another one at 7,100, another one at 6,600, maybe 6,700 area. So they can highlight important key significant levels. Now we are going to dig deeper into the support and resistance and trend line theory, and we've already looked at one way of using a tool that's available to us to discover these lines, and that's just manual trend line drawing. But we are going to look at others like Fibonacci, pivots and moving averages later in this section. So to wrap up trend support and resistance, some work for you to do on the trends. Take some markets on your own charting package, whether that be bar charts, candlesticks, go into different time frames and start drawing on your own trend lines, and make sure you understand how your charting package lets you do these, and remember those rules, you know, the 2 touches, the 3 touches. And in regards to support and resistance, look for those patterns to the up and down side and see how they play out, and look out for when support becomes resistance and resistance becomes support, you know, that role reversal that we talked about. And the big takeaway from this section is that trend lines, support and resistance is a very subjective process. You've got to remember that. There's no right or wrong answer as long as you're applying the techniques correctly. Now, patterns on price really do get the non-believers of technical analysis going. They really do think it's mumbo jumbo, but you've just got to stop and take a second look at what's going on. It really is all about supply and demand, economics and psychology, all being played out through a chart which is painting a picture. And over the last 100 or so years, technical analysts have put names around these patterns, and they are extremely useful and very helpful for making us more aware of the future direction of a market, whether it's going to continue the price, or is it going to stay within a range, or is it going to reverse. So patterns on price are a very useful thing to know. So within technical analysis, the chart patterns are put into two price movement buckets. One which is that prices continue, and the other is that prices reverse. And by doing that, we're helping the user of the charts have some sort of clue as to what direction the price will take next. So when a trend is developing, it normally has a period of time when it evolves into one of these two buckets, the reversal or continuation, and this evolution into its future direction is captured within these price patterns. So what are they exactly? They're just pictures or formations of price which appear on your chart, and it can be in any time frame. The fast ones, the 1 minute, 2 minute, 5 minute, 15, 1 hour, daily, slow than that, weekly, monthly. They work throughout all time frames and all markets, whether it's FX, commodities, stocks, the lot. They can be used generically across every category, and they do have some predictive and probabilistic value. And those two main camps that we talked about, the continuation and reverse, are further split down into two unique buckets of much more individual patterns. So bucket one on the left, we have reversal patterns, and the more popular ones in that bucket are heads and shoulders pattern, double, triple tops and bottoms, saucers, spikes and V reversals. And on the continuation patterns on the right, we have pretty much triangle wedge like patterns, and those triangles and wedges have their own unique setup. We have symmetrical, ascending triangles and wedges, and we have the same with flags, pennants, and we also have descending triangles and wedges. Let's start with reversals. We'll look at a couple of those examples, the double bottom and the head and shoulders. And here on the right hand side we have the double bottom, and it really is just because it's got two touches on the resistance line, and it also looks like a W shape, and we can get an idea of where the price is going to go when it creates this pattern by taking the middle part of the double bottom play out, the W. We take that part and then we add it on to the height and the breakout from that middle part, and that gives us our upside projection. It's very simple. Now we also need to point out that these aren't just double bottoms. You can have double tops, which are the exact flip, and you can have treble bottoms, treble tops, quadruple bottoms, there's no limit to it, but obviously the more there are, the stronger the confirmation of that reversal in price likely to be. Now the head and shoulders is so cool because it's supposed to look a bit like a head and shoulders, and it sort of does in a peculiar way, but what we're looking for is this sort of play out in the price. And again, remember, it's subjective. It doesn't have to look like a perfect head and shoulders, and that is very important to note. But generally what happens here on our example from the left, the price comes up, creates this shoulder pattern, then reverses back down to what we call the start of the neckline, then pops back up to create the head, down again, then creates the right hand shoulder, then the price breaks down through that neckline, and that's a chance for you to go short if you're a more aggressive trader. But what a lot of people do is they wait for it to come back to the neckline to go back to our support and resistance and support role reversal playing out, and then they will go short there, sell the market if they think it's not going to go any higher, and that's what the price is going to do. So the heads and shoulders is not a bad pattern. It's hard to spot and it's more of one of the rare ones, but you also have it to the downside, the reverse head and shoulders as well. So we have two there, the ups and the downs, depending on which way the trend is going. But the rule to bear in mind though is to spot these heads and shoulders is that the trend coming into it must be for this example here, trending upwards for a reasonable significant part of time. It can't come in downwards into that pattern or sideways. It's got to be looking like it's building up a reversal situation. So some rules for you around the reversal. There must be an existence of a prior trend coming into the reversal pattern, and the first signal of the reversal is often breaking an important trend line, and the larger the pattern, the greater the subsequent move. So when you're in higher time frames, that pattern is probably going to be stronger and have maybe an influence on your lower time frame trading. Topping patterns are usually more volatile than bottom patterns, and bottom patterns have similar price ranges and take longer to build, and reversal points normally coincide with heavier traded volume. Like I said, you can't do that in FX because we can't monitor and measure volume, but in stocks, commodities, much more easy to do, and volume is usually more important to the upside. So just an example here for you again on crude oil. First takeaway, it's not an exact science, they're patterns I've created, but on the bottom left hand side you can see a double bottom playing out and see how that moved the price upwards. Then we have a head and shoulders pattern. The trend was coming up into that pattern and it reversed off back down, and then as we move more to the right we've got a smaller double top pattern, and this is where the subjectivity comes in. I've created a triple top there, but notice that the resistance point to the price there is always around that same level, which is very important to take away. The three sort of triangle-y upside patterns don't look very symmetrical and very much together, but actually they all stopping at that one psychological price point, and we got a 3 touch there, and the price then came back down and reversed. So moving on to continuation patterns. With continuation patterns you're looking to move out of an instrument sideways holding period and continue in the way of the previous trend. So remember that, in the way of the previous trend. The continuation pattern is quite often shorter in duration than the reversal and happens more frequently, so there's going to be more opportunities for you there, especially in the shorter time periods. That's the in terms of your charts, the lower time frames, the less than daily period. So intraday, these are more common types of things to look out for. Now there's 4 main triangle based continuation patterns, and they do look like on the charts like their names. And we have the symmetrical one, the ascending, descending and expanding and broadening. That last one's quite rare and hard to spot, and it has 3 higher peaks and 2 declining troughs. Now the symmetrical one has, well, what you're looking for is 4 touches inside the pattern, and a breakout of that pattern often occurs 2/3 along the triangle, and obviously has a time limit where the 2 lines meet, then it's null and void. And the ascending, the price height of the pattern at the widest, add that onto the breakout for a price target, and the descending, it's the target measurement as ascending but in reverse. So we've got 2 examples here. We've got the symmetrical bullish triangle pattern playing out on the left. Notice how many touches it has inside it. It doesn't have to have exactly that, and the more, I guess, the better. And then it breaks out about 2/3 of the way. And remember, that's subjective as well. You can't hold it to exactly 2/3, but what you can look for as extra confirmation is what I've crudely drawn on below, is a volume breakout. So if you're looking at stocks or commodities like we talked about, or futures, then you watch that volume, and if it coincides with that breakout, then it's a better confirmatory signal. And then on the right hand side we have an ascending triangle type pattern. It's exactly the same. We've got the movement within the pattern and then it breaks out. So AB, the height of that ascending, you can add on to create CD as a potential price target, and again accompanied by a spike in volume. And here we have our last two patterns. It's the reverse with the descending bearish breakout, exactly the same. We've got a volume spike coinciding with the breakout, and then on the right hand side we've got this sort of megaphone type event or broadening triangle, and it's very rare to spot, but we're looking for a divergence in the top and the bottom part of the triangle. So that's the triangle patterns wrapped up, and it's a very similar set of rules to the flags and pennant shapes. And as you get into technical analysis and you want to use these type of patterns, then I suggest digging into what patterns extra there are, like the flags and the pennants, but the rules are the same. Look for the volume breakout. Say for example on the flag you use the trend up as the measuring stick that you add on to the breakout. So again, dig around, get some experience, look at your charts and start drawing on some patterns. And here's an example on the FTSE 100. Remember, it's not a science, it's subjective, so they are my opinion. You might have a different opinion, but just to give you an idea of what's going on. So on the left you can see a typical triangle pattern, then next to that we've got a pennant, and it's a pennant because of that flag pennanty type play out, and then we've got just another couple of continuation patterns breaking out on the right hand side there. So these tools, these patterns, can be very useful for estimating future price targets, but there are a couple of further rules you need to be aware around this. Now for continuations, the price target in an uptrend is measured from the start point of the trend, that's the breakout point at the base of the trend or most recent congestion pattern to the highest high, and the move is then projected up from the point of breakout from the triangle, flag or pennant pattern to arrive at the target. And for reversals, the target for a reversal pattern is calculated from the highest peak to the lowest trough in the wedge pattern, and the objective is calculated by projecting the target up down from the breakout point. So going back to our charts, how do you actually draw those? Really, it's down to you using the tools available to you. It's down that drawing side on the right hand side, and here I sort of see a head and shoulders pattern. It's on the US Canadian dollar 1 hour chart, so let's draw it to see if we can find it. So we've got this loose shoulder sort of here, we've got our head over here. Oops. The other shoulder there. We sort of got a neckline going across here, and that there's the breakout downwards for the price. No, but that's my opinion. You might not see that at all. You might see a host of other patterns. You've got wedges coming over here on the right, triangle type patterns, and the price then continues upwards. You've got another one there like that, and the price continues upwards. The important point of that head and shoulder pattern though was that the trend was moving up into it. It wasn't coming down from that way or sideways, it was coming up, so that was signifying more of an important or possibility of the price reversing. So to finish off patterns on price and exercise, take some of the markets from your charting package. It doesn't matter if it's bar charts or candlesticks. Use different time frames, play around creating your own reversal and continuation patterns and see what happens to the price afterwards. And the takeaway here, creating patterns on price like trend lines is a very subjective process. There's no right or wrong answer as long as you're applying the techniques correctly and are making money from them. I can tell you patterns are seriously improved once we start adding oscillators, and we'll look at that later. So moving average is a great, effective, simple tool to apply onto your charts. Basically, it's, and you might have seen this in other walks of life or in your maths classes of old, it is a smoothing of a time series of data. It's easy to build and test. It's also easy to get in and mess with, and it's a very subjective process, but you've got to use it as a guide to the trend more than as a trading signal. But you could use it, say, for exits, entries in combination with other tools, but as we said, it's a smoothing of a time series and gives us that insight into what the trend actually is and takes out the noise. And there's different ways of calculating exponential, linear, weighted. Some people use one, some people use a combination and use crossovers of those to create signals, although that can be dangerous, as I'll explain shortly. And on top of that, there's other popular methods. You know, there's like the triple crossover, 4, 9, 18 period. There's one based around envelopes of percentage of price move. There's the Donchian bands that are based off of a 4-week look back period. We have our Bollinger bands that use an input of a moving average to help analyze the standard deviation move of the price. We've got moving averages tied to cycles, 5-day, 20-day, that can measure behaviour easily. And you've got indicators on top of the oscillators like MACD that use the moving average. And in certain markets, these rules can't be beaten. And if the price is greater than, say, the Renko blocks, and it's bullish, and vice versa. But there is a problem. They only work when the market is trending, and this is what catches people out time and time again. And we need a tool that can be used to tell us whether it's trending or not. And in my world, I use the DMI. So let's have a look at an example here. We've got Amazon on normal candlestick chart, 1 week. So there's a long period of time there to have a look at, but we've got this set up as a Heikin-Ashi chart to just smooth out the data from a standard candlestick chart, and we can add the moving averages and change them around in this section here. You can see we've got 50, 209, 20, 100 all set up, and we can unhide them, hide them. We've got the short term 9 period here. We can see how that interacts in and out the price. As we move out in time periods, we've got a longer term indicator, and as they cross through the price, we can actually then see whether it's a buy or sell opportunity, or it's trending or it's not trending. So above is the price is up, and vice versa. So we might want a longer term look at the things, what's going on Amazon, and we've applied a 250 moving average here, and the price is definitely above both in July, so I'd be more bullish. And then we could maybe use the 9 moving average to time our way in and out of a potential trade. And here's just some examples adding on further moving average time length indicators to mix up. And as you can see, you can create various strategies around this. So these moving averages paint a picture of a trading cycle. And you may have heard of the Turtles. They use a 4-week monthly cycle to create a Donchian strategy, and they made a fortune out of trading that. So some final notes on the moving averages. Pros, really helpful in finding the trend direction. It helps you let profits run and you cut your losses. Good for support and resistance, entries and exit, and really strong for trade management. As we will see, cons, doesn't always work in non-trending markets that well, and people often optimize it and get in trouble because of that. So just quickly going back to show you how to put the moving averages on so it's cemented in. it's our example in front of you, the US dollar, Canadian dollar, but I've switched it back to daily. You can see actually the trend of the US dollar, Canadian dollar has been down. So we want to add moving averages. We go up to indicators, we type in either moving averages, or you can save them as your favorite. There's different types of moving average. We just want the standard one, moving average. We click it once to get 1 on, twice, 2 on, 3 times, 3 on. Okay, and then we can go up to the settings. Say we want we'll go the first line red, make it nice and thick, and we want a 50 moving average. We just change that to 50. And there we go, and we want a faster one, a 10, different color, then blue, thick, and there you go. And you would keep doing that until you were happy with the moving averages that you've got on your chart. But that's just a quick example of showing you how to put moving averages onto your TradingView charts, and it probably be a very similar way with any other charting package. So to finish off moving averages, we've got some work for you to do. So go away to your charts, any chart, long, short, medium term, whatever market, and try applying the moving averages onto the charts. Try 1, try 2, try 3, try crossover combinations, and see what results you get. Also play around with the lengths. We've got our standard like 20, 50, 100, 200. See what happens if you move them around, what you can achieve, and see if your chart package offers different types of moving averages, and why not align those together to see what different results you get. For example, you might compare a standard moving average against an exponential moving average, which would have more weight assigned to the front of it. So you could get some differences there and some different signals and trading ideas, and then add moving average based tools onto your charts. For example, MACD, that's an indicator that we're going to look at shortly, and see how they can help with possible trade entry and exit decisions. So the takeaway from moving average section is that moving averages are a fabulous tool, but don't always work, especially in sideways moving markets, as we will see later in this course, and we'll try and answer that question of what tools to use in either trending or sideways markets. We're going to take a look at band-based indicators, and these are bands around a price range around the original price, either above or below. They overlay the price on the chart. They can be based on percentage, statistical measures, volatility, and they'll move with the flow of the price. And we're going to look more particularly into Bollinger Bands, and these are bands that are placed around a moving average at default 2 standard deviations away. And what does this allow us to see? Well, it allows us to see 95% of the price action, and as a general rule, prices are thought to be overbought when it hits the top of that band and oversold when it touches the downside. Although, as we'll see, that's not necessarily the case in all instances, but they're a great tool for targeting, maybe as a strategy, those band levels. So here's an example with gold again, a Heikin-Ashi chart. So we're now going to add on the Bollinger Bands, and we're also going to add on top of that Bollinger Band width indicator. There we go, both are on there. We've got the upper band, lower band, and what we call a basis line, which is that middle moving average period. That's normally set to 20 as default, and the 2 bands to plus minus 2 standard deviations. And the bandwidth there tells us how fat or thin the bands are actually going, which can give us a pinch point in price action. Normally can explode out after a narrow ranging bandwidth, as we can see in the example there. So you can play around with the inputs into the Bollinger Bands if you want to create a more specific strategy, and we do that by simply going to the settings and the inputs. You might want to up the standard deviations that you're looking at. You might want to expand the length of the moving average, and then all of a sudden you've got a completely different look to your Bollinger Band chart. You've got a pinch point there, but like I said, it's up to you the variables you use, but try not to backfit the inputs. So we can see how the price bounces around in our new range and how the bandwidth expands and contracts as another measure tool. And here's a typical example of, in a longer term, how that pinches and then breaks up to a more bullish move. But we don't actually know from the Bollinger Band which way it's going to go. We just know that it is going to move, and that's why we'd have to use other indicators along with it to confirm the actual move of the price. So to summarise the Bollinger Bands, that they're very good at creating support and resistance levels, and you could use maybe the moving average in the middle as a trailing stop level. They're much better at determining the beginning of a trend and not trading between them, and when the bands tighten, that can often signify an explosion in the movement of the price, although we don't know which direction. And a little tip there then, if you adjust the moving average, then it's a good idea to adjust the standard deviations. For example, a 50 moving average, you might want to make the standard deviations a bit bigger, 2.5. A 10 moving average, take it down to 1.5 standard deviations. Donchian bands, you may or may not have heard of these, but if you've ever heard about the story of the turtle traders, which I thoroughly recommend you read, especially for your education in the world of trading, then they mastered these bands and made a fortune from them. They're one of my favourites, and I use a manipulated version of them to do my trading and some of my strategies, but it overall is really simple concept. It's just a price channel type of study, and you can use it for entry and exits. It's available on most charting packages. I use it on TradingView, but the example in here is from eSignal, one I used a while back. It can be used across all markets, and the founder of this study is a Richard Donchian. Now, normally in most packages, charting packages that is, the Donchian bands default to a 20 period moving average, and that establishes bands that plot the highest high and the lowest low. And because of this, signals can be produced to trade, and a buy or long signal when the price action is greater and closes above the upper band, and a short sell signal if the price action is less and closes below the lower band. It's as simple as that, but you can make it even more effective if the Donchian bands has an offset functionality, and normally I'll be using this, and I use a 5 or a 10 offset to create entry signals, a bit similar to the Ichimoku idea if you're aware of Ichimoku, but we're going to have a look at an example now to show you exactly what I mean by that. So here we've got a 30-minute FTSE 100 candlestick chart. I've overlaid the Donchian band indicator on top, which are the blue lines, the upper and the lower. It's a 20 Donchian, but I've used a 5-bar offset. And what does that mean? Well, if we look into where some of those arrows point to the upside, they give you, by moving it with that offset, a more obvious entry breakout point. So I really like the Donchian bands for breakout trade strategies when they're moving outside the normal 20 period range. But again, you can not offset the numbers, but you can manipulate and change those inputs to create more effective, faster, slower strategies, longer term ones, experiment and have a play around and see what you can find. But donking bands, highly effective. Now our third type of band is the envelope. It's a simple approach, and often it just uses a percentage type amount to work out the bands, and you can have 1, 2, 3%. You can have what you like. You can back test it. You can have a look into what you think suits what market or time frame. It's mostly used for a breakout type system approach, and when prices go through the bands, these envelopes, then it's normally either a buy or a sell signal. And some like to trade within the bands. If the price isn't going to go outside those bands, they're wide enough that it's like a ping pong ball and it bounces in between them. Then there's a strategy to buy and sell at the highs and lows inside the band. And its obvious flaw is it doesn't take into consideration volatility of what is going on or what you're analysing. So a 1% band on FX might be appropriate, but on a stock on the US Nasdaq that's moving all over the place, it could be quite dangerous and give you false signals. But we'll take a quick look at an example now. Now here's our example using Vodafone PLC, a large UK company. It's got a 20 period moving average to create the 3% bands. That orange line in the middle there is that 20 period, and you can see the price interacts mostly within the bands, but every now and again it does pop out, and you could have a strategy on that breakout to the up or downside, or you could have a strategy that says the price stays within the bands. That's for you to play around with and find out. So here we have the FTSE 100. It's a daily chart. How do we find those bands that we've been talking about? Up to the indicators. I have Bollinger Bands set as a favourite anyway, so other than that you would type it in Bollinger Bands, click on it, and it pulls it in, and we then mess around with the inputs by changing the settings. You can change the colours, change the standard deviations and lengths in there. So that is the Bollinger Band. And to find the Donchian bands, exactly the same. We type in Donchian up the top. There it is, Donchian channels, and notice below there's a lot of different derivatives created by individuals around the Donchian idea. There we go, we put them on, and again we can change inputs if we want, but that's standard setup. And I've just done the same thing to add on the envelopes, and you can see that's how it overlays on the FTSE 100. Change the settings. We're talking about lengths and percentages. We want to tighten that in. 5% band on the daily. You can actually see a lot of the FTSE price does stay well within that 5% range, so that could be a strategy for you. So there you go, that's how you would put them on your charts, and again it's going to be the same across all type of chart packages. Finally, a band exercise. On the bands, go to your charts, put on those 3 different types, see what sort of results you get. Again, they work in all markets and time frames, so have a play with them and look how, and have a think how those bands could aid your trading, and try and come up with ideas how you could use them. So the big takeaway from the bands is that understand that bands are a very good way to capture the volatility in the range of any given market you might be looking at. Remember that I said that moving averages don't work all the time, and we need to know when a market is trending or ranging. Now this is what we're going to look at now, and remember that markets trend only 1/3 of the time. That means there's 2/3 of the time when they're not, and we need a tool that allows us to filter whether it is or isn't, and then on top of that certain indicators work better in certain time frames. So you can do this very many sort of different ways, and you can look just by an eyeball test, mathematically, some rule-based approach around moving averages, and there's even indicators like parabolic SAR that I've used, but the best one in my opinion to use is the directional moving indicator, and it's developed by J. Wells Wilder in the 70s, and he just wanted to work out some more mathematical, systematic way of being able to measure such a thing. And it's made up of 3 parts: the plus DI, which is the upward trend movement, the minus DI, the downward, and the average directional movement, which gives you the trend range. And it's normally set to 14 periods. And the basic rules behind it: when the DI crosses, the plus DI crosses the minus DI, it's put long position to be taken, and vice versa, minus through the plus DI, and greater than 25 ADX, it's trending unless it's ranging. And if you're long, the reverse point is the low made on the day of crossing. If you're short, the reverse point is the high made on the day of the crossing, and the ADX is greater than minus DI or plus DI, indicating a turning point, and when ADX is less than both DI lines, stop trading, get out. I want to show you on gold though what that looks like, and then how I develop the DMI further to be more effective for trading in Renko. So we've got a Housekeeping chart, 1 day gold. We're going to search our trading view charts for the directional movement indicator. We've put it on. We see our pink line there, which is set to 14. That's the ADX line. We're just going to make it a bit more visible for you. There we go. So we've got our DI plus line, the bullish line, the blue one, the bearish one, the orange line, the DI minus, and our ADX trend filter. That you can see at the moment is pretty high, around, above 40, meaning we're in a strong trending market. But we can also see that the crossing at the moment, the two lines, which could signify a trend change, and here we have an example of such a happening when it started to turn more bullish. I like to use it without the ADX though, as a simple crossover tool. So when the blue's above the orange, it's bullish, and when the orange is above the blue, it's bearish. And you can see what happens when they cross. They then create a more powerful trend change indicator. And to finish off our section on trending and ranging markets, a DMI charts exercise for you. Add the DMI indicator onto your charts. Experiment with different setups with the variables on the indicator in different time frames and markets. It works nicely across all of those, by the way. And see how it can help identify a ranging or trending market, or even play around with the adaptation that I did about taking out the ADX and just using it as a crossover system to give me buy and sell signals. Now I promised that we'd look at Fibonacci in a bit more detail, so here we go. So there's a lot to it, but all you really need to know, it's all about behavior and psychology, and also about human and market interaction. It is in essence a self-fulfilling prophecy as to the reason why it works. And if you want to get back into the nitty-gritty of Fibonacci, then you can do, but you might have seen it when you throw a stone into a pond. The ripples are all Fibonacci, and it has been used throughout time in all sorts of application, architecture, etc. But it does work, however strange the concept is, and it works in all time frames. And that's really because technology now has made it very easy to use this type of tool over your charts, and everybody is doing it. The key numbers that you need to take away from Fibonacci are 0.618, 0.382, and the 0 and 1 lines that you use to find the high and lows. And it is a great tool for finding support and resistance points. That means it's very good for our risk management and trade management of our trades, and is placed on top of the price chart. And all you need to know is where the low and the high are. And this is the problem of Fibonacci. It's very discretionary, but everyone's doing the same sort of thing. And here you can see on the FTSE 100 here, these arrows are around the points of Fibonacci lines, and the price just keeps bouncing to and fro around these lines, proving that the Fibonacci lines works. And I could show you hundreds of charts like this. They just work. So all you need to do is find the obvious high and lows of the trend and then place the Fibonacci around these points, and then that will draw the lines in between for you. And as you can see on the FTSE 100 there, it was a great tool to use to find support and resistance levels. So how do we create the Fibonacci lines? Well, they're placed, as I said, on top of the price, and these lines are created automatically, but you've got to find the high and low. And I like to use a 3 different time period setup to create a more accurate Fibonacci picture. But like I say there at the bottom, all charting software should have this Fibonacci functionality now. It is very common, used in all sorts of markets and types of trader. So this is my 3-step approach to setting the Fibonacci lines, and we've got here the FTSE 100. It's a daily Heikin-Ashi chart. You can use this approach across all charts, Renko, line break, Kagi, it works everywhere. And first of all, we need to break it down into time periods of the short, medium and long term. So I start with the long term first and go back over the previous year and look for the obvious highs and lows, and we can see at the beginning of 2020 and to the spring of 2020 look like that obvious highs and lows. So we find our Fibonacci setup lines, we draw them on, we've got a nice double top there on the FTSE 100, we draw them back down and to the low we place them like so. And that's our long-term support and resistance setup. And is there anything obvious that we can see at the moment? Well, there's around this 5,900 area, there's a lot of noise at the moment, both to the upside and the downside, support and resistance. And then below that, maybe 5,450 around here, and again up here at 6,570, 6,600 zone. So that's the long term part of the equation done. Now we go to the medium term. So that's like the last 3 to 6 months, maybe. Well, from 0 to 6 months. I like to look just in case there's some obvious nearby highs and lows. But if we go over that period, and remember this isn't 100% exact science, okay? So if those highs and lows appear just to either side, don't worry. Of those time bands, don't worry too much, because this is a very discretionary, subjective approach using Fibonacci. So part 2, again, we're going to look for our highs and lows. So I can see this one back in June, and the lows maybe, if we're going to take down here in September. So that's going to be our next zone. So again, we draw on those Fibonacci lines. Actually, because the price has been ranging for a while on the FTSE 100 in between this 5,760 to 6,230, these bands are going to be tight, and it's starting to look a little bit messy, and it's going to get messier still because we now move on to the third part, which is to then draw on the short term stuff. So 0 to a month or so is plenty. Any short term obvious action, well, the lows are as of the part 2, and the highs maybe here in mid-September, so we draw that on. There's our highs down to the lows. Now at the moment that looks a complete unreadable mess, so what we do then is zoom in on the chart, we pull it open. And what we're looking for is overlaps in those 3 time periods, because I believe the more those different subtimes, the long, medium and short overlap, the more important the numbers are. So we've got double overlap here, double overlap there, double overlap there. It's close here, so these are where I'd be taking important numbers for. So we've got 5760. We've got this overlap here at 5950, another one up at 6140, 6230 and 6355. So I'd be using those as either support or resistance, for stops, targets, to give me a more, I like to user friendly Fibonacci, and I think more accurate way of using Fibonacci for setting those sort of levels. So I hope that gives you some idea of how you can use Fibonacci in your trading, and especially for trade and risk management. So to conclude Fibonacci, a bit of homework for you. Firstly, take any daily chart in any market and find the highs and lows in the short, medium and long term. Then create that three-way process that I do that over those different time frames, and see how the Fibonacci's line up and provide support and resistance levels, and these in turn create entry and exit points for possible trading strategies. And note if any of the three different Fibonacci setups you put on your chart overlap, and those overlapping points can signify even stronger, more important support and resistance areas. And the takeaway, again, a very subjective process, and there's no right or wrong high low points, but always look for the obvious. Now, pivot points are another great direct price analysis tool that I like to use, and they're very similar visually to Fibonacci lines. The calculation is different though, and the way they appear on the charts is more automatic, but I find them one of the best tools for trading intraday FX or stock market indices. They are useful in other markets, but in particular those. And like Fibonacci, they give you a roadmap around support and resistance levels, and they're a bit self-fulfilling as well, because other users in the professional arena like to use them, and because they are automatically laid on the charts, those numbers become like magnets of price action. And in the consequence of that is that the traders use these pivot points to anticipate future short-term price action. They can be used in the longer term, and I'll show you some examples later, but normally when it goes longer I like to switch back to the Fibonacci lines. And the main use of pivots then is to show very clearly levels of price and support and resistance, and this information can be interpreted and used as either price targets or very good for risk management, setting stop levels. Find pivot points great under 240 minutes, that's the 4-hour chart. Anything greater, like I just said, switch back to Fibonacci, and these pivot points are placed on top of the price. They're a DPA tool. Now, the pivot point calculation is very simple, and you shouldn't need to worry about it too much, but it's always good to know how it does work, because there are different types of pivot points you can use that use slight different setup. But the starting point is the main pivot, and in here I call it PP, and that is just basically the high plus the low plus the close divided by 3. That gives you your starting point line on the charts, and then there's further support and resistance levels calculated to the upside and the downside based around that main starting pivot point, the PP line. And there's the calculations for them, and some pivot points go out much further than that. The S's support are resistance, so that's our up and down side, and some go out to S4, S5, and you could in theory go out further and further, but that's the general calculation for basic standard pivot points. So here's a quick look at those key pivot point levels. This is a Euro US dollar foreign exchange currency 30-minute chart, and we've got the pivot points plotted on there, and you can see how they form. The P line down there on the right hand side being the central, and then we've got the R to the upside and the S downside, and each one of them you can use as a band of support and resistance or targets, and we've got a bit of support and resistance going on, so in the middle part of that day on the Euro USD. But that's what they generally look like, but they are very flexible and you can tinker with the inputs and the different types to use to give you different types of results. Here's another quick example on the euro against the Australian dollar currency pair. It's a 15-minute chart, and again it's just showing you how on the day on the left the price hugged the S1 line, and then it moved on up and broke through the main pivot point, and then the start second day didn't want to go above the R1 line above the pivot point before coming back down. So we can use these charts with the pivot points on as like price magnets. Now there are some important rules around pivot points you're going to need to be aware of, and don't worry, with practice they'll just become second nature, but I'll quickly go through them and you can study them again afterwards. But if the opening price is greater than PO, that's the PP central line, then we are looking for long trades. If the opening price is less than, we're looking for short trades because we're trying to put probability on our side. Trend identification of the longer term is important because often if the market is ranging, the price will fluctuate between the central PO line and the R1 and S1. With a stronger trend, pivot levels are more likely to be broken, and profit targets are often the next level up, and stop losses are set the other side of the pivots or behind moving averages or trend lines that you put on top of those pivot point lines anyway. And never anticipate a breakout or reversal of a pivot point. Front running can often lead to disaster or trade going wrong. Wait for confirmation. How can we do that? Well, that could be based off of price, action, momentum, strategy rules. We're going to look at some of those setups. We're going to use timing indicators like stochastics in the next section. News can be a killer, and that can be economic news coming out during the day, so you've got to be aware of what is going on. And if there's no news activity, then often the price will range between R1 and S1, but if there is something happening, it can jump through up and down the pivot points very quickly. On the open, if the price is greater than S1 or R1, there's a high likelihood that the price will mean revert back to PO, PP, the central line, and at S2, price with a high probability will head back to S1, and also the same for R2 to R1. S2 and R2 are perceived as the collars of the day activity, and in strong trends news the price can go higher, but they're normally the boundaries, and then the price heads back to the central PO, PP line, and often you can get a second bite at the cherry, so don't panic if you miss it the first time. What about a trading strategy using pivots? Well, I advise combining pivots with indicators for a stronger, more probabilistic approach, and in the example below we've got Euro AUD currency pair 15-minute chart, and on top of that I've added Bollinger Bands on top of the price, the DPA that we looked at earlier around Bollinger Bands, and below that, which we'll look in the next section, an RSI indicator. Now they're going to give us rules, and if those rules are happening at the same time to tell us to get into a trade or out of a trade, and it confirms with pivot point action, then we're going to take that trade. It also helps us allow, with the pivot points and those other indicators, the pivot points we could use as our risk management stop loss approach and the target to the trade to see whether the risk reward is there for us in that trade. So let's look how we can put them onto the charts. Here I am back in trading view again. I've got the pound against the US dollar currency pair. It's a 15-minute chart, so it's quite fast. It's about 3 or 4 days worth of data. And again, we go up to the indicators, you type in pivots, or you save it in your favorites like I have, pivot point standard, click on that, and voila, you have the pivot points overlaid on your chart. Now we want to make sure we get the correct settings for these, so you can either go up to the left hand side and hit the cog to change the settings, or you can right click on the pivot points to bring down the settings box, but we're going to click there, and this is going to tell us what type of pivots we got. And as you can see, there are quite a few, For the moment, I suggest you sticking with traditional or classic, but over time learn about these other ones. The Fibonacci one's quite useful as well. Now, pivot's time frame, we can have longer term views. Now, if we're in a 15-minute window, I suggest daily, but if you want to hold on to that trade a bit longer, you could go weekly, and notice how those lines have changed, because now it's looking back over the last 5 days of trading data to calculate the middle PP line and the subsequent pivot points around that. But for this example, we're going to set it to daily, and there's our roadmap, and we can change the colors and styles, and we can turn off and on the pivots as we want. We're going to leave it at that, and we're going to hit OK, and instantly my eye catches this PP line here, the support and resistance on the 23rd, here again on the 25th, and it's hovering around that bottom one there. Look at the way that it bangs up or hugs lines. It's a very good tool. It's like a magnet. So that's how we play with them on the charts. And just one last thing, we can go through the time frames, make it a bit longer. Again, those pivot points are going to stay there. I suggest once you get out to maybe say, I don't know, you're looking at an hour chart, you might want to change the pivot points there, because there's quite a lot going on. They are still relevant in the daily setting, but you might just want to change the input to a weekly to give you a longer term trade. So there you go, maybe they're your targets for a longer term trade with a higher time frame. So there you go, that's pivot points within the charts. Right, to round off pivot points and exercise, now add traditional standard pivot points to your charts, markets, do the different time frames, 30, 15, 5 minutes, and see how they provide support or resistance levels for the price action. And most pivot points default to the daily setup, but if you can, change this to weekly and see what happens, or even monthly, and see what happens to the price lines, pivot lines, and sets out new objectives and targets for you, and just play around with the different type of pivot points. So takeaway, very useful and popular tool for finding support and resistance levels across time frames, and also very, very good for strategy creation. What is Ichimoku? It's a very unique trading tool, and it can be used on any asset, on any time frame. So it's very flexible and adaptable to any markets and conditions. And like I've mentioned previously, you know, to the outside observer, at first look, it is a bit of a jumbled mess, but like I say, we've got to understand what that mess is, and once we do, it becomes very transparent as a system. And also very straightforward in fact to use, and it's I would term a good all-rounder trading system, and if you can apply it consistently, then you can certainly boost your trading results. So what does Ichimoku mean? Well, it means, translated, just simply one look, and it makes sense really, you know, all that information in there in one place at one time to give you a decision whether to buy, sell, or stay out of any potential trade. So looking into some history of Ichimoku, well, it was set up in the 60s by a journalist in Japan called Goichi Hosoda, and he was a journalist, and he was trying to be able to analyse all this information on the markets in one simple place, and to relay that in a certain way that people could more easily understand. It's also known as Ichimoku Kinko Hyo, which you might hear it as, and it's quite simply just a collection of technical analytical techniques used to determine the trend, the momentum of the market, and support and resistance levels, and also to give you trading signals and entry and exit points. So to me and anyone looking at this course for the first time would probably say then that all your trading bases are covered. What does Ichimoku look like? Well, here we've got a chart on gold, and I've overlaid a simple candlestick chart with the Ichimoku tools, and this is now what we're going to look into and try and understand what each one of these separate parts that have been added actually means, how it's constructed, what it does, and what it means for your trading and investing. Let's dig more thoroughly now into the basic construction of Ichimoku. Well, it's made up of 5 indicators, and they all have their own unique names. And to start with, they were talked about in Japanese terms, but now they have more generic names, which we'll look at in a minute. We have the first one, the Tenkan Sen, then we have the Kijun Sen, then the Senko Span A, followed by the Span B, then the Chikou Span. And what you've got to note is that those Senkos, the A and the B, create what is known as the cloud, which is probably one of the fundamental parts of the whole system. And the cloud also has a Japanese name, also known as the Kumo. So in terms of terminology, like I just said, well, I like to keep it traditional and use those Japanese names because they stick into my head quite easily. But if you want to know the English equivalents, or say what you'd probably find in a technical analysis package, well, translated, the Tenkan Sen means conversion line, the Kijun Sen is the baseline, the Senko Span A is now known as leading span A, Senko Span B leading span B, and Chikou Span is the lagging span. But like I say, I like to use the Japanese as it sticks into my head better, but that's totally up to you. So where do the 5 indicators fit on a candlestick chart? So we're going to use Trading View inside this course to understand Ichimoku, and we're going to take a quick look at how they fit in. Well, here we have a snapshot of the S&P 500 US stock market index with the Ichimoku inputs overlaid onto a Heikin-Ashi candlestick chart. And as you can see, we've got our red line as the Kijun Sen, the baseline. We've got the Tenkan Sen, the conversion line. We've got the green line, the Chikou Span, the lagging span, and we've got the Senko Span A and B, the green and the red lines there. And you notice that that gap in between them is filled in with a colour to denote either bullish or bearish situation. We'll explain how that works in a minute, but that just gives you a simple overall picture of how those different inputs, the 5 inputs, fit on your chart. We've got important tip and something you should be aware of, that trading timeframes for Ichimoku, really the system works in all time frames, but I found through trial and error and practice that you'll find it easier to start in the higher time frames. And what do I mean by that? I mean the daily, weekly, 4-hour charts, until you get the experience and practice to move into the lower time frames, like we call them the intraday, the 1 hour, 30-minute, 15-minute, even lower. If you want to use Ichimoku, it really needs a bit of experience and practice before you get down into those lower time slots. And another important point that we've got to bear in mind here is that of the inputs of the 5 indicators are always set in any charting package to their original default settings. But as we'll again come to see later, there's nothing to stop you manipulating those settings to maybe create a new strategy. And is there something special, why are they set at these some would seem odd or think odd numbers. Not really, they're the ones that Hosada thought worked best for his system, and they work for him, so why would he change them? But we've got the opportunity now with the software that we use to do such a change and enhancement. Before moving on, I just wanted to quickly show you in the trading view charts how you can add Ichimoku onto your underlying chart, and also how you can access the different parts of the Ichimoku system. So in front of us now we have the gold chart again, and actually I have the Ichimoku system already on there, but I'm going to remove that just by clicking on one of the parts of it, hitting remove. So now just going to show you how to add. You go up to the indicators box, you find Ichimoku. I actually have it set as a favorite. Click on there, it's instantly overlaid. Now a quick way to change the inputs and find out what they are is just to click on again one part of the system, go to settings, and all of a sudden you can see what we've been talking about so far: conversion lines, baselines, lagging spans, and the displacement, i.e. the forward look of the cloud. And you can overwrite these variables in there. You can also add, take away, like I say, and change the color enhancement, do pretty much what you like to the system. So this is important to know for when we get into later parts of the course, when we're trying to manipulate the current setup. So onto the Ichimoku cloud, and you might remember that Senko span A and B form the shaded area known as the cloud, or to give it its original Japanese name, the Kumo. Now the Senko span A and B's inputs look something like this, not too complex in terms of maths, but the Senko span A is the Tenkan Sen plus the baseline divided by 2, and Senko span B is the 52 period high plus the 52 period low divided by 2. All pretty straightforward and easily doable in your chart. So let's take a look at an example on the S&P 500, and you can see quite clearly the A and the B lines that are then the gap in between that is shaded in, and that's what forms the cloud, aka the Kumo. So moving on to the conversion line and the baseline, and these are used, to identify sort of faster in and outs of potential trades, giving you more frequent signals. And what you might recognize them as is something similar to a Western moving average crossover system. It's a bit different, but as we'll see in a moment. But the inputs to the conversion line and the baseline, the conversion line, known as the Tenkan Sen, is the 9 period high plus 9 period low divided by 2, and the Kijun Sen, the baseline, is the 26 period high plus the 26 period low divided by 2. Now as you can see, those inputs, they're not quite like the standard moving average that we're used to, and it's an important point to take on board, because this is looking at the highs and the lows based as an average rather than just the closes we would probably look over in the West. And because of this, it gives you maybe a more comprehensive picture of that time period, that 9 and 26 periods, and that in turn makes it a very good tool for finding support and resistance levels. So let's have a look on the chart again. We can see the red and the blue lines, that's our Kijun Sen and Tenkan Sen. We'll learn how to use them shortly, but first of all we want to see how they lay on top of our chart. So now onto the Chico span, also known as the lagging span, and this is seen as the link between the current and previous trends of the market you're analysing and inputs wise, it's based on the closing price plotted 26 days in the past. And as an example, here's our S&P 500 chart again. The light green line that's highlighted there is our Chico span. Let's now take a look at the basic Ichimoku trading rules, and what we're going to do here is we're going to put them all together in one place. We're going to consolidate them so it's easier to use going forward and to understand. It's all like a mini library of rules, if you'd like to think of it like that. So let's go first to the cloud, and that includes, as we know, the Senko A and Senko B lines. And simply, if the price is greater than the cloud, it's bullish. Less than the cloud, it's bearish. And remember that when the span A is greater than span B, a bullish cloud is formed, and vice versa. If we're going to get into the micro analysis around the rules, we look for the widths and the angles of the cloud, and we also need to use the forward cloud to utilize support and resistance areas, and to get some sort of gauge as to future price direction. And on top of that, we're then going to use a conversion and baseline, and they have the simple rules of if the conversion line is greater than the baseline, it's bullish, and if the conversion line is less than the baseline, it's bearish. And if we want the stronger, more reliable signals, then we want our crossovers to happen either above or below the clouds to give us that bullish or bearish extra strength. And then finally we have the lagging span, and we're going to look back at that to see where it is in relation to the price. And if it's greater than the price action, it's a bullish signal. Less than, it's a bearish signal. And if it's found with the candlesticks of the price action, it's neutral, so it's probably telling you to stay out, stay clear, or stay on the sidelines. But essentially though, you can choose how you want to use this. You can use all of it, parts of it. You can have sub strategies. That's what makes it such an exciting setup. Is it's very adaptable and flexible to very, very many different types of ideas and strategy approaches. So to end the Ichimoku section, a little exercise, a bit of work for you. Firstly, Ichimoku, it's all about getting familiar with the different parts of the system. So go to your charts, put it on a daily setting and see how you'd interpret the results. Play with different markets, stock markets, currencies, commodities, whatever. Have a play around and then dig into the component parts, turn them off and on inside your trading package, whatever that might be, and understand how you can use these individually to support your analysis or turn into strategies or new ideas that you might have. For example, the cloud could be used as a long short trend tool. For example, if the price is above the cloud, it's long, and below short. Simple as that. That could be one of your rules. But the takeaway from Ichimoku is to understand that it's a great one-stop trading system in its entirety, or you can use it very usefully as a sub-component part to your trading and strategies. We've covered a lot in section 3 on direct price analysis, and you've now got a good insight into the selection of tools available to analyse the price action directly on top of the chart, and hopefully now you're starting to see how things are pulling together. So it's giving you options in your trading, strategy ideas, markets to trade that suit certain indicators and tools. But don't panic though if you're not getting it at the moment. We've still got a long way to go, a lot more to learn. But let's recap now section 3 in a bit more detail. Trend, support and resistance. You now know about understanding that trend allows you to conclude which direction you think the price will move in more objectively. Trend analysis allows you to decide whether to go long, short or stay out altogether. It can be used as a trading system by itself, Now, on top of trend analysis, knowing where price is going to head to or not is critical for your risk management. When you're setting up entry, exits, target points, stop losses, all those detailed trade management variables that you need, for example. And combining trend line with support and resistance analysis gives you further power, more powerful combination of tools to get you started in the analysis of any market or asset you are looking to trade or invest in. Now, patterns and price, they seem a bit strange to start with, but once you dig into them and understand what they're there for, they are also another useful addition to your analysis because they have a strong predictive ability of future price action. The frustrating part is they're not an exact science, it's quite subjective, but I suppose the general rule is that they are very difficult to rely on by themselves. And as we go through the next sections, you'll see how you can add other indicators on top of that chart action, the patterns on the price, to give you much more stronger probabilistic trades. Moving average is another great simple tool, one of the more popular ones in technical analysis, and they make your decision making more objective than subjective. And it's a tool that helps support the philosophy of technical analysis around the concept of market trending. And some traders and investors use only the moving averages and those oscillators built around them, which we'll see shortly, for their strategies and trading. The problem with moving averages, as we now know, is that markets don't trend all the time, and in that period when they're not trending, they become a pretty useless tool. So you really got to know what is going on at that time, and we did see a tool to help us with that. But another weakness is that the moving average misses, because of the way it's calculated, a big chunk of the price action at the start or the end of the trend due to its calculation process. But luckily again for us, we've got tools that can help spot such situations. Now, bands start to give us a whole new dimension to our analysis, and they're very useful for capturing volatility of any market that you're looking at and the trend and range of any instrument. And they can be very effective standalone trading systems by themselves or in addition to or with other tools. And results from using these tools can be even further enhanced by marrying them up to non-technical analytical tools, sentiment tools, for example. If you're looking at commodities, a commitment of traders report, currencies, currency strength tool, stocks. There's loads of different sentiment type indicators you could use. And the big question we answered was, how do we know if a market is trending or ranging? And we came to the conclusion we could use a tool like DMI to help us make that decision. And that also supplements our analysis using moving averages, because if we know when a market is trending or ranging, we know when or when not to use a moving average. So we also learned that the DMI can be tweaked to create its own strategy setup, but it is a really good tool, the DMI, for, like I say, answering that question around trending or ranging. Fibonacci, at first glance, it seems a bit strange, a bit weird, but hopefully now you can see how useful it is. It's great for finding support and resistance levels and possible targets. It's great for risk management. I say it might seem a strange concept, but it does work. Pivot points are like Fibonacci in their appearance, but I really do like them. They're a fantastic tool for letting you anticipate future price direction, and very useful for trade management. They're like magnets for the price. They're used professionally to great effect, and you can use them now very easily in your own trading, and very good especially for intraday traders in highly liquid markets. And what I mean by that, forex, stock indices, more liquid stocks. And Ichimoku, well, it did look a spider's web, a mess to start with, but if you dig in, it is a fantastic one-stop trading shop. It's very useful for risk management, and your options really are endless with the Ichimoku tool. You can take it to pieces and add it to other indicators and tools and charts, or you can just use it on its own, and it is a subject to spend a lot of time on all by itself. In fact, I've got another course just on Ichimoku. It is a great tool, and it can be applied to all sorts of chart types, and it's worth your consideration digging in a bit further. So that's it for section 3. We've now covered off direct price analysis. We're going to move to section 4 now, where we're going to look at price confirmation tools, PCT, and we'll be looking at more specifically trend and momentum, and that includes trend tools such as the MACD and CCI, and momentum tools such as the RSI and stochastics. Section 4 is all about price confirmation tools, which I abbreviate down to PCT. That is an unofficial term, but it allows me to visualize where these tools sit in the context of the chart you might be analyzing, and these tools will all sit below the main chart, unlike DPA, direct price analysis, where all that analytical work sat on top of the price action. Now this section is broken into 3 parts. We look at trend tools like the MACD and CCI, then we look at momentum tools like the RSI, that's a relative strength indicator, and the stochastics, and we finish off with volume, volatility and sentiment, and then we conclude by looking how we can put these indicators and tools together under a rule-based framework. Now the trend, as we saw in the previous sections, around moving averages, Bollinger Bands, price envelopes, all great tools directly applied on top of the price chart to help us to distinguish the price trend. All of these indicators mentioned are great tools in helping us determine that trend in any given market at any given point of time. But in this section we're going to look at 2 indicators that are a derivative of the price action. They sit underneath the chart and are both also very useful for trend spotting. That is the MACD and the CCI. So firstly, the MACD, what is it? It's the moving average convergence divergence indicator, and it was developed by a guy called Gerald Appel, and it is a good indicator, but in my experience it's one of the slower signaling indicators, and it uses convergence and divergence of moving averages to come up with a leading indicator. See how much more complex these derivative of the price are rather than ones that are direct price. Why is it so popular and useful? Well, it combines some of the oscillator principles with a dual moving average crossover approach. So there's various applications that we'll look at on the charts more specifically, but in detail, you've got buy and sell signals when 2 lines cross, fluctuation greater than less than the 0 line around the oscillator principles, overbought when lines are too far above 0 line, and vice versa for oversold. And the best buy signals are when prices are below the 0 line, and crossing above or below the 0 line, another possible way to generate a trade signal and a possible strategy for you. So the MACD is useful in wide swinging markets, and it has something called MACD histogram, which is useful for following the trend. And when the spread between those 2 lines is widening in an uptrend, it means a strengthening of the trend, and when narrowing, that trend could be weakening. So there's many clues that the MACD is giving off for you inside its system. So let's set up the MACD on the charts. We go up to our indicators, we type in MACD in the search function, there it is, we add it on, and we scroll back just to get a bit more detail. Now we're actually looking here at the Nasdaq 100 US stock market on a daily setup, and here's our MACD. We've got our histogram, and we've got our MACD buy and sell signal lines, and we click into the settings, we can see what's their makeup. We got the fast length of 12 and we got the slow length of 26, and they're the default settings. And we got a signal smoothing line of 9, and these create the signals as they cross the two lines. We've got sell there at the top, and we got the buy when the blue crosses above the orange there. And it's the same when the histogram flips between the red and the green. It's a transference of, you know, the sellers to the buyers and the buyers to the sellers. And we talked about the difference between the two lines. As it grows, deviates, the trend is stronger. So at the moment in the Nasdaq, we've got a reasonable trend going on, and those best signals for buys happen when the cross is below, and sells when it is above. So we can see we had a cross here on the 24th of May as a buy signal on the MACD, because it happened below, the histogram flipped, we had the crossover, and off the price ran. So that's the MACD, and you can, if you want, change the input settings, play around with it, but I leave them, you know, as the default. So another useful trend-based tool is the Commodity Channel Index, the CCI, and it's designed to identify cyclical terms in commodities, but it can be used across markets, and it's very useful for identifying reversals and breakouts. It's like a bounded study between plus and minus 100s, and 70 to 80% of the price movement is between those boundaries. So if the study does go greater than 100, it's a strong advance, and then if it's less than that 100, then it's a strong decline. And a move from plus 100 equals bullish, and a move back under plus 100 is bearish, and vice versa. A minus 100 equals bearish, and a move back above minus 100 equals bullish. So it's a sort of same idea as most oscillators, but you know, some traders like to tweak further and use plus and minus 200 levels. It depends on what you're looking at and how volatile the instrument is. You can also use CCI for divergences, and we looked what divergences were right back at the start in some of the rules you should need to know. So here's an example of CCI on Diageo PLC, a UK company. We can see the two black lines, that's the bands. I've got them set to 100 and minus 100. As the price breaks up through the 100, we can see in this example, the trend carrying on. As it comes back to 100 and down through it, it then starts to deteriorate, and we have a sell-off, and then again that cycle moves back to buying. And this is why it's a very good cyclical tool. And you can see here it works on a stock, where you can apply it to commodities, futures, FX, indices, whatever market you're looking at. Now moving on to momentum indicators, they give us another angle in on things, and they're trying to answer the question, how fast or slow is the trend moving, and when is the trend going to change and reverse, if at all? And these two questions can be answered using specific momentum indicators and oscillators. And how can momentum indicators help you? It's all about timing. One of the most important things in trading, timing, whether you're going in at the right time or getting out at the right time. More specifically, what is it? It's the measurement of the speed or velocity or price changes, i.e. the rate of the rise or fall in the prices. And it's a bit like a car, you view it as the acceleration or deceleration of the vehicle. Here we're viewing it as the acceleration or deceleration of the price. It's also very important to note that momentum leads the price action. And how is momentum measured and used in technical analysis? I think you've guessed it, through the use of oscillators. We do need to know some basic momentum rules though. Peaks and troughs in an oscillator coincide with peaks and troughs on the price chart. So some oscillators have a midpoint value that divides the horizontal range into two halves. Normally we call that the zero line. And some oscillators have an upper and lower boundaries, and they're normally bounded studies between 0 and 100, but that depends on the oscillator, but they all have the same principle underlining them. And as a general rule, when the oscillator reaches an extreme value to the up or the down, this suggests that the current price has gone too far and is due for a correction. So to the upside, it's overbought and we're looking for a correction back down, and vice versa. If the market is oversold, we're looking for buyers to come in and the price to go back up. Another general rule is that a trader should be buying when the oscillator is at the lower end of the band and selling when at the higher. And the crossing of the midpoint line can also be used as a buy and sell signal. You don't have to wait till it gets to the overbought and oversold areas. And something also to remember is that trends do mean revert. So if you had moving averages on your chart, you can often see that price, after it flies away from the mean, it will come back to where that mean average is located. And that's also how you can use Bollinger Bands as well, because that's its principle. But a basic rule, when the price is greater than the long-term trend, it will revert back to the mean, so it's overbought. And when the price is less than the long-term trend, it will revert back to the mean and it's oversold. Why bother with this type of oscillator? Because they are also very good in a non-trending environment. So remember the DMI indicator, how it filters the ranging and non-ranging, and we know that moving averages are very good in a trending environment. These oscillators are very good in a non-trending environment. So if we know it's non-trending, which is almost 2/3 of the time, then we can deploy the right tools at the right time, and we can roll out the oscillators in that period. There are loads and loads of popular oscillators in this space: the Williams percentage R, ROC, rate change, basic momentum, the trended price oscillator. But we're going to look at two specific ones that are probably the most popular and most widely used. I use both of them as well. That's the RSI and the stochastic. The relative strength indicator is another of Wells Wilder's inventions in the world of technical analysis, and his basic thinking behind it was that in an uptrend, closes tend to be higher, and in a downtrend, closes tend to be lower. And please note that it only uses the closing price in its calculation, but it does smooth out the erratic and sharp changes in price. So it's sort of like a volatility calculator based off a closing price, and 14 days is the normal default input. If you want to speed things up, take it lower. If you want to slow things down, move it higher. It is expressed as a number between 0 and 100, so anything over 70 is viewed as overbought, and anything less than 30 as oversold. So what is it useful for? Well, identifying support and resistance levels, giving us overbought and oversold levels, as a strategy system in itself. Trend line breaks, but I like to ignore the 70-30 line that we talked about and just create a middle 50 line, and as it goes up through it, I call a buy, and down below it a sell. So here's gold again, our example from earlier. We add on the RSI from our trading view charts. There it is. We're going to format that quickly because they're not my sort of colours. There we go. We've put on the 70 and 30 bands. See how that works. We've got the 70 on the top and 30 on the below, and normally when it breaks above and comes back down, bearish, and vice versa for the bullish side. But it didn't actually happen many times over that period for gold, so I want to given you a very few signals to trade. So that is why I like to look at just the 50, and I adjust that by going into the settings again. So here it is with the 50 line placed on, and we're going to get a lot more opportunities to buy and sell as it crosses up and down below. I've also added on here a moving average, same principle as the 50 line, but it's just a bit more proactive in finding us trading signals, but used exactly the same way. As the price goes down, it's a sell and vice versa, and we can add on a trend line if we wanted to on top of the RSI. And again, same thing as the trend breaks, we might want to buy. The price goes up through the upside, it might be a buy, and vice versa. We can use the RSI as a very strong trading tool, and it works very nicely on the Renko charts, as we will see later. Now, the stochastic was developed by George Lane, and it's another great momentum indicator that shows the location of the current close relative to the recent X days price range on a percentage basis. And it's a bounded study, and the key numbers you need to know here are 80 and 20, and it uses high, low and close info. So it's sort of like a volatility, an average true range type calculator. So it's something different to the RSI that uses just the close, and this one uses a range of data, so the two can work nicely together to give you independent signals. It's displayed as two lines on the charts, the percentage K and the percentage D, and we smooth out that percentage D by, the normal default is 3 periods, and then that's called the slow stochastic. So there's two types of stochastic, fast and slow. Slow's the more popular version, and I think gives the more reliable signals. And what you're looking for is a cross of the percentage K and D lines, and from that we get our buy and sell signals. And we're also looking for the location of that cross. Is it above 80? Is it below 20? Because we're also looking for the the overbought and oversold conditions. Now I'm using TradingView for this example, and we're going to look at the 1-day chart of the Nasdaq 100, US stock market. And where can we find the indicator for the stochastic? Well, if you go up to the indicators button, type in stochastic, you are then going to get a whole load of information around other stochastic indicators, other derivatives of the stochastic that other analysts have put together themselves. As you can see, an awful lot of stuff in there, but we want the standard stochastic, and there it is. So you just click on that and it brings it up in the chart. So we can see our percentage K and percentage D lines, and the sort of coloured area here is between the 80 and 20, like I said, the important bounded areas of study. So let's just click on the detail. If you right click on that stochastic indicator, hit settings, we can then see it's set to the defaults, the 1433 that I talked about. Now if I just move that box over there, I said you can play around with the inputs however you want to, very easy, and just watch how the shape of the stochastic changes as I move the input. So I want to have a longer percentage K, I just keep clicking, and you can see how that moves. You want a longer percentage D, again, see how it's changing the two lines, and if I want to smooth that out further, how that also changes the data. So there are no hard and fast set rules to the inputs of the stochastic. The default 1433, but it depends on the markets you're trading, the time frames you're trading, and I try and make it as systematic across as many markets and time frames as possible. I don't try and back fit the number to work on markets. I try and get a more generic approach that works across markets and time frames. I find that works better, but experiment, back test the data, see what you come up with. So that's a basic look at how to put the indicator on your chart, and like I say, in this instance TradingView. But now let's have a look at how the actual rules of the stochastic work, and how we could use it for trading and potentially building trading strategies. Now the rules to the stochastic are both objective and subjective, and the subjective part adds in an element of trickery that makes it hard to use, but generally it's quite straightforward. Now on our chart here we have our stochastic indicator. I made it a bit bigger and coloured it out a bit so you could see it a bit better. Percentage K line's the blue one, percentage D the sort of orangey red one. It's set to 1433, and what we're looking for is the lines to cross, and preferably they cross in the overbought and oversold zones. Oversold at the bottom, overbought at the top. So here we have an example. The percentage K line has crossed back down, the percentage D line has crossed there, and that would be your signal to sell, and vice versa. We follow that down, it reverses back up, that would be our signal to buy. But preferably, like I say, we want to see these buy and sell signals in the 20 and the 80 area. But as you can see on this example, and it's a popular trading market, it doesn't often actually happen when it's, you know, so heavily oversold or so heavily overbought, and you do get a lot of signals inside that band. Now from my experience, I've seen that now those signals can still work very well. So that's one of the weaknesses of the rules, is you do get a lot of noise in between. Now, do you trade them or not? That's up to you, and I would suggest you've got to back test the data that you're using, or sort of make it a work in progress type of back test where you do some trading, paper trading or even live trading at a lower risk level to work out whether that works or not. If you can program it, even better. You can get the data very easily. It's not too complicated to take out this data and turn it into an automated approach. So one weakness there around the basic rules is what happens in that middle zone, and the other one, I suppose, is which catches a lot of people out if they're following the rules, and we can sort of see it here, is you can see we have this crossover here. You'd want to be selling. It's happened above the 80 line, and you know, if we're following the rules, we'd probably put our sell trade on. But just look what happens to the price. It actually continues to go higher, and this is the one big mistake that people make using stochastics. It's the subjectivity of the rules. So now we've seen the basic rules set up, let's look at that big one mistake in a bit more detail so you can start to understand it and factor that into your trading. So like I said right at the start of this video, this was my one big tip around the stochastic, and what it is the general rules of buying and selling when the two lines cross. Quite often, and I've seen it very often in my trading experience, is that that signal doesn't work. What you'll see is that that trend continues. You get a sell signal and it's in the above 80 zone and it just keeps on going, or vice versa, you get a buy signal in the less than 20 zone and it keeps on going down and down. How can we get around this problem? Well, we haven't touched on the sort of the movement of the indicators back through the, I suppose, different overbought and oversold zones. And on the screen here now we've got the Great British Pound against the US dollar currency pair FX market. It's still 1 day chart, but I'm zoomed in a bit on it just to give you a typical example. Now here we can see that the price has been trending up and we might be long from this signal. We've taken it in the middle of that zone, but we're still long, or for example, but we've got a sell signal here But as you can see, the next 8 or 9 days the price still continued to go up, and then a few days later we get another buy signal, so we might get back in, but there might be some costs around the trade getting in and out there. Then we get another sell signal, but guess what, that only lasts 2 days and it keeps on going. Psychologically, when you've been through all this, you might just forget to do the trades, you're put off by it. It becomes a bit of a mess. So what do I do to get around it is I actually wait for and remember this is all about momentum, is I actually wait till these lines go through. Maybe you can have one line, or you can use both lines, go through the 80 zone and back down, and vice versa. It would be the same for the up, but look what happens when it comes back down into the zone. The price then does come off. So my confirmation around here to try and get around the number one problem I see with using the stochastics, which is that the buy and signal crossovers just by themselves aren't reliable enough. You've got to factor in and use the 80-20 zone to your advantage, is to wait until those lines, or A lines, the K line, percentage K line, gets back into that zone. That's when I would close out the trade, and that'll allow you to run up that price. So that's my big tip of this video in using the stochastics. We've seen the basic rules. I wouldn't normally use the stochastics on its own. I'd have other price tools on top of the information there, or other indicators, or even other sentiment tools to confirm that. But stochastics overall is a good indicator to use, and now you know the main problem with it. Hopefully you can, like I say, factor that into your trading and analysis, and just by even applying that small adjustment and waiting for the percentage K line to come back into the 80-20 zone can save you a lot of frustration and make more money from your trades. So this is important to remember. The three most uses of our price confirmation tool are: one, when they're indicating they're overbought or oversold; two, when there's a divergence between the oscillator and the price action, which we also looked into in the rules in the earlier part of the course, the 20 rules you need to know, because it can warn of potential turning prices; and three, when the crossing zero line happens, it can also give an important trading signal as well. So they're just some of the indicators. Explore them and find them out yourself. I've given you the most popular ones here, but there are lots of other very useful known. But what I do know, what is known, is that when you combine both your price analysis and the oscillator analysis, it can hugely strengthen your decision making process. So to wrap this section up, an exercise on trend and momentum: apply each of the four tools that we've seen from MACD, CCI, RSI, stochastics on your charts. Try them on different markets, different time frames. Look for the overbought and oversold conditions and what happens when these occur. See if you can spot price divergences with any of the indicators, and look for those signals when they cross that zero line. And the takeaway from this part is that these tools are not 100% guaranteed. In practice they're not as clear cut as they would tell you in the book. So practice, backtest, observe, get experience before committing to them. Volume, volatility and sentiment, VVS. Trend and momentum tools and indicators help us to confirm the price action through specific price inputs. These three aren't based on price. They're going to give us independent supportive information to our analysis, and what is presented here, it's not an exhaustive list by any means. There's loads of volume, volatility, sentiment tools, I can tell you, but more of the generic popular ones. So what is volume? Volume is a measure of how much an asset has been traded in any given period of time. It's a very useful tool to aid our price analysis, and there are many tools that have been created around volume, and some of those are the McClellan, in and accumulation distribution, but in this example we're going to pick on balance volume. So what is on balance volume? It's the total volume for each day which is assigned a plus or minus value depending on whether prices close higher or lower for that day. So a higher close causes the volume for that day to be given a plus, while a lower one gets a minus, and then a running cumulative total is maintained by adding or subtracting each day's volume based on the direction of the market close. The direction of the OBV trend is the key and not the actual values. So if OBV is heading in the same direction as price, it's sort of like a trend confirmation, and when it diverges, this could be a warning of a trend reversal. So let's have a look at an example. So here's a very clear-cut example on Amazon, the US stock. Notice how its price has risen. We've got the two blue lines signifying the trend, but the on balance volume below has also mirrored the trend. So even in that small bit in between the two blue lines, we can see that the price has come off and the OBV fell. So it's been mirroring the price action, the OBV, which is indicating that those trends are in place. Now volatility is a very useful guide and creeps its way into many a technical analysis tool, and we can see them in Bollinger Bands and ATR, and there's other ones such as the Chaikin volatility measure. And understanding the volatility of an instrument can be crucial for your trade and risk management, and understanding how that asset that you're looking at behaves. Does it move quietly? Is it noisy? Is it random in its volatility? Is it more predictable in its volatility? A very useful tool to understand. Sticking with Amazon, I've got an example here of just the historical volatility of the stock, and we can see if we read off the bottom right numbers that the range of volatility, and that's the annual volatility, ranges between about 10 and 40%. So in terms of stocks, it's nothing too exciting, but notice how the volatility moves in conjunction with the price movements. We don't actually know the direction of the price move from the volatility, but we know things are either hotting up or cooling down, and we can marry that up with other tools to create a more robust strategy. Now these are tools I really like playing with in technical analysis, and they can be sometimes hard to find or use and can come from independent sources outside of your technical analysis platform. So you've got your price analysis and you might marry it up to one of these independent tools, and sentiment is, I definitely think, another area you want to look at. It explains behavior, it explains a lot of independent variables away from the price action, and it's a great way of measuring the bullishness and bearishness of any market. And they can also independently give warnings of turning points in prices and give us measures of extreme overbought and oversold situations in their own way. A special note here on equities stocks, when talking market sentiment, most think of equities and the many technical indicators that are around there, and we did look at market breadth, which could be classed as a market sentiment tool, but it's a bit bigger than that in the sentiment analysis arena, and we're going to look at 4 possible sentiment tools you might want to consider when looking at these particular markets. First of all, we've got open interest, which is very good and useful from the world of futures trading. And open interest is the total number of outstanding contracts held by market participants, i.e. how much interest there is actually in the asset that you're looking at. And because for each contract there's a buyer and seller, the OI on the chart is not the two added together but one side of the equation, and OI is normally presented below the price chart and is represented by a solid continuous line. So here in the table below, you can use this as a guideline for how to decipher open interest action. So price is up and the open interest is up, that's a bullish sign. Price is up, open interest is neutral to down, that's bearish. Price is down, open interest up, bearish. Price down, open interest neutral or down, bullish. Price neutral or open interest either way, bullish, bearish. So that's a guideline you could take when looking at open interest. Now this is one of my favourites from the commodity world and used in futures as well. It's called the Commitment of Traders Report, otherwise known as the COT report. And every Friday at 2:30, the CFTC, or the regulating body over there in the US, basically gives away the positions of the key players in the futures market. So you actually know which way round they're going. Are they long or short? So if you know the professionals are doing that, then why would you want to back yourself against the guys that do it for a living? So it's a very useful tool. It's maybe a bit longer term. It does give you a longer term feel and trend for the particular market you're looking at. The weakness of it, I suppose, is that it's only updated every Friday, so things can happen between Monday and Friday, but it does give you a longer term theme of what's going on in the particular futures market that you're covering. And it does look at FX as well, all those different commodity types, the energies, the grains, the metals, all of that lot, even the markets like indices, S&P 500, they're all covered off under the Commitment of Traders report. So how do you use this Commitment of Traders report? Well, we're looking for, and we're interested in, three particular types of trader. They're the commercials, they're the end users of the commodity. So for example, they're like the farmers, if we're talking about grains or meats. Then we're looking at the large speculators, they're like the hedge funds, the big trading houses. And in the third section categories, the small speculators, they're the small players. And interestingly, they are more often wrong than they are right. So you've in fact got a strategy there, you could reverse play them. The various ways of using the COT report: changes in size of position, crossovers of maybe large specs and commercials, and extremes around our overbought and oversold levels. Now getting hold of COT information isn't that easy, but fortunately the CFTC on their website allow you to download unlimited supply of big data on all of these types of commodities and futures markets. If you're good at programming, coding, then you can create your own tools, and I've managed to do that. But certain packages like eSignal cover off the information nicely. It could be a bought add-on into your package. Don't believe it's there on TradingView, other than individuals have looked to do what I did and then pump that information into TradingView. So you might want to have a dig around inside TradingView to find it there. But there's another company called COTbase, which I'm showing here in this example. That's that's all they do, and it just gives you the information that you want around the chart. I suppose the limitation of this is that it's not very flexible when managing into your charting rules and systems and add-ons. You'd like it all in one chart, but it does give you a good idea of what is going on. Now the two categories of people that have to be right to keep their jobs is one, the large speculators, so they always have to guess which way the price is going correctly, and the commercials, the farmers, it's their the miners, it's their livelihood, so they've got to be right. So this is how we can use this information. If we look here, we've got a price chart of sugar and the price has been coming down. The large speculators are the green line. Notice as the price comes down, their position size is going from more long to more short. They're reducing their positions. And the commercials, it's always the opposite way around because they're trying to hedge their risk. You'll see their position, the red line there, increase as the price decreases. So that's a very good quick guide for you to look at to see the sentiment of whatever asset you're looking at, and then go to your price tools, charts, marry the two together to give you a more robust strategy. Now I like using the VIX so much that I actually created a separate course all on it and volatility sentiment tools, because it's not just related to the VIX, there's other markets as well that it applies to around the world now. And to give you a bit of background, we're going to focus on, I suppose, the granddaddy of the volatility stock market indicators, which was the VIX, and it comes from the world of options trading and implied volatility. And again, it's knowing that the information that's going in here needs to be right for these guys to keep the job. And the volatility is actually the implied volatility that goes into options pricing, and these traders are marking their point of view for everyone to see. So if they think that volatility is rising, we'll see the VIX going up. If they don't think that it's rising, think it's calming down, it will go down. And it's based off the 30-day volatility on S&P 500 index options on the CBOE, and it is a really great tool. It's known as the fear indicator in the wider market, and there are some basic quick takeaways that you can look at so you can translate what's going on. So anything greater than 30 on the VIX is indicating high volatility, which means investor fear and uncertainty, and they're anticipating large price moves. And less than 20 in terms of volatility equals low, which means, investor complacency and less stressful markets. Now, there's an interesting reverse correlation here. As the volatility increases, what we see is that the related stock market, in this instance the S&P 500, often sells off, and vice versa. When the volatility is low, we see the price of the underlying market, the S&P 500, increasing. So there's a strategy there, and like I said, I've done a course on that just for that one point, and I've also related that to other stock markets around the world. So if you're interested, maybe you want to have a look at that. And here it is visually. I've got the S&P 500 against the VIX. On the top is the S&P 500, and below that is the VIX index. Now notice the correlation between the two. As the price goes up, the volatility has been going down, and those spikes correlate nicely to downturns in the S&P 500's price. So a very good sentiment tool then to add along with all the other ones that we've looked at so far. Now you may be wondering if there's any structure to putting indicators and tools together. Do we just lump them all in? Well, actually there is, and so far we've seen on top of the price action, the DPA, or underneath with the PCT, we can pretty much add what tools we like. There's thousands of them to pick from in the world of technical analysis, so what do we use? And what normally happens though, is what I see very often, is that the analyst or trader gets into a total mess. They put too many indicators on, trying to search for the holy grail of trading, and because of this you talk yourself in or out of trades and create some really strange hopeless strategies, and it's going to mess with your trading psychology, and in the long run you're just going to simply lose money. And here's an example, with trends, patterns, indicators, the whole lot. It's just too much. You don't need that many indicators on a chart. Like I say, it'll just confuse you, it'll nullify you. It's the paralysis of analysis. You'll get nowhere. Now, firstly, I always start with a reminder to myself, which is keep it simple, Stephen. And what I've seen is the best technical analysis strategies are often built off the most simplest ideas. So what to use then? Well, it could come down to personal preference, experience, trial and error. I think I've gone through most indicators and tools before I settled on what I use now, and that can take some time to go through, and it might be down to the markets you want to trade, and the time frames you want to trade, and trading goals. But still, that's quite a vague approach. We need something more specific. So rules then, we want obviously to enhance the power of our charts the best we can. So we know we're sport for choice and the tools, but we've got to be really careful in construction. And a key rule of technical analysis is this one called collinearity. The rule of collinearity simply states that you should avoid multi-collinearity amid indicators, i.e. the multiple counting of the same information. And we looked at that way back in the chapter section on the rules you need to know. And basically, for example, don't put the RSI and MACD together because they are based off the same closing price inputs. We're looking for tools, indicators that come from different sources but give us the same signals, and that's where we get the strength from. If you put them all from the same input, like the RSI and MACD for example, then you're only fooling yourself, and basically the signals you're getting are really just repetitive of the same thing, so you're not really learning much, and you're probably destroying your strategy by doing so. But still, how do we know what indicators work best and what should you use? So using that rule of collinearity, we are looking for a lot of independent supporting evidence from within our charts to help confirm our opinion. And more that these align, then the more confident we can be in our original trading signal. And it's about putting the odds of winning, the probability on your side. And I've constructed a table that you can use as a guideline of support to putting indicators together. Now, I've sorted this table into 5 different headings, and they all create independent variable sources of information around some of the tools you can use. So I've created a trend column, a momentum column, volume, volatility and sentiment. And if you want to put combinations together, pick maybe say one from the trend column, one from the volume, one from the sentiment, and make that your strategy. But don't pick 2 from the trend and just leave it at that, because that would be breaking the rule of collinearity. So use this table as your guide. Like I said, there's no fixed rule on how, whether you can take one from each of them, 5, and put them into a strategy, or just 2 of them. It's up to you. You're going to have to test it and see whether that works. But it breaks out the indicators you could use into different buckets to avoid you co-counting the same sort of information. Section 4 has been a very busy section where we've learned all about price confirmation tools, those tools that sit underneath the main body of the chart, and we've taken on board a lot of new ideas and concepts that as you get more experience in technical analysis, you can follow up and explore much more deeply. But we've covered off trend and momentum tools, the MACD, the CCI, the RSI and stochastics. We've learned about spotting overbought and oversold conditions on the charts and what this means for the future direction of any market and its trend. We've also learned that these tools can seriously aid the timing of your trades, the entry, the exit points. We've also covered off volume, volatility and sentiment tools, and we saw how they could also be used in conjunction with price analysis and their tools to create supportive independent evidence around our original price analysis. And they could individually create very powerful trading strategies, or like I say, be combined with price-based ones. And we also learned about the very important rule of collinearity and how you put these indicators and tools together around a rule-based framework. And I gave you a table which you could pick various indicators and tools together, marry them up to create a set of indicators and tools that confirm that rule of collinearity, and also offer you an independent view from various sources to confirm your original price analysis. Section 5 is a short topic on alternative concepts, where I'm going to introduce to you 3 different ideas around Elliott wave theory, GAN and market profile. They're to give you a taster. They're vast subjects in themselves, and they're for you to, like I say, get your feet wet, and then if you find them interesting, dig into them yourselves. They're not concepts I use much of, and there are numerous other concepts I could have used, from phases of the moon, fractals, proprietary channels, bands, oscillators, volumes, strength tools, etc. We just haven't got the time for it, but these 3 I think are useful, and I think get an understanding of them and then take them to where you want to. Now, the Elliott wave theory is probably the most mainstream of the 3 theories that we are going to look at, concepts we're going to look at. And this one was devised by Ralph Elliott. Elliott wave theory, I'm going to abbreviate it as EWT, is a methodology that is used to measure price cycles and forecast trends. And its basic idea is that the market behaves in an irregular, cyclic fashion. And around this idea, and through technical analysis in the charts, we can see it more clearly. It's created some measurement techniques that have been helped to quantify those movements in probably what I'd say a loose mathematical way. Now, EWT can be used in conjunction with other indicators, but the most popular indicator it's used with is Fibonacci, and we will look at Fibonacci as well, but those 2 normally go hand in hand if you're looking at Elliott wave theory. Now, the basics build around the theory of the concept of the wave, and EWT says the market, whatever instrument you're looking at, is a series of waves of various lengths and sizes, and these waves are determined as a price move in one direction as set by the reversal points that started and ended that move. And the wave is further broken down into 2 waves, which are known as the impulse and corrective part of that calculation. And the impulse wave is in the direction of the current trend, and the corrective against it. And that impulse wave is made up of 5 subwaves numbered 1 to 5, and the corrective wave is broken down into 3 subwaves labelled A, B and C. As I mentioned, the rules, if you really want to get into EWT, are far too complex and lengthy for this course and you can end up becoming an Elliott wave theory expert all by itself. But if you want to take this further, there is a book that I recommend, Applying Elliott Wave Theory Profitably by Stephen Poser, published by John Wiley and Sons. It's a useful book, and if you think you want to study EWT further, it's a good place to start. So EWT is a very useful trading tool, as it can help determine price targets and retracements, and it's seen as quite a subjective tool, and that's where it probably falls down with some. It is quite hard to automate if you wanted to try and do that as well, and some would say it works better after the event, where you can easily pick these waves and subwaves, but that's up to you to decide. But the concept as itself is worth an investigation and look into, in my opinion, and shouldn't be ignored. So here's an example of Elliott wave theory in action. It's on Cocoa, New York Cocoa, and it shows you the 5 subwaves, the motive wave and the corrective waves, all on the same chart. Now there are tools in charting packages that can calculate these lines, but again the inputs to that are very subjective, so you'll get what you sort of put in, garbage out, and it is quite tricky to use. So really it is an eyeballing methodology that, as long as you know the rules, you draw it on and you trade it that way. But if it works, it's a very good tool, and like I say, don't ignore it, give it a go if you can. Now moving on to our next theory, it's called Gann, and it was created by W.D. Gann, who was a very good commodity trader, very successful in the early part of the 20th century, and he created this idea around angles, fan lines and grids, and also believed in cycles and seasonality. So it all makes sense so far, and he used these methods to forecast and analyse markets, but he also based it on geometry. And where it starts to fall down for me is that he starts to add in astronomy and astrology and some ancient mathematics. So it really is an alternative concept. Some of it is quite usable, but some of it is quite far out, so I'll leave it up to you for whether you want to take it any further or not. But one thing he did believe in, and is I suppose obvious when you think about it, is that the most important angle was 45 degrees, which also rolls over into mainstream technical analysis theory. And one of the easiest concepts of his to use is called the fan, and it's 9 plotted angles based around that 45 degree line, which can be used as a tool for anticipating reversals. Now his concepts have been interpreted many ways and have become popular, but the problem is they are very hard to quantify and measure, and because of this his ideas attract many skeptics. I'm not going to go into these in too much detail, but the first chart here is the Gann box method, and it's on WTI crude oil, and you use the lines for those levels that we talked about. And the second chart, also applied to crude oil, is the fan method, which we talked about with the lines around the 45 degree ultimate trend angle. Like I said, you have to be quite committed to learn Gann, and it does have its uses. You can see it's quite colourful as well, and there's a lot of lines and drawing to do, and technology has allowed Gann to develop further in the modern climate of trading, but again it is one that you'll have to decide whether you want to use it or not. Now our final concept, alternative concept, is called market profile, and this was developed by a J. Peter Steidlmayer, a Chicago pit trader, and it really came about from his everyday practical experiences and knowledge, and how the behaviour of markets interacted and worked out over a given day. And he put it together into something called market profile, which is an intraday charting technique, and the price is on the vertical side and time and activity on the horizontal. It's not a time and price series chart, and you might recognise it from your days doing statistics, because it looks quite like the bell curve, normal Gaussian distribution. But it is a really good, practical, fair, interesting tool that looks to measure fair value around the price activity in whatever instrument you are looking at trading. Now, the market profile chart displays price market activity recorded in relation to time in that statistical bell curve shape that I was talking about. Now, it has fatter periods at the middle prices with activity trailing off at higher and lower prices, and then this portrays the ease with which the market allows facilitation of trading and the manner in which it takes place. And the chart, and for obvious reasons, identifies the class of trader, whether you're a local or commercial, and this allows traders to have a better understanding of actually doing the trading on the floor. And this is where his ideas came from. It was then automated into a technical analysis tool, and I suppose the downside of it is it's quite, I'd call an exclusive tool, so it's not very accessible to many. So if you've got a Bloomberg, you might have it anyway, but for some other packages it's an add-on, and it can be sometimes quite an expensive add-on. Now, this is what it looks like on Bloomberg, and this is on a US 10-year Treasury note. It's got 1, 2, 3, 4, 5 days of price history, and you can see the shapes of the distribution of the prices by the price levels, and it becomes a very useful tool for the trader, especially if you're an intraday trader. But like I said, it's very hard to get your hands on this, but there is a similar alternative that is much more widely available. Now, I think this tool could be just as good as the market profile tool. It's called Volume at Price, and if you've got TradingView, it's definitely on there. It's probably available on other packages as well. And as you can see, we can see a distribution on the right hand side. This is on the Nikkei 225 Japanese stock market, and it also gives you key levels and points of progression and movement in the day's volume. But you don't have to set it intraday like the market profile. You can have it for much longer periods of time. Now, this one goes over a few years in the Nikkei 225 chart here, but again, it shows you key support and resistance levels where the volume, the activity is happening around certain prices. So that helps us a lot for our risk management, where we could set stops because we know where the activity is happening and not happening. We can also set price objectives around there, and if you really take it further, you get into the world of options trading, you could use it as a tool for buying and selling straddles and strangles. But generally though, for our own interest, it is a very good guide for volume activity in any asset you're trading. Now, I suppose the caveat here is you've got to be careful of the quality of the volume data coming in to make this work properly. So if you're getting it direct from a broker feed, it might not be as good. That might just be the client volume. So you've got to check that you're getting that data from an exchange. And remember, this won't work in FX because there's no such thing as volume other than on futures, which is only a very small fraction of the $5 trillion traded every day in that world. Now, we've seen 3 alternative concepts: Elliott wave, Gann and market profile. And we've also sidelined volume profile around market profile. Now, I've only presented these as a consideration to get you thinking about other ideas within technical analysis. If you want to take them further, dig deeper, contact me and I can point you in the right direction with other resources. I say I don't really use these very often, but they are individually, if you get into them, useful tools. But before we conclude this section, then there's a little exercise just to sort of refresh or help you find these concepts out further. For Elliott wave theory, just as a minimum, look in your charts and see if you can draw wave lines, or just see if you've got indicators available that can plot the Elliott wave and see what that does to your charts. For Gann, as we know, it can be hard to practice, but just check if your charting package offers some of the Gann functionality, the fans, those key lines, the boxes. It is there on TradingView, I know, and it is on other packages, Bloomberg, probably eSignal. And then finally, market profile. If you haven't got it, maybe give volume profile a consideration. Very good intraday and longer term, and they are definitely available on TradingView and most likely other charting packages. To be honest with you, these concepts aren't really my cup of tea. Elliott wave, Gann, market profile, simply because they don't fit my personality, my risk or trading appetite, but they do work very well for others. So like I said, don't rule them out, give them a go, see if it works for you. It doesn't work for me, doesn't mean it won't work for you, and they shouldn't be excluded just because I don't think they're useful for me. Like I say, they're subjects in themselves, and you can spend a whole lifetime career just exploring any one of those three. And as you gain more experience and understanding within the world of technical analysis, they're going to be worth exploring further. They might be little add-ons you add to other stuff and combine to make more powerful systems. And I have a rule that says that if it works for you and makes you money, then it can't be knocked. Welcome to section 6. This is my favourite part of technical analysis. It's Japanese charting. Now, back in the 90s, I was privileged enough to work for a Japanese bank in London, and I had access and I saw these chart types and I was fascinated by them, and that started my journey in this space. So I've been using them for many years and quite successfully, so I hope I can give you an insight into what they're all about. Now, previously in this world they were classed as a minority part of charting, but software, the tech revolution, globalization has made this Japanese charting available to all now, whereas just even 10 years ago it was really out of bounds, and that to me means opportunity for us all. And we've already seen some Japanese charting techniques with Ichimoku, but now we're going to go a bit deeper. It's a big subject, and this really is only the tip of the iceberg, and I do offer courses on all of these individual types, including the Ichimoku as well. And if you're interested, get in touch. There'll be other resources pointing you in the right direction within this course. So 4 concepts we're going to look at in section 6: Heikin Ashi, Renko, Kagi, and line break. Now I'm going to ease you into the world of Japanese charting nicely with Heikin Ashi to start with. Now, if you cast your mind back and remember the candlesticks that we looked at, Heikin Ashi is a derivative of that, and really it's a psychological tool to stop you, if you've got jittery fingers, from getting in and out of trades too early, and helps you, smooth out the data and allow you to make more informed decisions. And the other good thing with Heikin Ashi is you don't have to learn all those candlestick patterns that we talked about, combining between 2 or 7 candles. There's only a few key ones that you need to learn. So let's get stuck into looking at Heikin Ashi charts. So like I just mentioned, the job of the Heikin Ashi candle is a method of smoothing out some of the noise and volatility that impacts the decision making process and in turn presents to you, the user of technical analysis, a much clearer visual representation of the trend. And I said they're a derivative of the candlestick chart already. And what does that mean in Japanese translated Heikin Ashi? It means average bar, because it's the average of 2 bars of candlesticks of data. And like I say, the trend is easier to see with Heikin Ashi charts and will help keep you in a trending trade longer. And that, doesn't matter whether it's a 1 minute chart or a 1 hour or a 1 week chart. And also it's very good for helping to spot price reversals. So let's summarize the advantages of Heikin Ashi charting. It takes out a lot of the psychology and noise around the charts, and traders often cut out of trades far too early and regret their actions. Heikin Ashi stops that, and this is a very prevalent trait, cutting out too early in new traders, and that's understandable. And try to force trades to conclusion rather than sticking to the original mental trading model, or strategy. Heikin Ashi makes you stick more to the rules. And another major psychological problem is that as we start to win, we become more risk averse, and as we start to lose, we become bigger risk takers, and we need to let our profits run if we want to be successful, and Heikin Ashi lets us do this. So a lot of people, especially new traders, struggle with the psychological movement of the price and become absorbed too much in what's going on right at the immediate moment. They chart watch too long, and Heikin Ashi is here to help you. So for all you mathematicians out there, what is the maths behind it? Well, it's not really too much. It looks a lot from the slide, but it's not much really there. It's just simply a combination of 2 bars candlesticks to create a new open, close, high and low. And I'm not going to go through all that formula now. If you're interested, or you're a programmer who wants to code your own type of Heikin Ashi charts, there's the formulas. It's in there, but we can get a better idea how it works from just looking at a practical example. Now I've made up these numbers in the example just for the purposes of this section. We're going to look at the S&P 500, and we have 2 Heikin Ashi candlestick bars, and here's our prices. We got X and X equals 1. We've got the first one, the open, high, low and close, and the second one, the open, high, low and close. And can you see on the bottom line there how combining those 2 become 1? So you can see the open from X is 2049. You can see the high over that 2 candlesticks was 2064, and the low was 2049, and the close was at 2057. So that's how we create our Heikin Ashi candlestick. So let's take a look in the charts, a comparison of a candlestick chart to a what we call a Heikin Ashi chart. Now up on the screen now I've got NIO. It's a US well, this one is on the US exchange. It's actually a Chinese electric vehicle car maker. It's a very popular stock at the moment. On the left hand side we have the candlestick chart. On the right hand side we have the Heikin Ashi chart. Now I'd like to draw your attention to how the Heikin Ashi chart starts to smooth out the data, whereas on the down run on the left hand side in NIO there was red bars and black bars, and you might have been thinking, is the price going to reverse and go back up? Actually it stayed down all the way through to June, whereas on the right hand side that jumpiness in the price was smoothed out. And also notice the gaps are taken out as well from the price, but the trends I think you can just see very quickly are more visual. Like the current up run from June onwards is a lot more smoother, and you'd probably stay in there, whereas the one on the left you get a red day and a down looking candle patterns. You might think the price is going to short and go down further. So visually just I think a much easier tool to use when you're looking at trends and wanting to stay in your trade. So let's now just look at, we'll take another stock and change it to a different time frame. So all I've done now is I've flipped the stock to Amazon, and it's a 1 hour chart on both. And again, we've seen an up run in the Amazon price from the 7th, candlestick on the left, Heikin-Ashi on the right. But again, that uptrend, is a lot smoother with a lot more, black bars in there. Remember about the colours of the candlesticks. You can set them what you want. I like having black as my up and red as my down. And the recent sell-off in Amazon in the 1 hour chart, there you can see the trend was a lot smoother than it was on the left, where we had red and black bars that could have caused us confusion and made us jittery and counter what we wanted to do with that trade. So that's how you can visualize, I think, a lot easier what's going on by using Heikin-Ashi charts. Remember, I also said there was less candlestick patterns you needed to know. Well, there really is only two that are important in the Heikin-Ashi world, and that is the doji and the spinning tops, which are very similar to the doji, and they are indecision points and often key points of price reversal. So if you start to add other indicators on top of these charts and you see these patterns come up, then you might have a more probabilistic trade that the market, the asset that you're looking at is going to turn around and move in the other direction. So again, there's a lot less to learn than just your standard candlestick charts, which again saves you time. And actually, to pick these patterns up is a lot easier than those others that we sort of looked at in the candlestick world. So some other important things to note, the traditional classical technical analysis patterns like the triangles, heads and shoulders, all of those still work on Heikin-Ashi charts. And I've already mentioned that you notice that gaps are eradicated, and also on Heikin-Ashi, big down bars with little or no upper shadow. That's the wicks signify strong selling pressures. On Heikin-Ashi charts, big up bars with little or no lower shadow highlight strong buying pressure. So just a bit of a note on the strength of the trend, and this is another good thing with the Heikin-Ashi charts, that you'll notice when a strong trend is underway, the shadows, the wicks of the candles will not be visible, but when the trend becomes weaker, they start to peer out, poke out and become bigger, and that is also an indication of the trend weakening or slowing down. And it's not a sign of a reversal, but like I say, just the possibility of it slowing down. So some other notes on Heikin-Ashi: it works in any time frame, I found, and it works across all markets. It's very good if you add other indicators to it. Now I'm just going to give you a quick example on the Euro USD 15-minute chart of 6 possible trading strategies that you could use just to start getting you thinking about how to manipulate Heikin-Ashi into your trading environment. So what do we have here? We have Heikin-Ashi Euro USD 15-minute chart. We've got pivots on there, we've got a stochastic on there, and we've drawn trend lines, and we've got a couple of moving averages. So I've thrown a few things in there to get you thinking on how you could possibly put your own strategies together. Now if we have a look more detail wise, we can see, for example, how the price bounces off pivot points, and we could use maybe our knowledge of the two candlestick patterns and the slowing down of the bars as an indication of something reversal. We could then time that in maybe with using the stochastic. We can draw trend lines on there where we can have reversals off the price trend lines there. We got pause and continuation patterns, and we got breakouts, and we got pullbacks. So there's a lot to think about and develop into strategies just using Heikin-Ashi. So just to show you how to set your charts to Heikin-Ashi, we've got the Amazon 1 hour chart that we used previously. We go up to the box that allows us to change the charts in the top left. We click on it, and we simply just click on the Heikin Ashi, and there you go. It's as simple as that. Let's round off Heikin Ashi with an exercise, and you just see me turn the charts to Heikin Ashi from Candlesticks. Have a go yourself, play in different time frames, and notice how it smooths out the data. Look for those type of strategies and ideas that we've talked about, and then maybe come up with a trading plan around Heikin Ashi charts. Now this is where I start to play with your brains. After giving you a whole load of rules and setups for charts, we're going to take a whole different angle with the next 3 type of chart type, and that's Renko, line break and Kagis. And before I get into Renko, I just wanted to explain a bit about the 3 so you could see the difference and why you would use them, and they all offer very different opportunities. The big takeaway here is that they don't deal with time, and their main objective is to deal with price movement, and they deal with it all in a slightly different way. And like I say, that gives us trading strategy opportunity. So I created a hypothetical set of stock data, and I just wanted to present to you what that would look like in 3 different formats before we carry on. So here's the hypothetical set of data, stock XYZ. It goes over 19 days, gives you the stock price, the change in the price, and whether the direction was up or down. And that's important to know when we're putting together these chart types. Now these chart types are similar to the point and figure chart, but I find them a lot easier to use and a lot more visually interesting, and actually easier to construct strategies around. But let's have a look at how that stock XYZ PLC data turned out in the different chart types. So here are the results. We have the line break chart on the left, the Kagi chart in the middle, and the Renko chart on the right. And all we need to know for now is that if we look at it, that's just all based off the same set of data over the same time period, that they all give us a slightly different angle onto the data analysis. They certainly give us a different approach to Heikin Ashi or candlestick, bar charts, line charts. And because of this, and now like I said, the change in technology and the software available to you, this gives us some ideal trading opportunities. And I think these charts deal much better with trading psychology, and are also very easier to systematize and program into, so they're definitely worth following up and investigating. So let's get on with the first type, and that's Renko. So what are they? Well, they created in Japan, obviously, and they've been used for a very long time, and they're now sort of coming into the mainstream and available to us. But what does Renko mean? Well, it derives from the word Renga, which means brick, and as you look at the charts, they do look like bricks, and they move up and down in 45-degree lines with 1 brick per vertical column. And this is quite a unique way of charting, and it does create some great analytical applications for trading. At this level, all you need to know is that they do remove time. We can introduce time elements in it to manipulate further, and that's due to, like I say, the updates in technology and software. And to start with, these might blow your mind a bit, but I can tell you, if you spend the time to learn them, they are a really powerful charting type. So here we've got an example for you to look at. It's Tesla, the very popular US stock. On the left we have a Heikin Ashi candlestick chart. On the right we have our Renko chart. Now we know previously that Heikin Ashi likes to smooth out the data, and really Renko has smoothed it out even further, and it just makes it even more black and white. We've got the red blocks as down, black as up, and we can really see the trends a lot more easy, I think, in the change in the trends and support and resistance areas on the Renko than you can even the Heikin Ashi. If we just flip the Heikin Ashi back to an ordinary candlestick chart, again it's the same period of time. Now I've manipulated it to show us the same period just for the illustrative purposes here, but again look how much clearer that is over an ordinary candlestick chart, and because of that clarity it makes us more consistent and systematized in our trading approach. So some basic things you need to know. Well, it's similar to point and figure charts. Remember the noughts and crosses, where they replace them with bricks, and sometimes those bricks are known as blocks or boxes, and they move up and down in 45-degree lines. In terms of the colors, hollow, white, red, for up, whatever really you want. Downside, black. No fixed rule here. You create what you like. I like red and black on my charts. Stop hunter colors, and I think it's a very effective charting system for support and resistance levels, turns, reversals in the marketplace, and trade signals are generated when those blocks alternate color. I wouldn't advise you to trade just off that rule alone, because you'll get into a lot of trouble. You need to combine it with other methodologies, other indicators and tools, which we'll see in a minute, and that's when you can then really start to use Renko to its fullest. Now I want to re-emphasize what we've already learned on Renko, and as we know, they're based on bricks, and they filter out the price because of the size of those bricks. Now our regular bar line candlestick chart has a uniform X and Y axis spaced equally out into days, weeks and months, as this is because there's one data point per whatever time period you're looking, day, week, minute, whatsoever. Renko ignores all that time aspect and focuses on the price change. So if the brick is set to 10 points, a move of 10 points is required for another brick to be drawn. If nothing happens, it stays the same. So that's why time starts to become irrelevant. So if the price isn't moving, we're not going to get that change. But once we have a new brick, that's when you'll start to see on your charts the dates adjusting, and why there can be a jump between the dates on a charting package, because there has been no price action until that next brick is formed. And as we can see on here on our example, we've got a WTI crude oil standard candlestick chart versus the Renko, and this example, just like the Tesla one, is just reiterating the smoothness, the clarity of the data. Essentially Renko is taking out the noise of the chart and presenting you with a much more transparent picture. You might have worked out that the key to success in Renko is getting the right block size, and this is the most important aspect of the Renko chart system. And there's three commonly standard methods which you'll find on your charting packages. One's a fixed value. Say we trade in the Tesla stock again, and we think that a 10 or 20 point block is appropriate. We would then plug that into our system. We could use a percentage of the price. For example, we might say for every 2% price move, then we're going to create a new block. But this has weaknesses, as it doesn't really take into account the volatility of the instrument, because for example a stock like Tesla moves far bigger than say a currency pair or maybe a stock indices, so maybe more of a weaker approach. But the third method does encapsulate volatility, and that is ATR, average true range. So average true range is a non-statistical method. It's very simple and easy to apply. You can find it from within your charting packages as another indicator. Standard setup is 14-day, or you can manually tweak it, and it takes into account, like I say, the volatility and movement of an asset price. That's very good for when we want to create a block size, because we know the blocks are moving correctly based on that instrument. And you can manipulate the ATR to your heart's content to create different numbers. I'd say don't backfit them, try and get them generic as possible, especially if you're trading multi assets. So it's important, and a tip here is to get the right box size, whatever the cost. Spend some time working it out. Do you have long, short-term view? What sort of moves do you want to isolate? How sensitive do you want to get? How many trade signals do you want to get? What have past prices done? What drawdowns are you prepared to accept? More sensitive, you might get more losing trades, things like that. Or less sensitive, you'll be sitting on the trade a lot longer. Can you afford to run that trade? So a lot of considerations there around getting the right size block. Now I just want to take you through an example on the block sizes within the charts. Now TradingView does 2 of the 3 methods. It has a fixed amount or ATR. It doesn't have the percentage set up, but others do, and if yours does, have a play around with it. I just want to show you the 2 inside TradingView. There'll be the same processes in your charting packages if you don't use them. So we've got Tesla again, and I'll just default it at daily chart for argument's sake. But on the left we have the Renko chart set with an average true range of 5, and if you can see just after that 5 we've got the number 25, and that's how big the block is. It's 25 points for one block move, so it has to move 25 to create another whole block size. And if you notice down on the axis, the time axis, that actually with that setting takes you right back to 2017. So there's not a lot of action there in terms of probably trade signals. It's a much longer term ATR number. Now if we flip to the right hand side, I've done my own analysis, and I think maybe a block size of 10 is more appropriate. And notice that that has shortened the time period down to just a few months. It will give us more signals, but it might give us different results. It depends on what your strategy is and how you want to get involved with the Renko charts. Now just a quick look at how I set those. Now when you flip your chart to Renko there, you will have this line come up, tell you what the setting is for the method of calculating the block. So if we just double click on that, we can see we've got an ATR. It's based on the close. We can manipulate it to open, high, low, close if we want. We can change the length of the ATR to more or less, and let's just, for argument's sake, make it bigger and see what that does to the number. We're taking it up to 15. Actually that made no difference whatsoever, so even with 15 ATR it kept it the same. And flipping over to the traditional side, how you derive at the block size of 10 could be down to your own knowledge of Tesla. It could be based off of your observations of how a standard candlestick chart moves within a day, to give you you might want 2 or 3 trades per day on Tesla, so you have a faster box size. But here's the traditional. If I move that up to 100, which is going to be a lot, it's going to give us only a few blocks. See, actually, you can see how the impact of changing the block size significantly alters the blocks you get. Let's take that down even faster than 10 to say 5 points, and again we're going to get a lot more information blocks. You see we've only really got 1 month now, whereas we had 3 months with 10. So again, you might want to create a strategy around just that. So there you go, that's a brief insight into playing around with block sizing and setting them within the charts. So at a basic price level, what can we do with the Renko chart? Well, we could see key resistance levels, low points, trend line breaks, key support levels. So it's very good just as a simple price analysis tool, and we can see that in the example here on crude oil. So we've got that as our basics, and we might want to use that in conjunction with maybe a candlestick chart or a bar chart to give us our trend direction filter maybe. But using the Renko chart, says it filters out that noise and maybe makes that decision making process of yours a lot more transparent and systematic. And again, if you want to take this further, start adding indicators on top. It will make it a much more powerful system. So this is our WTI chart again, and on it I've added a 10 period moving average, Bollinger Bands and Fibonacci, just to, there's no strategy behind that. It's just to illustrate how you can now add on indicators and tools on top of old traditional methods to enhance them a lot further. We've seen that Renko can show us very key support and resistance levels, key price turning points, and we can use that within our trade management to set, say, stops or even targets to where we want to get out of a trade. And the basic rules behind that, use these levels of support and resistance in your strategy trading plan. You could use indicators like moving averages, bands, Fibonacci that we've looked at. Trail your stops maybe under a number of bricks or behind significant price levels. And I would advise using an ATR based approach for setting the stops, because that's going to take into account the volatility of the instrument that you're trading and make it a more relevant level. To round off Renko, I've got an exercise for you. Have a play around turning your charts to Renko. Have a look at the difference between that and candlestick charts and how it takes out the noise. See if you can try and set the brick sizes around the rules that I've presented and what changing the brick size does to the data and the potential for any trading approaches you might be trying to deploy, and look for trading strategies inside the Renko way. And if you're interested in Renko, like I say, it is a big subject, and we've touched the iceberg, top of the iceberg here, and there will be other resources that you can follow that I will present in section 8. Kagi in many ways is very similar to Renko. They might look very different, but their creation, their inputs, the way of creating the lines that we are going to see on Kagi chart are very similar. But what is Kagi? Well, it's been around since 1870s. It's another one of those Japanese chart types, and its purpose again is to paint a transparent picture of price action. It's Renko and line break cousins, ignoring time and focusing on price change. And again, it's great for taking out the noise of the charts, and another really good psychological charting tool to help you. And like the point and figure charts from the West, we looked at the noughts and crosses. Kagi charts, unlike Renko, which uses bricks or blocks, uses lines instead, and those lines are known as yin and yang lines. And the other fundamental concepts of these charts is that of the reversal in price, and the lines change direction once the price moves a set amount. So very similar to Renko. Let's have a look at an example when we got the S&P 500 here over a long period of time, and notice that we've got red and black lines, yin and yang lines. The black lines are the bullish up ones, and the red are the bearish ones. They're the yin lines, those bullish ones the yang lines. And that's pretty much it as a price analysis tool. Again, it's smoothing out the data in comparison to, say, a candlestick or bar chart. And here we can look at the Kagi chart against the standard candlestick chart on the right here. Same period of time, S&P 500. Again, just look how much simpler and easier it is to translate the data. And unlike the line chart that we looked at right at the very beginning, we can add on tools and manipulate the data around, like the Kagi and the Renko and the line break charts, because of their inputs, unlike just the one point of input in the line chart. But the general takeaway from this chart is, again, just look how it takes out the noise from the charts. So into the basics of Kagi charts. It's the study of pure price movement. Remember, it takes out time when constructing the charts. The lines are simply known as yin and yang, and they measure the price, and they change direction once the price moves a set amount, which you're going to input to make it happen. So Kagi charting is like setting the bricks, all about getting the price reversal right. Now again, you can change the colors how you like, but the black thicker lines normally are bullish, the red thin lines bearish, and in my examples I always use black to red is a sell, and going red to black equals a buy. And a bit like how the blocks in Renko change, I would never trade that rule of just when the lines change, because you're going to get whipsawed about, it's going to get messy, you're going to lose money, it's not consistent enough. And we need to add other indicators and tools and analysis on top of the CAGI setup, which we can now do to make it more effective. The construction again is just like the Renko chart. It's 3 methods: a fixed number of points, a set percentage move, or using the average true range. And again, I always favour using the average true range because that takes into account the volatility of the instrument. And again, you can manipulate the inputs to the CAGI chart. You don't just have to use a close, you could use high lows, for example, or combinations, and mix it up however you see fit. And the reversal amount is the minimum price change required for the CAGI line to reverse its direction. So the benefits of using the ATR approach, as we've just mentioned, it takes into account the volatility of the instrument. If you don't factor that in, your trade signals are going to get whacked and you are going to lose money. And here we have an example of the Nikkei 225 with a 350 point reversal. Now the interesting part also of these CAGI charts is that horizontal line that is that start that reversal point, and that sort of joins the chart together and shows the correction, the changes in the market of whatever you are analysing. But like Renko, getting the right line size, the reversal size, is critical for success in this type of chart. So the uses of the CAGI chart, well, you could trade it by itself, and that could include a combination of oscillators, indicators, trend analysis, Fibonacci analysis on top. If you just want it as a tool to filter out the trade noise so you can see trend direction of whatever's going on in the market you're looking at, or for just spotting, support and resistance and trend lines and using that to help you maybe with another chart type like candlestick or Heikin-Ashi, help set stop levels or target levels. And again, I've used the Nikkei 225 example, and I've just put on some patterns. And again, the same rules apply to our earlier look at patterns and trend lines. You can draw on triangles, wedges, the whole lot in the same manner with the same rules. So some further suggestions around CAGI chart usages. Because of the advancement in technology and charting software, we can do pretty much what we like to the CAGI chart now, and you can create your own strategies and ideas and derivatives of the CAGI chart. Don't just stop at pattern analysis. Like I said, if you want to enhance further, add some of those oscillators that we've looked at. Why don't you consider something like RSI, MACD, stochastics, moving averages, to determine support, resistance, entry and exit points. Also very useful with Fibonacci. And here again is an example on the Nikkei 225, and I've just added on the MACD as a tool to help me get in and out of any trade, and I line that up with the price analysis on the top part, the direct price analysis on the top part of the chart. I put on a moving average as well to help determine the trend and when that's changing. And once you get into CAGI, you'll find it has its own terminology like falling waists and rising shoulders that can help you understand what is going on. And like I said, for stops, trade management, why not use those support and resistance lines to help you in that area as well. So a brief look within the charts again, going back to our Tesla example that was in the Renko form. If we want to change that to CAGI, we go up to the charts button and we simply then find the CAGI one, click on it, expand it out to have a better view. Again, here we've got a default of ATR of 14 lookbacks with a line size, reversal size of 25. Again, we can change that if we want. We can set it to the traditional and make it a lot faster. Let's go to let's use the same as we did in the Renko, 10. And again, we've changed the time period and the amount of action that we'll get around those charts and if we want to add indicators, it's exactly the same process with like we did with a bar or candlestick chart. Let's add on, like my example, a moving average. So you can see the moving average go on, and let's see if we can find the MACD. There it is. So it's just as straightforward as any of the other chart types. Just got to have the practice playing around with it. And like I said, the critical point, like in Renko, is getting the reversal size spot on. Otherwise you're not really going to have an effective trading strategy, and you're going to find it very frustrating. So spend some time on reversal sizes if you're going to use Kagi. So a Kagi exercise for you: turn charts to Kagi, look at the differences, even compare it to a Renko chart or candlestick or Heikin-Ashi chart. See how it takes the noise out of the price data, and see if you can try setting the reversal sizes and looking what happens to those yin and yang lines on your charts. And again, look for potential trading strategies. And if you're interested in learning more about Kagi, and I think it is a good one to learn, there'll be further suggestions and resources given and available in section 8 of this course. You'll be pleased to know that line break charts are a lot more simple than their Kagi and Renko cousins. Again, they're created in Japan. Again, they ignore time, and the line chart only changes in direction when price moves by a given criteria. Unfortunately for you, that criteria is set in the rules, so you don't have to do anything. So they're similar to point and figure charts, but they are really fantastic, and this is their big strong point for spotting price reversals and turning points, especially when used in conjunction with other momentum indicators, which in the past you couldn't do very easily on charts. So they're also very good for trend identification, and I found that they work in all times, from end of day all the way through to the intraday faster approaching charts. And you'll hear like people say a 3-line break or 2-line break, 5-line break. The most common is the 3-line break, but don't let that stop you exploring around it. I use 2, 5, 10, all different size line breaks to come up with different solutions. So here we have our first look at the line break chart on the right hand side in comparison to the standard candlestick chart, and it's on the pound versus the US dollar. Again, look at the simplicity of the data of the line chart and how much easier it is to ascertain what's going on with the market. It's split into bars, a bit different to the Renko chart and the Kagi chart. It's all almost like a hybrid of the two. It's not, but it almost looks that way. But I suppose again, it's a great chart for taking out the noise, and like I say, really good for spotting reversals in the price. So some basics on the line break chart. It shows a series of vertical white or black lines, or coloured however you like. I use red for down and green or black for up. New lines are created based on the closing price, and if the previous high is exceeded, a new bullish line is added, and if the low is exceeded, then a new bearish line is added. And if the price stays within the range, then no new line is drawn. So that's why you'll see the jumps in the date axes on your charts, because if nothing happens, it won't create a new line. So price continue in the same direction until a reversal is created. A reversal occurs, just to clarify, when the closing price exceeds the high or low of the prior 2, 3, 4, 5 lines. So that's where the name 3-line chart, 2-line break chart, 5-line break chart comes from. It's what you specify, and that's really the only bit of work you've got to do to decide whether you want a 2, 3, 5 line. If you want a 2-line, it's going to give you quicker entry and exits. A 3-line, it's the most common. 5-line, even up to 10, you probably don't want to go more than 10. Slows it down into more noticeable trends. And construction, as I've already mentioned, it is a lot more simple compared to Kagi or Renko. All you have to do is pick the line chart that you want, line break chart that you want, 2, 3, 5, 10. We'll have a look in a moment at some examples, but that's all you have to do. So it is quite an easy chart to set up and use, and you can actually in a charting package now flip the time frames to give you more or less action. It sort of goes outside the original traditional rules of line break chart, but again I'll show you what that means in a moment. Now this is a gold chart on 240 minutes, the 4 hour, and it's a 3 line break chart, and I've just drawn on some examples of how that would work. And if we focus on those ones in the middle, the 3 line break examples, we will have a look at how we can get in and out of trades and where we could possibly put our stops. So on the example on the left, you'll notice I've drawn a black horizontal line, and that's the start of the whole process. Because it's a 3 line break, we're looking for 3 bars. So we've got 1, 2, 3 green bars up, and we go back into the trade when the red bar is formed and breaks through that first point of the green bar. So our entry point to a short trade is here, and where could we put our stop? Well, we could just put it at that turning point, because if we're confident that strategy works, then it shouldn't really the price go there, and if it does, it's wrong. So we could put our stop there, and then we could then maybe trail down behind these blocks until we get taken out. That was a short trade we looked at, and the rules are exactly the same for a long trade. We'd want 3 red down bars, and then as that green bar breaks through the first of those red down bars, we then go long. So trading using line break charts, well, as we've sort of gathered, that we can really enhance the charts as much as we like, and we can improve the results by adding on other momentum indicators to build some great strategies. But uses, by itself with other indicators, filtering out trading noise, great for spotting reversals, very good for finding support and resistance and patterns and trends. And why not, again, like the other type of Japanese charts, use it in conjunction with a bar chart or a candlestick chart to confirm a trade signal, a trend, or something like that. So here's a great chart of Cocoa, 3 line break chart, and I've added on stochastics, and I'm going to use the stochastics indicator to confirm the 3 line break signals. So looking at a simple example there, over on the right hand side of the screen we have a big rundown in the cocoa price. Look what happens to the stochastic at the same time it's telling us to go short. So that's a simple way of using line break chart with a oscillator to give you a much more strong trading signal. So just to cover off the stops once more, the rules, basic rules, yes, you can use them for line break charts, whether that's 2, 4, whatever. Basic rules: use levels of support and resistance as the turning points of the line break chart for a more aggressive approach, and use indicators like moving averages, bands, historical volatility, ATR, and you can trail your stops as well behind those bars if you like. And a loose rule is if there are 8 to 10 lines in any one direction, this can signify that the asset is susceptible to change in a price direction. So maybe that's worth testing or looking at and see if that works in your strategy. So sticking with our Tesla example, let's have a look how we can play with line break charts in the charting packages, and again it'll be the same across all charting packages. Here we have Tesla. It's set to Kagi. Let's change it to line break charts, and as you can see up there we got in the brackets there 3, so it's automatically set to a 3 line break chart. Now to show you what the difference between a 3 and say a 10 line break chart would be, I'm going to just pull up another chart, and that's set to our Renko. Let's change that also to line break. So now we've got exactly the same thing. Notice 3 and 3, but let's double click on there and then move the number of line breaks up to 10, and you can see instantly how different that looks. For one, it's gone back a further period of time, and you've also got now much more of a trending longer term approach, so probably less trading signals but more clarity around which way the market's going. Now, you might want to put these two together. You could use the 10 line break as your trend signal, and you could use the 3 line break as, you know, getting in and out, the timing part of your trading. So the other thing we were going to look at was the time element in the line break charts. Now, they shouldn't exist, but we can play around with it in our charting packages. Now, if I set that one back to 3, so we can directly compare change in time. Notice I've got this one set to 1 day on the left. Now, if I change that one on the right to say 1 hour, we've still got a 3 line break chart, but now we're, you know, if you look at the bottom here and the date axis, a lot closer range, and again we've got more price action. We've got a different looking chart, and again that can create more timely trading opportunities on any given market that you're looking at. So really you shouldn't have time on line break charts, but actually with today's software you can actually manipulate the data to create your own strategies. And an exercise for you to conclude line break charts. You know, turn your charts to 3 line break, compare them to Renko and Gaggy, see what you see. Also play around with the 3 line break chart setup. Look for 2s, look for 10s, see what that does to the charts. Also then introduce time, although we shouldn't, as we know, because it's not strictly the rules. We can, to see what type of other strategies you can create in the line break charts. And the takeaway, like the other 2 Japanese charts, if you're interested in learning about line break charts further, I'm going to suggest some possible resources available to you in the final section 8. I hope you enjoyed that brief look and introduction to Japanese charting. You probably need to have a bit of a rest after going through all that lot, because it's quite a lot to take in, and it took me a while, but once I spent the time and effort getting into it, I realised that these are really effective chart types that can't be ignored. And we looked at 4 on top of the Ichimoku, which we saw earlier from the Japanese world. We've looked at Heikin-Ashi, which is a derivative of the candlestick chart. It smooths things out, it aids your trading psychology and discipline and consistency. And we looked at 3 very different chart types: Renko, Kagi, line break, which, like I said, at first glance can seem confusing. They take away time, they focus in on the price movement, and because of this they create different trading opportunities and edges to the mainstream charts. And if mastered, I can tell you they can become a very useful tool as a standalone trading strategy or system, or as a complement to, say, your standard candlestick and bar charts, as maybe a trend filter or risk management tool for finding support and resistance to help you maybe set stops and target levels. So to round off our introductory technical analysis series, in the next 3 sections we're going to put what we've learnt together so far. It's all very well having all this super knowledge and technical analysis and trading, but how do you actually use it in the real world? Technical analysis is a multi-talented tool. You've now seen that it's a vast subject and can be used for many things in your trading and investing. So in this Section 7, we're briefly going to look at how you can use technical analysis to design, build and implement a trading strategy, and then we will see how you can apply technical analysis in your risk and trade management. and finally how you can use technical analysis to improve your results. So for me, this is where technical analysis starts to get exciting. It's when you start to put together your own ideas and turn them into strategies, which essentially hopefully are going to make you some money in a return. But when you're starting to create these strategies, what are your options? Now remember, we're focusing purely on the technical analysis side of things, so it's going to give you, I think, 3 choices for your trading. One is to trade purely technically. That means ignore all news, all well, anything really other than just looking at your charts. Okay, so that's a called 100% pure technical approach. Or secondly, you could use technical analysis to aid other fundamental analysis or sentiment that you know about, or you could use it to trade and develop systematic, algorithmic type trading models. So if you're more technical, analytically based in your trading, then one of the biggest influences or factors that's going to affect how your strategies and trading go about will be the liquidity of the market. So as I've said before, technical analysis works very well when the markets are liquid. There's a lot of volume and turnover in it, and it makes the world of technical analysis more reliable. So this makes markets such as FX and indices and some of the large commodities like crude oil, or large stocks, equities like Amazon or Apple, very good for deploying purely on a technical analysis basis. Now if the markets are less liquid, like lean hogs or AIM stocks in the UK, the smaller size that are open maybe to more manipulation, then I like to use technical analysis more as a timing tool for entry and exit, and use that in conjunction with some fundamental news or knowledge I have, behavioural or sentiment tools, as the main driving factor behind my trading strategy. And another often overlooked factor is your own personal circumstances and objectives. Technical analysis is brilliant for creating trading opportunities and strategies around your lifestyle. If you've only got a certain part of the day to trade in, technical analysis, speed it up and you can do that. Or longer term trades, you're retired, got more time to sit on positions, use a longer term technical analysis approach. So it's really good for throwing up so many opportunities for you. We've looked at time frames, and we can speed up and slow down our trading to suit within technical analysis, or you can even get rid of time altogether and have strategies that focus purely on price movement, like Renko, Kagi, line break, or point and figure. And with technology changing as it is, day by day, more tools and instruments and methodologies are coming into the technical analysis trading market space. And it also, I suppose, changes in technology and programming have allowed systematic trading, algorithmic trading, to make more of a mark and more of a possibility for almost anyone. So it's easier than you think, and has many advantages if you can get an edge in your trading strategy. Then systematizing it using technical analysis can take away a lot of the psychological defects and possible failings that can impact a potential winning idea. And I can tell you, even if you're a full algorithmic trader, you still can tinker and change things down to your own psychology to try and make it work. So technical analysis does go a long way to helping create discipline and consistency in your trading. So now let's have a look at what exactly is a trading strategy. So before you go off and start trading anything, using TA or not, you need a plan and you need a strategy. So what is a strategy? It's a set of trading rules that are constructed around an idea or uncertainty that you are trying to benefit from. So your strategy could be fundamental, technical, based on behaviors in the market, etc., etc. But it basically answers the who, what, why, where, how and when questions. So there's a basic 7-step design process. It's firstly coming up with the idea generation and a predefined strategy. Maybe it involves fundamental analysis, technical analysis, whatever variable, maybe even behavioral analysis, or some knowledge that you have to deploy. Then we've got to have a reality check. Does all your analysis add up? Then a head check. Are you mentally prepared to trade? Then you've got to put it into risk and portfolio construction. And then it's time to, after doing all that testing, back testing, stress testing, whatever, it's then time to trade. So here's a very simple idea to get you going. You think oil is going to go up for whatever reason that you've come to that conclusion. So how could you trade that? Well, you could buy Shell, the oil company, and you could sell EasyJet, the airline. Why? Because it's good for oil producers, the price going up, and bad for airlines because it's factored into their ticket price. And how? Well, you could time your way in using technical analysis for entry and exit points. Now, that above example in the world of trading is known as a pairs trade, which is very common in stocks. So here's another example, just using purely the technicals. Our technical tools we could define as the MACD, parabolic SAR, CCI. I know we haven't covered off the parabolic SAR, but I'm just throwing it in there to mix things up. Maybe you want to investigate that as well. And our trading plan says when the MACD and the parabolic SAR flip in the same direction and the CCI meets that criteria and all three add up, you trade. And you check the longer term trend in the chart timescale above to confirm your trade direction, and stops are at relevant support and resistance for the trade order. And in terms of trade management, you're going to trail the chart 5 to 10 points above close of every daily high low, so depending on the trade direction. And we're looking for a risk reward of 2 for 1, so that means for every £100 invested we're looking to make £200. And this is what that example we've just gone through could look like. And this is the S&P 500 daily chart. The actual chart type is Heikin-Ashi, and we've got on the CCI the MACD, the parabolic, and we're looking for those three to line up in the right direction for us to either buy or sell the market, along with the trend direction being in our favour in a higher time frame. So being that the S&P is up in that chart there, the weekly might be up, and then we need the MACD, CCI, parabolic SAR to be pointing upwards before we do our trade. Don't forget the very important rule of multicollinearity when you're putting together a strategy. Don't mix bad indicators together based off the same information. So for example, the RSI and momentum's a bad combination because it's closing price, whereas RSI and stochastic is good because the RSI is closing price and the stochastic is a true range indicator. I encapsulate some volatility. So remember that when putting your indicators together. And you should do this in conjunction with other forms of analysis, chart patterns, volume, open interest, volatility. It's really up to you. So we're now going to look at a strategy that has a more fundamental slant. That's the driving force behind the trade, but we're going to use technical analysis to time our way in and out. And this is an example on commodity, and we've already looked at lean hogs, the pigs, and we know that buying fizzles out in the summertime and we see a big drop off from the price. So as our sentiment tool, our independent variable here, we're going to use the CFTC Commitment of Traders report to monitor the trading activity of those involved in that market. And then you'd go into technical analysis on the daily chart to time our entry and manage and set our stop losses and how we got out of the trade, maybe using Fibonacci. And this approach will therefore take out some of the emotion of the trade and create a systematic process for us. And that's what it could look like. We've seen our indicators below the price there. We have our Heikin-Ashi chart. We can see that we need them all lining up to give us that sell trade in that summertime period. And on top of that, we've got the fundamentals of the Commitment of Traders report backing up the evidence of the technical analysis. As I mentioned earlier in this section, technical analysis is great for creating systematic algorithmic types of trading. So if you're good at programming, getting your hands on big data, then technical analysis is a great tool for you and could be very profitable. And one of the reasons so many people fail at trading is that they can't trade systematically, and psychology and human emotion time and time again interferes and ruins a great trading idea. You don't have to be fantastic at programming. You can create a rule set that is very systematic in its approach. Think of yourself as your own computer. Try and take away those emotions and create some discipline. So when building any system, you need to answer the who, what, why, where, when, how. Remember that. And you can do this by back testing your theory. Download data to see if you can get positive results out of it. And that's easier to do on technical analysis. And then if your results or theory you think is going to work, put it into some sort of live practice. There are many software tools out there now that allow you to build up the basics of a strategy very quickly and very simply, just using technical analysis. Within TradingView there's a back testing tool and language that you can use. There are in other charting packages themselves, and like I said, it depends on your IT talent. You could even build your own system. Now myself, I'm not so bad on the programming and systematization side of things, and I run various programs based purely on technical analysis and quite successfully, using, for example, Renko and line break charts. So technical analysis does give you options. It allows you to work with other facets of trading, or purely on its own. You can be as hands-on as you want, or you can make it as automated as you want. The important thing is to get a trading plan down, and in the last section, section 8, I do include a basic trading plan for you to have a look at, but it probably even requires a bit more detail than that, and you need to create consistency and discipline in your trading if you're going to be a success. Successful trading is about helping yourself and putting the odds on your side, and we're going to take a look at the often forgotten, overlooked use of technical analysis, and that's risk and trade management. And if you're a raw fundamentalist or don't want to use technical analysis to make trading execution decisions, that's fine, but I think you're being foolish. And if you don't consider using TA to improve your risk and trade management processes, you are missing out. As we've learned in technical analysis, that it's great, the 5 points that I keep going on about: makes and saves you money, saves you lots of time, helps you deal with the psychological aspects of trading, creates discipline, and is simple and to understand and apply. We are fully aware that technical analysis can help us with strategy design, but it can also be a very strong tool to help us in the world of risk. It gives you a set of rules, i.e. fixed and objective parameters around which to trade, which in turn creates the psychological discipline you need in your trading. And many people go into trading blind, no rules, no plans, no strategies, and especially no risk and trade management. And that is why so many people lose at trading. That's why 8, 9 out of 10 fail in this space. So let's take a look at money management and risk and reward. So on top of developing a strategy with an edge, you also need to address money management, and that's just as important as your trading system. So you can use technical analysis to control the risks in your portfolio and individual trades. For example, you can use moving averages or an oscillator as a tool to get you automatically out of a losing trade, and this takes away a lot of the psychological pressure of trading. You can also use TA tools to calculate the risk reward on any potential trade idea you may have. So let's look at risk reward. We're asking the question, is it worth executing a trade? And only if the risk reward is in your favor would you want to do the trade. And how would we calculate that? It's very simple, and it does involve our technical analysis. The reward is the entry price that we got in to the target price, and the risk is the entry price that we would get in to the stop price, i.e. if the trade goes wrong, where do we get out, to the ratio of 1. So our risk reward of 2 to 1 is very good, and we're going to look at a gold example here. But if your risk reward dropped to 1 and 1, you'd need a edge of greater than 50% in your strategy to make money in the longer term. So this is where statistics, collection of that data becomes very important, so you can analyze to know where you are on the trades that you are doing. So from the example, you can see that technical analysis can help define those inputs. So here's our gold example, and we get into the trade at around $1,100. For whatever reason we've done the analysis, that's where we got in, and we now know a lot about double bottoms, treble bottoms, and support and resistance. So we put our stop loss around 900, so that gives us a downside of about $200 if the trade goes completely wrong. But our upside analysis tells us that gold should, we might have used Fibonacci or something like that, tells us that it's got upside up to $1,500, which is a $400 profit on the trade. So if we take our $400 and divide it by the $200 downside, we have a 2-for-1 risk return ratio, which is very good, especially if you're winning more than that 50% of your trades that you do. So here's a real world example using Bitcoin. We've put on our Fibonacci lines, we've spotted strong support and resistance, we've used a collaboration of indicators to get in, and we would then use maybe those Fibonacci lines to create our risk and reward numbers. So in the Bitcoin example, to summarize, I used Fibonacci to define the key areas of support and resistance, and if we were going long, where would we put our stop? So based purely on those Fibonacci numbers, then we could look at 2,900, 2,500. You can see how old that Bitcoin chart was when I first pulled it off, and it depends also on your trading time frames and knowledge of the assets underlying volatility. I just wanted to show you the Bitcoin example, to show you how in any market you can overlay these technical tools to come up with these sort of numbers. So what other TA tools could you use to define trading risk management levels? Well, you could use average true range, pivot points, moving average, it is volume at price. There are loads, but decide what you're going to use, put them into your trading plan, keep it consistent, and make that the methodology that you're going to apply systematically to your trading. So here's a sneaky way of staying in your trade longer to benefit from a move in your favor. Now a lot of traders have a fixed exit in mind. This is more of a trailing exit, which, like I said, it gives you a chance of staying in the trade longer. You get to your target point and you come out, and then the next day you go in to look at your charts and you see the price has moved even higher, and you get despondent, should have stayed in the trade, get very annoyed, and you can get around that by using something called a trailing stop. So let's look how that works. So the theory behind the trailing stop is it's going to stop us taking our profit too early, and it's a psychological approach to deploy. It's sometimes harder to use a trailing stop, but it does offer up larger potential gains in the future. So how do you do it? Again, it's by using technical analysis and our knowledge of support and resistance. So let's go back to our earlier gold example, and this time, instead of using the fixed target of $1,500 from our analysis, we're going to trail it all the way up. So imagine that the horizontal lines on my chart I'm just about to show you are Fibonacci lines, and you move your stop to just below these levels, as the price makes its way further and further up. And you'll see that we finally get taken out of $1,700 at nearly $200 extra profit. And you can use other tools to do this, pivots, moving averages, parabolic SAR, Fibonacci trend lines, all sorts of things. But again, same rule applies, make it a consistent approach. So this is going back to our original gold chart, but I've added on a higher price scale up the y-axis. Now it's the same entry point at $1,100. We put our stop again at the $900 to start with, because that's due to our analysis and knowledge of support and resistance. And previously we had our exit at 1,500, but what we do this time is we let the price get up to 1,500, and as it does it, we then move the stop, we trail the stop up to our first point that we got into the trade, our break even, which is 1,100. So now we have a free bet on the trade. So if it goes wrong and the price comes back down, we've lost zero. Bit of a shame we didn't make the $400, but we haven't lost anything. We're still in the game. But we've still got in the back of our mind that we think the price is going to go up further and gold. We know some news coming out or whatever. So we now wait, and with the stop at 1,100, the price is at 1,500. It then moves up to 1,600, our next Fibonacci line. We then, once it gets there, pull our stop up to 1,500. And now we've locked in $400 of profit. And guess what? We still think there's some juice left in the tank here. The price then wobbles a bit around the 1,600 area, but then goes up to 1,700. We pull our stop up to 1,600. We've now locked in 500 of profit. The price then goes back further up. We bring the stop up aggressively to 1,700, and then the trade's done its stuff. It falls back through 1,700. We get taken out of the trade, but we've locked in all that extra profit. So instead of getting out 1,500, we've got out at 1,700, and we've made $200 more. Now this is a process called trailing stops. It's very effective, but you have to have a consistent approach so you can measure how successful it is. So define it in your trading plan, and then deploy it, and it will make you think differently about your trades. Keep the statistics to see whether it works or not. So we've now seen how we can use technical analysis to keep the shirt on our back and the money in our pocket, help us create statistics and information to aid the performance of our trading. So an exercise to finish off here, get familiar by calculating stop loss levels and target levels on your charts in any time frame. Pull up whatever you like, go through the process to come up with the numbers and calculate the risk reward on the trades. And also, secondly, there, practice your trailing stops, practice the concept, and come up with your own set of systematic rules to apply for your trades, and then make that part of your trading plan. Technical analysis can also be used for improving your results, and this is sometimes forgotten by users of technical analysis, and it's not so obvious. But before we wrap up the series so far, the course, it's another part of the trading and investing jigsaw that we need to piece together to give you the optimal chance of success in this field. So I hope you now can see that technical analysis is not just a one-dimensional tool, and applying it and using it, the basic inputs to your TA in a simple quantitative qualitative process can go a long way to improving your results. And I do this methodically, day in, week out, year in, year out, and I can tell you it does seriously improve your results. If you know what you're doing, then you know what risks to take, what risks not to take. It's really obvious and straightforward stuff, but it does help. So as we've mentioned, we're introducing TA into our trading and investing to create discipline and consistency that we need for that better performance anyway. And by doing that, we're going to try and help minimize the human psychological interference and bias on your trading. And we've learned that technical analysis allows us to understand the psychology of ourselves and as well the marketplace, and we know that the best traders have mastered those two components themselves and the markets. And where the markets are concerned, technical analysis allows a trader to decode in a more simplistic and quicker fashion the psychology and behavior and fundamentals at a more macro level. And I like the quote to the trader: a chart is worth 1,000 words. We also know that using technical analysis lets us to become more objective than subjective. Although there is a lot of subjectivity and art into the world of technical analysis, it does create more objectivity in our decision making processes, which is crucial to success and improving the results. And technical analysis allows you and us, me, to bring these various components together in a more structured, systematic process. So if we focus a little more on market understanding, understanding people's behavioural psychology plays an important part in how markets move. And the profession of technical analysis, as we've seen, has created countless tools for time and entry, exit and analytical ability. And at this level again, we're trying to add in objectivity where possible. And you might have heard me mention this over the duration of the course. You can give 100 analysts the same chart and they'll all give you a different opinion of where the market is going. Now, when we're trying to understand the market, cycle theory is a great concept to understand, and we touched on Elliott and Gann and some of Wilder's tools, and they've all put their pennies worth in. And if you can understand by looking at a chart where we are in a trading cycle, using whatever technical tools you might want to use, then you can seriously improve your trading results. So take a look at this very simplistic view of the market. We've got our chart on here, and this was actually Bitcoin a while ago, and you can translate that into the psychological thinking of the participant. So on the left we start with optimism as the price goes up, the excitement, euphoria when it gets to the top. People start to sell out, maybe they're taking profit, people don't understand why, people become anxious, then it slips into denial, fear, panic and capitulation, and we're down at the bottom, and then despondency and depression creep in, and then people think, well, actually this is an undervalued market, we're going to buy in again, and they're going to use either technical analysis or fundamental analysis to reach that decision. And then that cycle starts again in hope, relief, optimism, excitement as the market moves again, and we create these waves and cycles. And knowing where you are in those waves and cycles is hugely important to how you deploy your trading strategies. What else could help us? Other tools such as pattern analysis, whether it's double bottoms, heads and shoulders, candlesticks like dojis, trend lines, obscure tools like pivots and Fibonacci to determine market support and resistance, oscillators, volume volatility, sentiment indicators such as VIX, commitment traders, currency strength, market breadth tools can all aid in our understanding and help improve our results. But how can you get an understanding of the supply and demand fundamentals for almost any market, from the highly liquid world of FX through to liquid commodities such as lean hogs? Well, the answer is simple. It's technical analysis. You can't be a fundamental expert in all of those markets. It's just too much effort and time. But you can be a technical analysis expert across those markets. So that's one of the pure beauties of using technical analysis in your trading and investing. So here's a look at our lean hogs chart, one of my favourite trades of the year. Spot the pattern. Be very difficult to spot any supply and demand peculiarities without the help of technical analysis here. I'll go back to this example because it's so clear cut, and it does play out every year, and it works for a fundamental reason, and we use technical analysis to take advantage. So it's not over when you close out your trade. You've left a footprint in the sand in the world of trading. You've put all that TA into practice. You've got your strategies set up, your risk management in place, your trading plan laid out, like you were Sun Tzu, and you've been merrily trading away for months. But there's still one part of that plan missing, And all that trading doesn't mean anything unless you understand and can decode what you are, and have done in your trading so far. If you don't keep on top of your trading results, it's going to be very hard to improve, and it's as simple as that. And, trading, investing is a results-driven game, and knowing your own strengths, weaknesses, opportunities, and threats will be crucial to your success. You're going to need to know the statistics, the data behind why you're winning, why you're losing, how you can improve. I was very fortunate when I was working at banks, hedge funds, trading companies. We had teams of accountants, risk managers, senior managers, all analysing our trading worlds 24/7, giving us this data. As a retail trader, you're not so lucky. You've got to do it for yourself. These places succeed because they have all that backup, but you can, do it yourself. There is the tools and the abilities out there to crunch the numbers, do the data, get the information that you need. So you've got to be really your own accountant, manager and risk person, as well as trader, all in one, if you're going to want to make money and be successful in this arena. So two things you're going to need to do is, one, think like a top athlete. You need to think and adopt the practices like those of the world top athletes. They don't sit on their laurels, and the best ones are constantly re-evaluating, changing, evolving, processing data information to get that edge to stay at the top of their game. And the same is the same in trading and investing. And this is where our technical analysis comes in. It creates the data for us to analyze, and I like to say, what you find, you've got to make actionable. The second thing you need to do is make results evaluation part of your trading plan. Keep a trader's log. It's very important. Record details of your trading activity. A lot of the brokers and packages that you can get available now allow you to download data, so it's not a very time consuming process. You've got to commit to it and put that data into the log, make it part of your trading plan. Say once a week you analyze and download, update your results so you know where you are for the following week. It's not much of a commitment, half an hour a week. If that's the difference between success and failure, I know what I'd want to be doing. Now, for example, if you've done your TA homework, you've kept your records, you're going to have details like entry price, stop level, target, exit points around every trade. You're going to create risk and trade management performance metrics around these numbers, like risk reward, points risk, etc. And over time you'll have kept a history of these results, and this information is going to be really critical and utilized really effectively into making your trading better. You're going to see win-loss ratios, how long you're in the trade for, were you long, short, what products you succeeded in, didn't succeed in, and all of that information comes from how you've set up in your technical analysis strategies and trades. Are you using Fibonacci incorrectly for your stop loss or trade taking? Only you can tell after you've done a lot of trades and you've got some data to analyze. Maybe you need to tweak that part of your strategy. You won't know unless you keep this information. On top of this simple technically derived quantitative data, you could further enhance that information with additional comments. Why did you close out? Why were you feeling a bit iffy that day? Did that impact your trading? How were the market conditions? All of this will help you create an edge you'll need to succeed in trading. So what could such inputs look like that you could include? It could be pre-trade info, products traded, trading strategy, trade date, were you long or short, percentage of your capital that you're using, price info, if you're doing spread betting, pounds per point, or something like that in CFDs, entry, exit, stop, risk reward, points, risk, max loss, entry trade details, trigger date, entry price, pound per point, stop loss, risk, and maybe closing details like reason for closing, the date, the closing price, profit and loss. They're just some of the variables. That's not an all-inclusive list. You can create your own as well, but these are sort of things you've got to be thinking around and how you can marry them into your technical analysis, your strategies, and pulling that data out to be able to analyse it successfully. So to round off section 7, one last exercise. Design your own way of evaluating your trades with the suggestions put forward in this section. Add the evaluation process to any trading plan that you create. Remember, in section 8 I'm going to give you a trading plan and we're going to have a quick look at that, so you could add that to that. And understand how technical analysis can help you with all of this. And the big takeaway from this section is that if you don't keep on top of your trading results, it will be very hard to improve, and it's that simple. You know, the big boys, the professionals, have accountants, risk managers all behind them. You've got to turn yourself into one of those as well as a good trader. So there's a lot to do, but you know, it's very doable. So you just got to commit to, you know, the trading plan. Now section 7, pull together all your TA learning to hopefully give you some ideas and an introduction as to how to turn that knowledge that you've learnt over the last 6 sections into a practical application for your trading and investing. It's a starting point. There's a lot more to it, a lot more detail, but you've now got a great platform in which to build on. And we've covered off strategy, design and implementation, risk and trade management, and improving your results. And I hope that the biggest takeaway from section 7 is that you can now see that, you know, TA is an all-encompassing tool in the world of trading and investing, and gives you that, you know, platform for structure, consistency and discipline that you need to be a success in this space. So let's just go through those 3 sections of 7 in a bit more detail. So strategy, design and implementation. Technical analysis, if deployed and used the right way, can be a very powerful trading tool, and used on its own or in conjunction with, say, a fundamental approach or a behavioural approach or quantitative way of doing things to design and implement a strategy. But you've got to remember, it's not a magic bullet, and you need to understand technical analysis, you know, really thoroughly before you can maximize its potential in your trading. You know, don't run before you can walk, and that's the purpose really of this course, is to give you that, or those building blocks, to then take it to the necessary next stage. So I really like being able to use technical analysis for risk and trade management, and I keep mentioning it's an often overlooked part of technical analysis, but it can really help improve your results and keep the money in your bank account when you're trading, and that's the most important thing. And I think it's a no-brainer really. You've got to be using it, you know, for, you know, even as a minimum, setting, you know, the trade and risk management stops and targets around, you know, your analysis. Even if you're a fundamental or a quantitative trader, it just helps. And I say, it's going to keep the shirt on your back. It's going to take out a lot of the psychological aspects of your trading, because you create a systematized, you know, consistent process. And, you know, it's going to help with your forecasting, targeting objectives, timing, entry, exit, you know, trade size calculation, risk and reward, all those things. And there are many tools to get you to that point within technical analysis. But once you've found those tools of choice, you know, define them in your trading plan, and you've got to be consistent. And there's, I can tell you from experience, fine margins between success and failure. So you've got to give those tools a chance to work and measure those tools and the results they provide you, to see how they need improving or changing or working, or whether you're going to stick with them. But you have to be consistent. And lastly, improving your results. So I like this saying from Manu Bennett: anyone can train to be a gladiator, but what marks you out is having the mindset of a champion. And this is leading me into what I was saying about how the most successful sports people, business people are. You know, they put in that extra mile to analyze what they're doing. And in our trading, that's about post-trade analysis. It might sound boring, but it needs to be done, because if you do it, your results are going to change dramatically. If you're a losing trader, you can spot places where you're going wrong and correct them. If you're a winning trader, you know where to go bigger and take more advantage of. But it does require commitment and the right mindset. And those are the best traders, they're the ones that can do it. So TA is just another part of the process. It's going to aid market predictability and create the objectivity that you need to give you that springboard to success. And I think quite simply you'd be a fool not to introduce some of the elements of technical analysis. If after you've done this course you only took some of it, maybe the risk management part, and applied it to your trading, then that's a massive leap forward, and I think you'll notice the results. A very big congratulations to you for completing the course. A very big well done. But before we can finish off, we've got to go over a few things. We've got to review where we're at, some other resources for you, and what you need to do next. So in terms of course summary, you've now had a great introduction to the world of technical analysis. You should now understand the background and history of TA and how it has been shaped more recently by the advancements of technology, software and globalization. And hopefully the course has inspired you to use TA in your trading and investing and left you wanting to dig further into the various topics presented. More specifically, you've learned about the basic chart types, the line, bar, candlestick, point and figure, and you've learned about the rules, the big questions, and the different forms of analysis around direct price analysis and their tools, trends, support, resistance, price patterns, moving averages, bands, pivots, Fibonacci, Ichimoku, the price confirmation tools, trend and momentum, volume, volatility and sentiment, things like the RSI, stochastics, CCI, and alternative concepts such as Elliott wave theory, GAN, and market profile. You've had an introduction to the very interesting looking Japanese charts like Renko, Kagi and line break, and you've learned how to put all of that TA together through strategy, design and implementation, risk and trade management, and improving your results. Quite frankly, you've learned quite a lot over the duration of this course, but there is one more surprise I have for you. Now, I've mentioned it enough in the course, you'll need a decent trading plan, so I'm going to try and get you started on that, and you'll find attached a trading plan and a couple of quizzes for you. Well, not quizzes, but more tests to find out what sort of traders you are, because there's no point doing all this course if you're not going to put it into some sort of action. So I've included the trader's plan. So like I say, complete the 2 tests, the risk profile and mental toughness test. Then start filling out your trading plan. It's a blank one that I use generically across courses, but it's going to help you to start building your own trading and technical analysis strategies. And something important to take away there is, a lot of the inputs are subjective. You've got to be honest, work on those weaknesses, add in the scores from the 2 tests, keep track of those, and as you progress, update, change the plan. It's going to be work in progress to start with. There is no right answer to this, but when you do your trading plan, stick with it, give it a go. It's use it as a key document for your trading and analysis. So looking at some other resources you might find helpful that we provide at the Stock Punter: brokers. Find out who I use, who I recommend. If you want to start trading either demo or live, what works best in certain countries, in different markets. Further look at the technical analysis packages if you want in more detail, the ones I use and recommend. The Stock Punter, if you want further support or information or want to get in touch, email at info@thestockpunter.co.uk. and visit the website www.thestockpunter.co.uk for other trading solutions. We have a traders club, a managed account trading fund, I've got a book, and there's loads of other free resources. I did mention that I offer other courses, more detailed, comprehensive courses on technical analysis, those branches, those routes off of the course that you've learned that you might want to master and get into. We've got ones on Renko, Ichimoku, Heikin-Ashi, line break, a VIX and volatility strategy for stock indices, a very good trader called Darvas and his methods and how you can use them in stocks and financial trading, and we've got a Kagi course there as well. So there's a lot of extra course and learning. It's full of strategies, ideas, more techniques, tips, to get you on and make you better traders and investors. Now I've also got a YouTube channel, and on that it covers pretty much all things about trading, strategy news, tips, tricks, ideas, challenges, etc. and much more. It's a great tool to supplement your learning, education, takes you into other areas. You find out stuff and information that you might not have been able to get hold of before. Totally free, the channel. Why not subscribe and aid your learning. What next? Well, you've got to keep it fresh in mind. There's no point doing a course like this for all the hours you've put in if you then let it sit on the side for months. You've got to action what you've learned, and in the next few days you feel free to take a few of them off, let it all sink in, and then over the next few weeks revisit the course content, submit those findings, the learnings into the grey matter, cement them in there, and then on top of that, why not develop and finalize your trading plan, take those tests, create your setup, strategies, objectives, goals, time available, how does it fit into your lifestyle, those risk management and trade rules we talked about. Get that trading plan finished. Then next month, if you haven't already, get your brokers set up for demo and live trading, sort out your hardware, computers, workstations, the software, the charts, spreadsheets, resources, get that all done, and then you should be good to start at least demo trading or live trading. And if you're too concerned about the live trading, why not just make the trades small so you can get a feel for what's going on, because you'll learn a lot quicker. And after that, it's about committing to your trading plan. Keep track of your results in detail. We looked at performance analysis on the course. Use the resources highlighted at or by the Stock Punter. And remember, trading's a journey, and it might take you 1 week to master it. It might take you 10 years to master it. But you've got to understand that it's a journey, and you've always got to improve. Again, going back to performance analysis, think like the top athletes do. Businessmen, how they get to the top is through hard work, dedication, and learning your strengths and weaknesses and how to develop and make yourself better. And taking it further still, get as much experience as you can under your belt, learn and keep learning, have that passion for trading, investing, technical analysis, get a mentor. It doesn't have to be me, it can be anyone that you believe in that can help you with your professional trading development, and always seek help from the right people. Get hold of the resources and use them that are available to you. Speak and feed off like-minded people. And trading, remember, shouldn't be a matter of life and death. You should enjoy it. The technical analysis part, you should enjoy it, and you'll find that it becomes more rewarding to you. There you go. I hope you've enjoyed this course on technical analysis and you find it very useful and be able to apply it into your trading and investing in the coming days, weeks and months. Please leave your thoughts, feedback, anything you like in the comments below, and if you've liked the video, please remember to give it a thumbs up. Don't forget to hit that subscribe and bell buttons if you haven't already, and all that's left for me to say is thanks for watching, good luck with the trading, and I'll see you in the next video. Thank you.